Good morning, everyone, and welcome to day 2 of the Bank Research Conference. We're excited to be sharing another day of banking research with you at our 20th annual celebration. We're going to open today with Elena Lutskina moderating a session on the effects of banking competition on borrowers. Then we'll have a session on bank risk and regulation before we break for our lunch Eastern time and coffee or tea or whatever you would like to do in the part of the world that you are in. And then we'll continue after lunch with a panel discussion starting at 12:45 Eastern Standard Time, moderated by Christine Parlour, looking at 20 years looking forward into banking research. After that, we'll then have a short break and reconvene for paper sessions in the afternoon on systemic risk, starting at 1:55 p.m. Eastern Standard Time, and then 3:35 p.m. we'll start a session on pricing climate risk. Like we did yesterday, we'll have virtual receptions in the afternoon, one dedicated to presenters for the morning and one room dedicated to presenters in the afternoon. And we encourage everyone to join us there. That's a more interactive and informal environment where you can ask questions and answers that you're not able to pose with the time that we have during the paper sessions and panels. We are very excited to start our day with you, and I'll turn it over to Elena to introduce her session.
Good morning and welcome to the conference. And it's a great pleasure to moderate the session dedicated to the effects of banking competition on borrowers. We have 3 magnificent papers and great authors to hear from. And without further ado, I'd like to pass the microphone to the authors of the first paper, Competition and Selection in Credit Markets, and I believe Anthony is presenting.
Great. All right, so I'll get started. Hopefully everyone can hear me. Okay, so thanks a lot. It's great to be here. So I'll be presenting a paper, Competition and Selection in Credit Markets, which is co-authored with my colleague here, Konstantin Yunelis. So let me just jump into the paper. So what's this paper about? In short, in this paper, we're characterizing, as fits the theme of this session, a kind of interesting and counterintuitive effect of competition in financial markets, right? And then, of course, there are many such effects. We're going to argue that this is sort of an effect which we think hasn't been looked at as much before. Let me just jump in. Here's a picture of the relationship between concentration and prices in the U.S. auto lending market, right? So what we have here is, let me just make sure I know how to use this annotation. What we have here is on the x-axis, the HHI, and then so that's like a measure of how concentrated the market is, going from 0.25, which is roughly 4 lenders, to 0.05, which is roughly 20 lenders, right? And then on the y-axis, we have interest rates, and this is for prime borrowers, right? And then so what we see is we see the classic relationship, right? And so we see basically that sort of in a more concentrated market, we have higher interest rates. Relatively big change, right? You go from around 4% to around 6%. So this is over the past 10 years. So relatively low interest rates, relatively large effect, right? Okay, so that's as expected. What's the counterintuitive part? Well, the counterintuitive part is when you look at the subprime market, you actually see the opposite effect. So then you see that in more concentrated markets, there's actually lower interest rates. So they're getting much higher interest rates on average, like 13, 15%. But you see a statistically significant relationship where sort of the more concentrated the market, the lower the interest rates borrowers are getting, right? So what we want to explain in this talk is what might be happening here. And then the explanation we're going to come up with boils down to the following. A core difference, we think, between consumer lending markets and, say, for example, firm lending markets is that nowadays consumer lending markets involve fixed cost screening decisions. You make investments that basically allow you to screen out consumers likely to default, whose fixed costs are very high, but it's relatively cheap to apply them to more consumers. So think about a firm. You want to lend to a firm, you need to figure out how likely that firm is to default, right? That's an investment that you make firm by firm. Sort of learning from one firm doesn't tell you that much about another firm. For consumers, however, sort of the way you're doing things, you're building a giant data model. And then that model tells you sort of how likely consumers are to default. You can improve that model. The way you improve that model is, for example, buying alternative data on consumers, building automated decision software to make these credit decisions, buying alternative data, automating lending, so on and so forth, right? And the key nature of these technologies is they're expensive, right? I'm going to give a back of the envelope showing that they're sort of non-trivially expensive even for relatively sort of large lenders, right? But the thing is, after you build them, the marginal cost of applying them to another consumer is not very high, right? So basically, I'm going to build a model in which this combination of imperfect competition with fixed cost screening investments is going to make it so that we can match this asymmetric relationship of competition with interest rates. So you can predict that sort of interest rates have the classic increasing relationship with concentration in the prime market, and then sort of this counterintuitive decreasing effect in the subprime market. And then in a nutshell, what the model says is the following. In the subprime market, sort of you have a small market share, you have no incentive to build data models. You have no incentive to hire data scientists and build decision models. So sort of you have set low markups, but sort of your consumer population is really bad because you can't screen out the bad types because you didn't make these investments, right? So when the market's more concentrated, everyone has a bigger market share, and sort of they have bigger incentives to make these fixed cost investments, right? That's going to make the population of borrowers lower risk, allowing lenders to charge lower interest rates. And then so the idea is basically that sort of this force can be strong enough in the subprime population to counteract the standard markups force and lead to lower interest rates. That's the gist of our theory. So sort of fixed cost screening investments is a mechanism through which concentration can actually lower prices for consumers. Okay, then we're going to sort of take this simple plot and then show you that's like fairly robust. We're going to look at auto lending data, and we're going to show that there's this robust sort of asymmetry in the correlation of concentration and interest rates for low risk and high risk groups, right? Of course, you should never regress interest rates on concentration. We're going to use quasi-exogenous variation in bank market structure as well from bank failures and bank mergers, so two designs that we found in the literature for variation in concentration. We're going to show you some direct evidence showing basically that it looks like lenders are actually investing more in observable screening technologies, one that we found an example of. And then we're also going to show you that the model's predictions on default rates and loan quantities are also hold in the data. And so the implications you should think about our results, we think we found sort of this sort of interesting new effect of competition in this like consumer lending setting, where sort of these screening costs, these fixed screening costs will affect interest rates alongside the standard sort of competition and markups force. And so this is implications for how we should think of doing competition policy and how we should regulate lending and concentration in these consumer lending markets. Okay. So I'm going to skip related literature mostly for reasons of time. Jumping into the model. So I basically told you the basic two forces in the model, but let me emphasize these again. I'm going to construct a simple model with basically two forces. So a bunch of lenders are competing to make loans to consumers. Lenders have market power, and so they're able to set prices somewhat above marginal cost. Lenders also make these fixed cost screening investments to identify and screen out high-risk borrowers. These two channels are going to have relatively intuitive two different effects on interest rates. So the idea is that as you increase the level of market competition, right, that is a standard effect that in imperfectly competitive markets, that's going to lower markups over break-even rates. So the minimum rate that you can set, which depends on the default rate. But due to screening, the default rate is endogenous, right? And so if you have a smaller market share for the same fixed cost, your costs are amortized over less consumers. So then you have lower incentives to screen. And then so your consumer default rates are also higher after screening. And then so that implies that your your break-even rates are higher. And this force tends to create a upward pressure when more competitive markets on interest rates. And how we match the asymmetry in the population is basically that sort of in high-risk populations, sort of screening is very important to lower default rates. So basically sort of in the low-risk prime segment of the market, this one's going to win. And in the high-risk segment of the market, the second force is going to win. Okay, formally, what do we do? Formally, we have n identical lenders indexed by j. So we have a simple sale-off circle model. It doesn't really matter what model we use. We have a logit model in the appendix. We have a simple two-type framework. So there's a unit mass of good consumers who never default, some measure of bad consumers who always default, right? And then you can think of Q as basically when Q is high, we're in subprime world. When Q is low, we're in prime world. And lenders pick two things. Lenders pay a fixed cost to screen out the bad types, decreasing the default rate, and then lenders set interest rates. let's analyze separately the markups and the investment screening investment incentives, right? So take a symmetric equilibrium, everyone splits the market, right? How large your market share is going to determine your markups, right? So then your loan rate minus your break-even rate, which depends on the default rate, right, is going to depend on two parameters. It's going to depend on a price elasticity parameter. So this is just sort of the price sensitivity of consumers, how much your consumers will borrow from you, your local consumers, even if your price is relatively high, and it depends on competition. So send n to infinity, and the market is very competitive, and then your markups are going to be very low. Loan rates are going to be set such that lenders basically just break even, right? That's going to generate downward pressure. What generates upwards pressure is that how much your incentive is to screen, to invest in these sort of machine learning technologies to improve your default rates is going to depend on your market shares, right? And then so the smaller your market share, the less incentive you have to hire a bunch of data scientists and build these screening models, because sort of you don't have enough customers for this to be worth it. Okay, and then so a picture of the last slide is the following. This is basically the model counterpart of the picture I showed you. And then so I break interest rates here into two parts. I show you how concentration, the Herfindahl index, is associated with markups, and how concentration is associated with default rates, right? This kind of visually sort of shows the two channels of the effect. More concentrated markets, lenders set higher markups, but they also screen more, and then they tend to decrease default rates. So what the different colors are sort of blue is the prime population. So that's like the fraction of bad types in the population. So what we see is default rates are always decreasing in the level of concentration. However, the effect is stronger when there's more sort of higher default rates to begin with, right? And then so the idea here is that sort of for the red line, sort of the screening channel is really important. And then for the blue line, it's relatively quantitatively smaller. And the end results for interest rates are the following, right? So we see the asymmetry in this plot. For the prime consumers, you see a positive relationship. So the markup force basically wins. More concentrated markets, higher markups, higher interest rates. And then for the subprime consumers, the screening channel wins. And then so for the subprime consumers, you actually see interest rates decrease from around, in the simulation, 20% to like 10% as we make markets more concentrated because lenders have higher incentives to screen. So that's the model. And then so the main prediction of the model is we match this asymmetry, right? We match that there's this asymmetric relationship between credit scores, between concentration and interest rates, depending on the level of risk in the population. And the model also makes two other predictions that we'll bring to the data. The first is that this screening channel should be symmetric in the sense that higher concentration should be always associated with lower default rates. Only that sort of this effect is bigger and dominates the markup channel in the subprime segment. And the second point is that sort of what we think is a relatively sort of sharp test of our model is that in our model, an increase in concentration can lead to a simultaneous decrease in prices and loan quantities, right? How this happens is basically that sort of when concentration is higher, lenders screen more intensely, right? And they restrict credit to the good types and are able to offer lower prices as a result. We think this is relatively strong evidence that some kind of screening is going on. Because if you simply offer to lend at a certain price without screening, if you offer lower prices, more consumers should want to borrow. So you shouldn't be able to see sort of quantity and prices moving together with concentration. And so we're going to bring this test to the data. Okay, so what's the empirical setting we're studying? We're looking at the US auto lending market. Why? Because it's pretty big. And also because something that was a bit surprising to us to find, securitization rates in this market as a whole are surprisingly low, right? So then if you just take the total outstanding auto ABS and divide it by the total outstanding auto loans, you actually get a number that's like 20%. So we don't necessarily need this for our model, but the thing is if you want a model in which lenders basically are making screening investments, actually care about the default rates on their loans, right? Sort of, it's nice to know that many of these loans are just staying on lenders' balance sheets. Other reason, of course, there's some narrative evidence that sort of these investments are actually going on in this market, right? So lenders appear to be increasingly spending on predictive analytics, AI, alternative data, and so on and so forth. Okay, so we use credit panel data. So we aren't restricted to one of the many kinds of lenders in this market. We see banks, credit unions, dedicated lenders, anyone who shows up on a credit report. We use the TransUnion credit reports. We observe loan balance, payments, and maturity from which we can back out interest rates. We've sanity checked some of the volumes in this data. We also observe a lender key that allows us to compute Herfindahl indices, where where across markets is it the case that we see this asymmetric relationship between concentration and interest rates. And once again, in the prime market, classic relationship, high concentration, high interest rates. Subprime market, the counterintuitive relationship, high concentration, low interest rates, right? Well, we can run some regressions. We can add counting in year fixed effects, regressing log interest rates on fixed effects, and then the log of the HHI pretty robustly across different fixed effects specs. So no fixed effects for year, counting fixed effects, we see a asymmetry. So negative relationship for subprime, positive relationship for prime, right? We can split into finer credit score buckets, and if we go from very subprime, slightly less subprime, more and more prime, we see a relatively monotonically increasing relationship between very negative relationship, very negative, positive, more positive, positive insignificant, right? So we can throw a bunch of different specs, and it seems that results hold up. We take a very strong sense on what's driving this, right? And the idea is that there's many forces through which competition has weird effects in credit markets. And then so we better give some evidence that this really is going on here, right? So we have some direct evidence, which is we got data on lenders' purchase of one alternative credit product, which is TransUnion's Credit Vision product. And it gives consumer behavior and histories that are also useful for getting default rates, right? So a simple prediction of our model is lenders should be investing more in Credit Vision in more concentrated markets. We do a simple pin scatter, higher HHI, is also associated with a higher fraction of lenders actually buying Credit Vision, right? And then so another piece of suggestive evidence is the credit scores of the average customer base are somewhat higher in more concentrated markets. So these are just two pieces of evidence, pinning down, suggesting that our theory, in fact, may be at work here. So we also have in the paper a discussion of the many other theories, adverse selection, menu screening, so on and so forth, that may be at work. And we discuss in some detail how we think that none of these other theories are able to match all of the facts that we observe in the data simultaneously. But so this is one indication of that. Okay, so we're not supposed to regress interest rates on market structure. Everyone in IO says that's a terrible thing to do. So what we can do instead is we can at least look for some quasi-exogenous variation in market structure, right? And so variation in market structure uncorrelated with other determinants of prices. I'll go over this a bit quickly for reasons of time, but we use two designs. We use a standard bank mergers design. So what happens to interest rates after a merger? And then we use a cross-sectional instrument exploiting the failure of large banks in '08, which led to persistently different concentration in areas where those large banks had a high market share. We found this instrument in a recent paper by Greg Vucek and Adam Joring. Okay, so I'll have to go over this a bit. Oh, one thing. So why is this a valid instrument? Well, banks are not the only lenders in this market, but banks are an important subset of lenders. And if you simply plot bank market concentration against auto lending concentration, the levels are quite different, but there's a very strong correlation. Okay, so I'm just going to jump to the results for reasons of time. Using the cross-sectional instrument, we find an implied correlation, which has an asymmetry, just as we see before. So the idea is that an increase in concentration causes a lower interest rate for subprime customers and a higher interest rate for prime customers, as we see in the non-causal evidence. Similarly, for bank mergers, I should note this is a relatively weak instrument, so we have some issues with weak instrument issues. However, we also find basically that a bank merger is associated with a downdrift in interest rates for subprime consumers and roughly constant interest rates for prime consumers. So the causal evidence seems to match up. I will mention that we test the default rate predictions and also the quantity predictions from our model, where we said an important test of the screening channel is, can we have interest rates and quantities simultaneously decrease? And it does seem like we can have in some of these segments this happen, that concentration increases are associated with prices and quantities both declining, which is inconsistent with movements along the demand curve. The last thing I will... Oh, sorry?
2 minutes.
Yeah, great. So we do have a number of robustness checks that I'll mostly leave to the paper. I'll just mention briefly that we divide the sample into auto lenders, so lenders that only make auto loans, and bank lenders, right? So you may be worried that mix shift is driving some of this. So basically, sort of, maybe in more concentrated markets, you have more like fintechs, or you have more sort of banks or something, and that's driving it. Well, that doesn't seem to be the case, because when we divide the sample into only looking at the rates set by sort of one of these types, we still see the effects we find. We do some analysis of lender size. I'll leave that mostly to the paper. I think the last thing I want to talk about is that sort of as a final check, that could our channel possibly be explaining this, right? And we do a simple back of the envelope. And the back of the envelope we want to do here is the following, right? Our theory says there's an investment that decreases default rates. A big lender is willing to make that. A small lender is not willing to make that. So can we put numbers on that, right? Average subprime loan is $17,000, which implies that a lender should be willing to pay $100 per consumer to decrease the default rate by 1%, right? And then just turning through the numbers, our P50 lender, right, is going to be willing to pay around $6 million a year to decrease default rates by 1%, whereas our P25 lender is only going to be willing to pay $400,000, right? So the idea is a fixed cost of roughly, it costs like between $400K and $6 million to build a model is something that would be count as a screening cost that does what we do in our model, right? So if you think you need to hire, say, a couple of finance PhDs and buy some data in order to sort of build this technology, then your big guys would be willing to do that, and your smaller lenders would not be willing to do that. And so we think basically sort of that suggests that these costs are in the ballpark of reasonable, right? And then I'll basically stop there. There's more robustness checks in the paper. I'll just conclude by saying we have this simple model of screening and price setting that has this counterintuitive effect that higher competition can actually sort of lead to higher interest rates and be bad for consumers. And I've shown you some evidence of sort of why we think this new screening channel is the channel at work here. And we think sort of this may be sort of a new effect that we should take into account when thinking about the effects of competition in these kinds of credit markets. All right, I'm done. Sorry for going a bit over.
Thank you very much. I'm just grabbing this. Can you hear me? Okay, great. Thanks. So thanks to the organizer for inviting me to present my paper. This is joint work with Maria Gianetti from the Stockholm School of Economics. And since I work for the Federal Reserve, of course, these views expressed here are our own and do not necessarily reflect the views of the Board of Governors, the Chicago Fed, or the Federal Reserve System. Okay, so why do we care about the deterioration in syndicated loans, and to what extent ownership concentration affects outcomes? If you think about the last 20 years, and especially over the last 10, financial regulation has driven or shifted more and more risk in credit markets towards financial institutions that are less regulated, basically non-bank lenders. You can think about CLOs, but also increasingly private equity funds, hedge funds, to some extent insurance companies and pension funds. All of these invest now in leveraged loans. And so you can consider that new concerns have arisen about the secondary market of syndicated loans coming from these regulations and capital constraints of banks, as well as collateralized loan obligations. So specifically, you can think about leveraged loans will be fire sold if banks suddenly run into financial capital constraints, or CLOs have all these collateral tests. If they start failing them, they may have an incentive to sell off of some of these loans, which then could lead to price drops, increased price volatility in the leveraged loan market, and in extreme cases, spill over even in the primary market for leveraged loans. And in the very extreme case, as we actually seen in late 2015, shut down the market completely. So with that in mind, we want to look at what happens if you have more and more of these new lenders, non-bank lenders taking over shares in this market, and what are the incentives to cure loans once these loans run into difficulties. So we could think that these new lenders have more skills or they have less skills. So the question here is, how do these new ownership structures interact with potential default? We know from the literature, for instance, Robert has pointed this out repeatedly, leveraged loans are renegotiated very often, especially after shocks to borrowers' financial health. Similarly, we know that renegotiations usually have a positive effect on subsequent performance on the loan. So if you manage to get your syndicate into a room and to agree on a renegotiation, whether it's an amendment or refinancing arrangement or whatever it is, then typically the bank is better off. But of course, the bigger your syndicate is, the less likely it is that you will find some arrangement. And so our question is coming exactly there. What can we learn about changes in ownership structures and subsequent renegotiations, especially for those loans that are of deteriorating quality? So what we do in this paper is the first question that we ask is like, how is the syndicate structure changing after negative shock to credit quality? And I will talk more about this. For here, we are going to take the credit quality measured by regulators. So these loans get a regulatory rating. And we do this because regulators have, as you well know, different incentives than rating companies. So to some extent, we're going to trust that much more. The first question that you then ask is, do regulated intermediaries sell? And regulation should be here seen broadly, not just government-based regulation, but also governance regulation. By that, I mean the CLOs that face these internal constraints that are well written down in their own documentation. And of course, who's on the buying side? So we will first establish these two things, and then we will ask, does more concentrated ownership of this outstanding debt actually get you more renegotiation and potentially better outcomes, which would be consistent with the theory once posed by Bolton and Scharfstein back in the 90s. So once we want to do this, we of course run into the problem that all of this looks terribly endogenous. So what we are going to do is we are going to exploit exogenous financial constraints on these buyers of loans, or those that typically buy these loans, that prevents more concentration of loans. And we'll use that as an instrument when we study outcomes of leveraged loans. Okay. So here, this figure just shows you what happens after regulatory downgrade. And you can see that the number of lenders goes down actually quite a bit after a regulatory downgrade. So the main findings of this paper is that banks and CLOs sell after regulatory downgrade, which is totally consistent with the regulations they are subject to. I should also say, if you're wondering, it's true that CLOs are tied to credit agency ratings, but credit agencies tend to be not too far behind regulatory rating downgrades. The buyers are typically mutual funds and hedge funds, and this may be surprising. You may think of vulture funds from the literature as those that buy very distressed assets, but we want to point out here that banks and CLOs sell basically at the first signs of stress. These loans are nowhere near bankruptcy. Of course, that means that the prices of these loans will go down, and mutual funds and the hedge funds seem to be the one who are willing to take that risk and buy these assets. We also show that the concentration of loans in distress increases as long as there are no financial constraints on the potential buyers. And then we document that higher concentration with our instrument of financial constraints is related to better loan outcomes ex post. So if you think about the literature, and I will be somewhat brief here, there's quite a number that I've written 2 papers that show that banks sell loans when they either face a shock to their funding position or when they're short of capital. There are these papers that document the constraints on CLOs and the subsequent downgrade and how these can have fire sale effects in the secondary loan market. More broadly, you can think about how concentration and creditor types can affect outcomes, and this generally has been studied in the context only of bankruptcy. Again, here's Bolton and Scharfstein is the classic reference, and then on the empirical side, this has been studied in the context of vulture funds, hedge funds, or creditor concentration trading claims during bankruptcy. But again, this is only in bankruptcy. What I've already shown you before in this little graph is that ownership concentration increases already when financial distress is mild. So when you're still far away from bankruptcy, you already have this effect. So everything that you study within bankruptcy is basically already endogenously more concentrated. So when we go to the literature on loans, then we have to take into account that when banks are not able to renegotiate, we have evidence that this is going to hurt borrowers in the syndicated loan market, but also more broadly. So in our paper, we are not talking about banks because banks, as you will see shortly, they are the ones that are going to exit. The data we are going to use is the Shared National Credit Program. It's a program run jointly by the Federal Reserve, the FDIC, and the OCC. In its most current version, it has loans over 100 million by at least 3 supervised institutions. And I should point out here that this is going to be a shortcoming. The loans that actually have no banks in them anymore in the syndicate, they will not be in the sample, and that's a limitation that we have to acknowledge. But in the data, we also see the borrower identity. We know when the loan was originated. We know what type of loan it is. We are going to drop the credit lines because we are only focused on the term loans that are held by a large set of different financial institutions. And we see the loan share of each lender, and that allows us to infer transactions, who bought, who sold. We are going to do this on the quarterly data that run from 2009 Q4 to 2019 Q4, and we intentionally stopped before COVID because, well, we also don't exactly know what to do with it right now. Okay, so here are the ratings. So you either get a pass rating, a special mention rating. That means there's some weakness, but it's not really a problem. Then substandard is more substantial problem. Doubtful already raises the question whether you get your money back. And loss means you should charge it off as a bank. The point here is that banks will react to any rating that is not pass immediately because you have to start to provision for these loans. So if you have a special mention loan, you have to provision for 20%. So you see immediately why there's an incentive for banks to respond to these rating changes immediately relative to a credit rating agency change. Here, this has direct implication to the bank's balance sheet. Okay, going forward, so here's what's going on in these loans. You see in past loans, you actually see in the blue bar still like 30% banks, and once you go at a rating that's worse than past, the bank share immediately drop, and you can also see that the share that is gaining a lot is mutual funds. CLOs and banks, especially in the lowest ratings, they sell off, and it's the mutual funds that show up, and you see that the hedge funds are also creeping in, even so they have a much smaller share than you may have expected. Okay, so now we want to know who's buying, and to buy, we run a very simple regression. We look at whether the institution purchasing, like who is the institution purchasing? So this is like, is it a bank? Is it a mutual fund? So this is conditional on purchase. And we regress this on a bunch of fixed effect, bank and time, and then the rating. So basically what you're picking up in the regression is a bank more likely to buy after a downgrade or after a change in the rating? And this is what you get, and you can see that once a loan is downgraded, banks are less likely to buy, mutual funds are more likely to buy, CLOs are less likely to buy, and hedge funds are more likely to buy. So this is totally consistent with the graph that I showed you. This is just in regression form, providing additional evidence for that pattern. Then you can ask who's going to be the largest owner. So you run a similar regression, you put on the left-hand side who's the largest owner, and you can see after a downgrade, so we define downgrade here is whether the loan was downgraded at least once in the last 3 quarters. So if in the recent past the loan has been downgraded, who's going to be the largest owner? And you can see it's way less likely to be a bank, and it's more likely to be a hedge fund that holds the largest share in the loan. Similarly, you can see that all of our concentration measures respond to downgrades as well. In fact, concentration goes up no matter how you measure it. So there are less number of lenders. The top 10 hold the larger share. The largest share will be larger, and you can also measure it as the HHI, which also goes up after a downgrade. We then provide additional cross-sectional evidence for our channel. Particularly what we have in mind is that concentration should occur more in these industries in which the bankruptcy costs are higher or gains for renegotiations would be higher. In particular, these are firms with high cash flow volatility, where you have low asset tangibility, high R&D, and low leverage. And this is totally consistent with the story we are telling, that even early concentration and avoiding bankruptcy is already beneficial. We also find that concentration increases more when the bank's lead share, either current or at origination, is lower. And that would be consistent with partly monitoring, but also the lead bank still being in charge. So if the lead bank has a large share, it might take that role of coordination. But once the lead bank is out, somebody else needs to do the job. So you need to see more concentration, that somebody can take over that role that perhaps the lead bank has played before. Now we want to go and think about outcomes a little. So here, of course, we have an endogeneity problem, that lenders are more likely to concentrate if you expect favorable outcomes. So this is why we need an instrument, and that is going to be coming from financial constraints. And the financial constraints we are going to use is, what is the number of downgrades the lenders have experienced in other unrelated industries. And then we are going to go to the syndicate and ask how many of the lenders in this syndicate have experienced downgrades in other industries that should be unrelated to the downgrade for this loan, right? So we are going to define this on the 2-digit industry level, and we are going to argue that when a lot of the lenders in the current syndicate are financially constrained, that is going to make it hard for them to buy up more and to concentrate, and therefore we will see less concentration.
4.5 minutes.
Thanks. So just to show you that the story I told you is true in the sense that there's less secondary market trading when this downgrade share is high. So let me show you the exclusion restrictions. So these are loans that were never downgraded. These are all past loans, and you can see nothing is significant here, right? So the downgrade share does not affect refinancing amendments, loan amount changes, regular credit rating downgrades in any way for loans that are never downgraded. Okay, so that's great, because that means that really something can go on through the ownership structure. So let me show you this. When we use the instrument, I should point out we have an F-stat of 15, which isn't too bad, so it's fairly predictive. And we find that in this case, more concentration leads, I should say the other way around. More lenders means less refinancing, less amendments. It means you're more likely to get downgraded by credit rating agencies, and you're less likely to be upgraded by the bank regulators. And this is consistent evidence with the story of concentrating ownership rights and renegotiation having positive outcomes. So the other thing that we can do is we can ask, how does this change? How do these constraints change, or the number of lenders? Who is going to be actually in charge of the renegotiation, in the sense of like, who is the top owner? And you can see that when you get more and more concentration, it's actually going to be the non-banks that are taking over. So you get this concentration. The concentration is then driven by somehow the non-bank lenders coordinating that somebody in that space is taking over rather than what you would have expected, the lead bank being it is stronger when the lead is not the largest owner, so the non-banks coordinate. So I already got the voice from God, so I read up. So what we document here is that after regulatory downgrades banks and CLO exit, that does not necessarily imply an amplification of the shock as long as the other non-bank financial intermediaries are not financially constrained. However, if these unregulated institutional investors, and specifically mutual funds and hedge funds, are constrained, then this can have large effects. And then once these constraints hit all participants, we can actually have a systemic event. So if you step back and ask yourself about the worries that we had during the onset of the COVID-19 crisis, it's like, oh my God, do we have to renegotiate all these leveraged loan? Is this going to be a problem? And the answer is, well, maybe it's not, as long as the portfolios are mixed so far that the unregulated sector can still take over and help cure these loans. And I'm going to stop here. Thank you very much.
Okay, so thanks to the organizers for inviting us to present this paper. This is joint work with Mehdi Bayagi, who's at the Richmond Fed, and Cesare Fracassi at UT Austin. And so the main motivating observation for this paper is that across a wide variety of industries, market concentration has been rising over the years. So if you look at this black line, this is the share of total assets held by the largest 10 bank holding companies. And what you can see is that it started off around 35% in 1985 and is up to over 65% by 2015. And so this is something that's concerned regulators because we typically think that higher market concentration will lead to higher prices or higher deposit rates, higher loan rates for firms seeking funds. And because of this, the DOJ and other bank regulatory agencies like the FDIC will use measures of market concentration as important criteria to approve or block mergers. But what I'd argue is there's one kind of major difference between credit markets and typical product markets and even deposit markets. And that is these markets are often plagued by asymmetric information. And there's two kind of main forms of asymmetric information. It can be between the borrower and the lender, where the borrower knows more about their creditworthiness than the lender, or across lenders, where certain banks may know more about a firm than other banks. And the second form of asymmetric information is what we'll be focused on in this paper. And in fact, this form of asymmetric information can actually cause, in credit markets, higher market concentration can lead to lower prices. And the basic idea here is in this quote, but I'll just kind of give you the gist of it. If I'm a bank and a firm walks into my door looking for a loan, I'm going to be concerned that they were rejected by the other banks in town. And in fact, this problem can be exacerbated the more banks there are in the region. And here's another quote from Robert Marquez, who has a model kind of modeling this exact type of situation, where he says, focusing exclusively on the number of banks may not provide a very good indicator of the competitiveness of a market. Markets composed of many small banks may actually have higher expected interest rates in equilibrium than markets composed of a few large banks. So what I'd argue, because of these two forces, the relationship between market concentration and prices in credit markets is theoretically ambiguous, and I'd argue is ultimately an empirical question. Now, the problem with trying to test this is that if we take our standard measure of market power, which is just markup, which equals the price or interest rate in the case of a loan minus its marginal cost, while the interest rate is generally observable, the marginal cost is not. And so historically in the literature, what people have done is they analyze the interest rate and they control for observable characteristics and assume that any remaining difference in interest rates is a markup due to market power. Now, the problem with this approach is that banks may have private information about their loans. So if we look at two loans that have the same observables, but one has a higher interest rate, that may not be due to market power. It may be that loan is simply riskier, but we can't see it because we don't have access to banks' private information. And so this makes it very difficult to distinguish markups from risk without access to banks' private information. So what we'll do in this paper is analyze the relationship between markups and concentration in local corporate loan markets. And the key innovation is that we'll have a data set that will give us access to banks' private risk assessments that we'll incorporate into our estimate of the marginal cost of that loan. And I'll go into much more details of what exactly I mean by their private risk assessments when I get to the data. So let me just summarize our findings. So we're going to create a new measure of markup that controls for banks' private information, and we'll show that this measure of markup is orthogonal to the future performance of loans. Well, if you take kind of the classic approach where you don't control for banks' private information, we'll show you that this estimate of markup is contaminated and strongly predicts future loan performance. So with this new estimate of markup in hand, what we'll do is revisit this question on the relationship between markups and concentration. In fact, we'll find evidence more consistent with the adverse selection channel in that we find higher markups in regions with lower market concentration. Then what we'll do is provide some more evidence on the channel. So first we'll show that markups are higher for firms that are more susceptible to asymmetric information. So smaller firms, firms with fewer tangible assets, more highly levered firms. Then we'll also show that markups are higher when firms stay with their existing banks. This is the classic information holdup problem where if I'm a firm and I try to leave my bank, the other banks in the market will think that I'm a bad type and they'll raise the interest rate. And so this allows my existing bank to extract an information rent or markup from me when I stay with them. And then finally, if I have time, I'll talk about some aggregate evidence that we think is also consistent with the adverse selection channel. I'm going to skip the related literature for sake of time. Here's just a roadmap. So I'll start with our methodology and data. Then what I'll do is first I'll show you that these private risk assessments, they contain a substantial amount of information about the future performance of loans. Then what we'll do is estimate markup. Then we'll go back to this question on the relationship between markups and market concentration, and then I'll provide some evidence on the channel. Okay, so if we start with a simple interest rate decomposition, just the interest rate equals the marginal cost plus the markup, what we're going to do is first estimate the following first stage regressions. So the first we're going to call our baseline model, and this is just a predictive regression with the interest rate on the left-hand side. This is kind of the classic approach. X is a vector of loan characteristics. We have bank by time and industry by time fixed effects. Then we'll do the same in our risk-adjusted model. We'll include probability of default, loss given default, and their interaction. Then what we'll do is decompose the interest rate using these estimates from these two models into a predicted interest rate and a markup. And so we'll do that for both our baseline model and our risk-adjusted model. And so there's a kind of a key identifying assumption. If we want to call something a markup, this is kind of a key identifying assumption, and that is after we control for loan characteristics and banks' risk assessments, the variation in interest rates of loans given by the same bank in the same quarter should not be driven by the ex-ante riskiness of that loan. Because if it is driven by that risk, then that means we're picking up a component of the marginal cost of that loan, and it's not really a markup. And this is something we can directly test by regressing measures of ex post loan performance on these estimates of markup. So I want to note kind of one small limitation of our methodology. We're defining markup as a residual in a regression, so by definition it's mean zero. So all we can say is how markups vary across loans, not the overall level of markups. Okay, data. So we're going to use Federal Reserve Y14Q data on corporate loans over $1 million. And the Fed began collecting this data after the financial crisis to monitor banks and perform stress tests. And it's a very rich data set. It contains very detailed loan characteristics, loan performance, and firm financials. But perhaps most importantly for our analysis, it includes these internal bank risk assessments, so probability of default and loss given default. This is a quote from the instructions to the banks on how they should report these. Internal estimates of PD and LGD must incorporate all relevant material and available data, information, and methods. A bank may utilize internal data and data from external sources. So my interpretation of this is banks should really come up with their best estimates of these using any available resources that they have. So our data does not contain all loans in the U.S. It's only for U.S. bank holding companies with over $50 billion in assets. However, this contains the vast majority of assets and commercial and industrial loan volume in the U.S. banking sector. So this is a quarterly sample from the end of 2014 to close to the end of 2020. It's a panel, so we observe loans quarterly every quarter. But because we're interested in the markup at origination, we'll restrict the sample to new loans. And then we'll also remove publicly traded firms and syndicated loans, because these types of firms likely have broader geographic presence, and so the effects of local market concentration and information effects are likely to be limited. Okay, so we need a measure of market concentration. We're just going to calculate loan level HHI at both the MSA and county level. This is the sum of the squared annual market shares averaged over the sample period. And I want to mention, I think a lot of other papers looking at corporate loan market concentration will use deposit HHI just because of a lack of data. This data set is nice because we actually have the vast majority of these loans. So that's kind of a novel aspect of the paper. Here's some summary stats. The things I want to point out to you is that the median loan size is $2.5 million and the median firm assets are $20 million. So while these aren't, small business loans, these are fairly small corporate loans, where you might expect these types of information issues could be pertinent for these types of firms. The average interest rate is 3.5%, which amounts to about 200 basis points over the sample. The average PD is 1.36%. So let me just give some visualization of the data. This is what we've done here is place loans into interest rate buckets, and the y-axis is the average realized default rate in each of these buckets. What you can see is there seems to be a positive relationship between interest rate and realized default rates, although it might not be as strong as you expect. In fact, from the first bin to the second bin, it goes down a little bit. Now, if we do the same thing using probability of default bins, you see a much stronger positive relationship. And so what this suggests is, one, that PD contains information about future realized performance, which I'll show you formally in a second in regressions. But two, there may be some component of this interest rate that's not related to the underlying risk of the loan. And this is exactly what we want to exploit in this paper. Okay, so first let me show you that these risk assessments contain information about future performance. So we have non-performance and realized default as our main kind of measures of performance. Columns 1 and 3, we exclude the private risk assessments. But if you move from column 1 to 2, you can see that probability of default strongly predicts non-performance, and the R-squared goes up by about 2% in both cases. So what this suggests is that these private risk assessments do contain a substantial explanatory power for the performance of loans. Okay, now what I want to do is estimate. That was kind of a sanity check. Now what I want to do is estimate markup using the methodology that I showed you earlier. So right now we have interest rate as our dependent variable. The first column is our baseline model, where again we exclude private risk assessments. And you can see as you go from the first to the second column, all the risk the PD, LGD, and their interaction are all statistically significant, economically significant. They predict interest rate. Moreover, the R-squared increases by 3%. So just as these risk assessments can predict the performance of a loan, they also can predict they can explain a good portion of the interest rate as well. Now what I want to test this identifying assumption I mentioned earlier. So here we just have realized default as our dependent variable, and I want you to focus on column 2. So first what we're doing is we're taking this baseline markup, which was estimated without the private risk assessments, and seeing if that predicts default. And you can see it strongly does. So what this says is that this markup is not a markup, it's contaminated. It contains a component of the marginal cost of the loan. Now, if we move to column 3, to our risk-adjusted model, you can see that the markup does not predict the future performance of the loan, while the predicted interest rate does. And so what this suggests is that when we control for banks' private risk assessments, we can satisfy this identifying assumption that the markup is potentially orthogonal to the risk of the loan. So now that we have this markup in hand, hopefully I've convinced you that this is a markup, and now that we have this in hand, what I want to do is go back to this question on the relationship between markups and market concentration. And so here we have our risk-adjusted markup as a dependent variable, and we have MSA level and county level HHI. And what you can see is that if you go from a HHI from 0 to 1, the markup drops by 15 basis points. And this is fairly large compared to an average credit spread of 200 basis points over the sample. Now, if we add in firm level independent variables, the signs of these coefficients seem consistent with the adverse selection channel. So larger firms face smaller markups, more highly levered firms face higher markups, firms with more tangible assets face lower markups. So this is some preliminary evidence on that this is being driven by the adverse selection channel, that the markups are driven by adverse selection. Okay, so now, but I want to give you a bit more evidence on this channel. So what we're going to do is analyze the relationship between markups and the firm's decision to switch banks. And this is, again, is the classic information holdup problem where firms face higher markups if they stay with their existing banks. And this is a common result in models of adverse selection. And the intuition is if a firm switches, other banks assume they were rejected because they are low quality. This allows banks to raise rates on existing borrowers. And this effect should be larger for markets with more banks because the adverse selection problem is more severe. And so what we'll do here is restrict the analysis to firms with multiple loans in the sample. And then we'll use MSA and county by quarter fixed effects to analyze the cross-section of loans within a region at a given point in time.
5 minutes.
Okay, great. So what you can see here is this, we have risk-adjusted markup as our dependent variable. Stay bank is a dummy that equals 1 if the firm stays with their existing bank. And what you can see is that when firms stay with their existing bank, they face a higher markup of between 9 to 18 basis points across these different specifications. And this is consistent with the adverse selection channel. Also, interestingly, if you look at column 3, what we're doing here is interacting stay bank with the MSA HHI, and you can see that the more concentrated the market is, this seems to mitigate this effect, which is exactly what theory would predict, because the fewer banks there are, the less severe this adverse selection problem is, and the lower the information rents that banks can extract from their existing borrowers. Okay, I guess I have enough time to cover this, but we want to take a couple more tests to the data. So we build off this Dellaricchia and Marquez model that predicts that when new borrowers of unknown quality enter a market, this mitigates the adverse selection problem and leads to higher loan volume, less collateralization. Collateralization can be a form of screening, at least that's how they model it, and lower markups. Unfortunately, we cannot observe new borrowers because we have too short a sample. We don't know if a firm borrowed 10 years before we see them in the sample. So what we do is we aggregate markups, loan volume, and collateralization at the county and MSA quarter level, and then we analyze the correlations between these aggregate variables and see if they're consistent with the theory. And what you can see is that when the average MSA or county level markup is higher, we see that total loan volume in that quarter is lower, and the degree of collateralization is higher. And we'd argue this is consistent with the adverse selection channel. I guess I finished much earlier than I expected, but I guess that maybe that's to the benefit of everyone else. But just to conclude, in this paper, we find that in corporate loan markets, higher local market concentration is associated with lower markups. And this is kind of in stark contrast with the way we typically think about the relationship between market concentration and markups. And the key innovation of the paper is we use data on banks' private risk assessments so we can actually control for the risk of the loan and not be concerned that we're missing some component of risk that is unobservable to the econometrician. And overall, what I'd argue is that our evidence is consistent with adverse selection driving markups, lending standards, and lending volumes in these local corporate loan markets. And finally, just to go back to the initial motivation of the paper, there's a macro literature documenting this rising concentration in the US, And while our results aren't causal, I think this could perhaps point to an upside of higher concentration in banking markets, and that this can actually reduce markups in these markets by reducing the adverse selection problem. Okay, thank you.
Wow. So thank you so much for Thank you so much for inviting me to discuss these papers, and it's a great pleasure to be here. Now I've really struggled to figure out how to switch and control the slides. I am so sorry. So
There are two carrots on the left-hand side of the slide. If you hover over the slide, you'll see a number 65 with a little up arrow and a down arrow. And you can use the down arrow.
okay, got it. See, thank you. So it's a great pleasure to be here and discuss these papers. And as the last author mentioned, this debate about the concentration of lenders in the market is really important. It's important because our prior goes that it's great to have more competition in the market. But recently we see this dramatic concentration of market share of the largest lenders going from 35% in early 90s to 70-some% recently. And the concentration of lenders is super important in both functions in the banking system, both in the screening function and the monitoring function. In a screening function at the point of loan origination, we know that increased lender competition is great for the markets. It's more competitive credit markets lead to more efficient credit allocation, lower prices, higher credit availability, more formation of a new business. And I actually tried to put together all the literature related to this, but it ended up to be fruitless exercise because the number of papers attacking these issues is just vast. And if I did not put anyone in the audience paper on the slides, I profusely apologize, right? But there is also bad side of the lending concentration because competition can harm lending relationship formations and reduce the incentive of the lenders to collect soft information about the borrowers, hence reduce credit availability and increase prices. We also know that the high lender competition actually can lead to ugly results with bubble formation and formation of booms and busts and variety of asset pricing, and specifically there is quite a bit of literature in the real estate. The lender concentration and competition also quite important in the monitoring role of banks, and that's what Ralph's paper kind of attacking. There is the good side is that the more lenders we see in the syndicate, we see more information sharing, we see risk sharing, we see reduction in monitoring costs. But the bad side of this comes in at the back end of the lending equation in inefficient renegotiations, right? Where we're going to have conflicting incentives because we have different lenders with different contracts. Even when you have lenders with the same contracts, there is coordination problems. And even if you can try to solve those, there are free rider problems in there. So hence, it's really great to have an opportunity to talk about three papers that are actually talking about the adverse effect of banking competition and kind of the benefits, potential benefits of lender concentration on borrowers. Right, and I'm going to split them into these two groups, or two papers actually attacking this relationship more on screening and origination side of things, and Ralph's paper is talking about ex post monitoring and renegotiations. So I'd like to start my discussion by talking about the last paper. Yes, it fits into that literature probably very nicely, and empirically, that's probably why my eye got attracted to it. So in the paper that Greg presented, we kind of reminded about the benefits of the lending concentration, where under adverse selection, the competition can actually harm this lending relationship formation and the willingness of the lender to collect soft information, and hence we should see higher prices, right? And that is exactly what the paper documents. What the paper documents is that loan prices are actually higher, the markups are actually higher in less competitive lending markets, and we do see that the holdup problems are less when you have less severe competition, because presumably other lenders are willing to invest into soft information collection. So what this paper relies on is the data from Y14. So it's a very extensive, very interesting data set that covers about 70% of all bank lending in the U.S. It has extensive information about borrower and borrower characteristics, and that actually combined with internal risk assessment from the banks about the borrower allows the authors to estimate loan markups. And the great thing that they do in the paper is that they show that these loan markups are actually orthogonal to exposed borrower performance, right? So this is less about risk-driven. It's just the ability of the lenders to generate the markup. And the core result that I just want to show you a couple of core results is that market concentration actually does affect is correlated with loan markups, right? So the dependent variable here is the markup, and the authors are showing that as the lender concentration increases, so as you have higher in Herfindahl, fewer and fewer lenders in a given market, we see that the pricing of the loan goes down, so there is potentially more soft information production happening, and the lenders don't have to price in that artificial risk into the pricing of the loan. The authors also show that under higher concentration in the market, so less competitive markets actually see a much weaker hold-up problem, right? So it's just easier for the borrowers to switch to the alternative lender. So I do have a few questions for the authors. One is the hated one, which is probably obvious, is the relationship causal? And yes, Greg admitted that it's not causal, which is fine. I actually think that we need to expand our view to just causal relationship to start thinking about more equilibrium conditions. I just really would love to see the authors to align their language in a paper with their view of the situation. Is it causal, or is it kind of set of equilibrium conditions, and abstain from statements such as whether the market concentration drives markup? But more interesting question is, if we're thinking about this as an information problem and for selection problem, who benefits more from this banking competition? I really would love to encourage these authors to take this paper to the next step and start thinking about, are all borrowers created equal? Do we see some kind of segmentation in the lending markets? And how does it affect? Does it have any real effects essentially there? So this question is actually very nicely this kind of issue about the whether all borrowers are created equal is very nicely addressed in Zhang and Ganelli's paper, Competition and Selection in Credit Markets. This paper is actually looking at the auto loan market, as Anthony presented, and so, essentially documents that higher lending competition is associated with lower cost of credit for low-risk consumers, but higher cost of credit for high-risk consumers. And they conclude that increased competition may decrease rather than increase consumer welfare in subprime credit markets. And I highlighted that word welfare because I'm going to come back to that in a second. So what this paper relies on is on auto loans. This is a hot information-driven market, and they use essentially the TransUnion Consumer Credit Panel data, and they infer the interest rate, and again, they have quite a bit of information about the borrower characteristics. And what do they have in their mind is that for screening all these loans, there is some kind of information production technology that operates behind the scenes, such as GPS technology on cars, or AI and machine learning, predictive analytics, or some kind of a vehicle quality verification services. But essentially, this is, in their mind, it's a big fixed cost investment that banks have to make, and it's so much easier to spread this fixed cost among the large number of borrowers rather than the small number of borrowers, right? So they're also exogenized local banking competition by using bank mergers. Local lender competition, I apologize, that's a misstatement. Local lender competition using bank mergers. So they use about 1,500 bank mergers covering about 1,800 counties. So we can argue whether bank mergers are endogenous or exogenous, but relative to the market they're exploring, I would actually tend to agree that it's a fairly nice shot, because not all the auto loan lenders are actually banks. So the most striking results that the authors showed you, and Anthony showed a couple of times, and it's fascinating, and I'm really fascinated by it, is that if you look at the prices of the credit among the low-risk borrowers, which is on your right-hand side, and high-risk borrowers with credit scores below 600, you see a very different relationship between the market, the lender concentration or lender competition, and the markups. So when the markets are competitive and you're close to the zero on the horizontal axis, you see that low-risk borrowers are actually getting higher prices, and lower prices, and high-risk borrowers are getting higher prices. So effectively, this subprime borrowers on the left-hand side graph are actually benefiting from more concentration of lenders in the market. And again, the argument that in the model, the core mechanism in the model in the background is that when there are fewer lenders in the market, they have much more incentive to invest into the fixed cost screening technology and spread it among the larger number of borrowers they can get access to, and they don't really have to compete for. But if you look at the second graph, right, now the question arises. Because if I've in a fairly concentrated market, I'm a lender in a fairly concentrated market, and I invested in the screening technology, and I have this advantage of lending to a high-risk borrower because I can assess them better, I should probably lend to those borrowers. But what we see in this graph is that most of the borrowers that lenders lend in highly concentrated markets actually have high FICO scores. You can actually look at it in a regression setting as well. And looking at it, again, I just highlighted the two coefficients. It seems that the lenders in less competitive markets, or lenders in high HHI markets, kind of undersupply credit to those riskier borrowers, right? There is a much steeper kind of a supply curve. Anthony showed this graph as well. This captures the delinquency rate in competition. Again, there is a delinquency rate on the vertical axis and the competition on the horizontal axis. And yes, the direction is very much consistent with the model that they presented, but we can interpret this graph slightly differently. We can actually interpret this graph as the lenders in less competitive markets are actually undersupplying credit to borrowers with credit scores below 600. Right. Notably, I just want to attract your attention that the vertical axis on those two graphs is very much different, with the axis on the left-hand side having about 10 times the magnitude than the axis on the right-hand side. So what I can interpret this graph is just this borrowers with credit scores below 600 are actually not getting enough credit in these markets. Maybe they're screened out, okay, but they're just not getting enough credit. So to combine, what we see is these high-risk consumers enjoy lower credit prices in less competitive markets, but actually face tighter credit constraint in those less competitive markets, potentially because there is more investment in credit technology, and hence they're screened out more. But then if the question is, what is the net effect on consumer welfare? So from the consumer welfare perspective, lower prices versus lower credit availability, how do we think about this? If we're thinking about a subprime borrower in need of a car, are they better served by a lower price, or are they better served by actually having credit available so that they can drive to the job? So I also am struggling to reconcile this undersupply of credit with the lender's incentive to spread the cost of the lending technology across more borrowers, right? So that's another question that I would like the authors to think about. Then I can also really would like to call on the authors to help me understand how the empirical approach matches the theoretical prediction, because the core mechanism behind the effect in the background is that sharing this large fixed cost of screening of the information technology to produce soft information across larger number of borrowers actually reduces the cost of debt, right? Because I can screen the borrowers better and I can price the cost better if I have this information technology, but I'm only have an incentive to invest in it if I know that I can access a large number of borrowers in the market. And the model kind of assumes the closed economy. An empirical approach, I'm not sure meets this, because in the empirical approach, the authors are using this local county-level auto loan lending competition measure, or HHI index, but lenders can actually spread the cost of information technology across all the markets they operate in. So maybe we can think about different measures of competition. For example, lender size might be a nice measure to capture the ability of the lender to spread the cost of the information technology across variety of borrowers. So that's really, I'm curious how the authors match this kind of their empirical approach and the theoretical prediction here. So last but not least, a couple of questions that I have, that it would be nice to actually still validate whether there are differences in pools of borrowers in high and low HHI markets. So this just helps to validate their approach a little bit so that there is not much of a endogeneity correlation there. And a market's experiencing new entry or mergers unique to terms of borrower characteristics. I would consider those two questions really minor, just to validate their empirical approach in terms of exogenous shock. So last but not least, I'd like to talk about the paper Ralph presented, Ownership Concentration and Performance of Deteriorating Syndicated Loans. As I mentioned earlier, this paper talks less about kind of this role of lender concentration at the origination and screening stage, and talks more about the role of lender concentration at the monitoring stage of the loan life. And this paper looks into the syndicated loan markets, and at the origination point, we see a lot of benefits of broader set of lenders coming in, and information sharing and risk sharing, and alternative access to alternative sources of finance, but exposed renegotiations in this setting where you have a lot of different high diversity of lenders having a stake in a loan, fraught with a ton of information frictions, require quite a bit of soft information production, and lenders face this free rider and variety of coordination problems. So what does this paper document? So they actually address and document the adverse effect of the very diverse investor base at the stage of loan renegotiations. The downgraded syndicated loans held by more diverse syndicates are actually less likely to be renegotiated and more likely to be further downgraded, which is evidence in favor of this kind of information problems that exist at the renegotiation stage. In response to these downgrades, banks actually sell their shares in deteriorating assets, and ownership concentration increases, and mutual funds and hedge funds kind of increase their ownership and pick up the stakes that banks are willing to sell. So the core evidence presented to support these claims is essentially in this table 9. The authors are showing that as the number of lenders increases, so with the large number of lenders, loans that are downgraded are less likely to be refinanced, less likely to be amended, more likely to be downgraded, and the notches to be downgraded, it's actually higher than for other loans controlling for a variety of loan characteristics. And again, nicely enough, they have this fairly nice strategy to deal with endogeneity of the lender concentration and the need for the lenders to sell, right? Once the loan is downgraded, we see a decline in the number of lenders in the syndicate, right, or in the consortium, number of investors. And what happens is that banks and CLOs are reducing their stakes in those loans, but mutual funds are increasing their stakes in the loans. So what are my comments? So I really would like to understand better what is the cornerstone of the paper. Is it performance of renegotiations, and which is relegated to table 10, and thinking about that loans with higher ownership is actually leads to lower rate of renegotiations and a higher rate of further downgrades, or is this kind of the change in ownership structure? Admittedly, those two things kind of live together. And what makes this paper very, very nice is that while there are some other papers, prior papers, that actually address the first question of whether the higher lender concentration is beneficial for loan renegotiations, this paper actually talks of whether the lenders are reacting to the need to concentrate the ownership in order to make renegotiations more efficient, better, and quicker. But if that second part is the core questions, why are banks selling, and why are banks and CLOs selling? So the author's argument is that regulatory pressures, right? But it does not explain CLOs, and that does not fully explain Figure 3. So I was just wondering if this can be empirically tested further, for example, by exploiting banks' capital constraints. The other question that comes into the picture automatically is like, one is, why are banks selling? The second question is, why are mutual funds buying? Because they're buying right before the need to renegotiate. So are they better renegotiators? Are they better at producing soft information? What makes them better at this? Are they just opportunists? But if they're opportunists, then why are they concentrating their ownership? They still need to renegotiate. So does it mean that mutual funds have fewer coordination and information frictions between them so that they can be more effective in renegotiating contracts? So bottom line, I think that these three papers actually adding more light in thinking about what does the banking competition, or the opposite side of it, the lender concentration, what positive effect the lender concentration might have on borrowers, either on the screening stage of the lending equation, on the monitoring stage of the lending equation. And these are the considerations the regulators need to take into account when we're thinking about whether we should continue deregulating markets and be very much concerned about top 10 banks holding 70% of the market share in business lending, or should we not be so concerned about this? So thank you very much for giving me this opportunity to read these three great papers. I really applaud the authors for work great done. I hope my comments would be useful to them.
Thank you very much. We'll give the authors, if you are interested, very quick response. Try and take, just a minute or two at most. We do have a question in the Q&A that I'll ask on behalf of the questioner. Attendees, you can raise your hand using the raise hand feature, or put a question in Q&A for the presenters. If we don't get to all the questions, we will share them with the presenters afterward. Presenters, why don't you go in the order of the presentation to give responses?
Okay, I guess I'll go first. So thanks a lot, Elena. That's very useful points. We have something in the paper dealing a bit with the size point. So sort of we show that the effect seems to be larger for small lenders, which you would expect. Because of the fact that if you're small, your fixed costs are more likely to be basically based on sort of more related to HHIs in the local market that you're operating in. However, the effect is still positive, but smaller in magnitude for the large lenders. For the mix shift point, that's an interesting point. I don't have a great response on that. Sorry, for the point basically that this seems to be associated with a credit reduction to sort of the very low credit score people, even in sort of both in the high and low credit score groups. That's an interesting point. We have to think more about that. So I don't have a great response to that. But thanks a lot for pointing that out, as we should definitely think about that. Yeah.
Yeah. So also thank you for the comments. Let me just point out that the bank capital constraints side of the paper with Jose Luis, Vash Iyer, and Vas Ivani, where we document this that banks with capital shortfalls sell. So I don't think we need to rehash that. Similarly, there's at least 3 papers that I'm aware of that show that the collateral constraints of CLOs start binding when you get these downgrades. So I think that that point has been addressed in the literature. So we are more focused on the renegotiation part. But you're absolutely right. What's about mutual funds? That's something that we need to investigate further, and we have to be more clear about. So thank you again.
Yeah, thanks for a great discussion. I agree. I think we need to be more careful about our language in the paper about calling things causal. It's definitely not causal. And I think your point about exploring, which borrowers benefit from the higher concentration, I think that's a really good idea. And I know we're talking to you later, so we'll probably get more from you on that. But thank you for a great discussion.
Excellent. We have a question in the Q&A for Anthony. The question reads, it would seem to me that the decision of a lender to invest in screening technology with high fixed costs would relate to the lender's overall size rather than concentration in one or more local markets. HHI is a measure at a local market level. Can you explain why local concentration would matter more than overall size?
Thanks for the question. So I think this is a bit related to Elena's point. The way we think about this is that sort of we do a robustness check where we check basically the association of interest rates with with concentration interacted with the size of the lender, right? And so the idea is exactly as you say, sort of HHI is not a perfect measure of screening incentives. It should be better if you are a small lender and you're active only in a couple of markets. Your screening decisions should be made more at a local level, right? What we find is that the relationship between rates and concentration is more negative, implying the screening channel is bigger for these small lenders, right? As you might expect, that the large lenders' screening decisions should be less sensitive to local concentration. So we at least have some evidence that sort of the size effects you're thinking about are at work here. Now, there's, of course, the question of if size is the right measure, why not just regress on size? And I guess this is kind of a methodological point that size is even more endogenous than concentration. And sort of, I guess we couldn't find a good way to kind of find the overall market size effect on screening without confounding with sort of many other things that affect size. And then so that's sort of methodologically why we sort of analyze concentration rather than trying to basically sort of distinguish a kind of size effect on lenders screening. But we're still thinking about that. We got that point a lot, and then maybe there's a good way to do that analysis that we haven't thought of yet, if that kind of makes sense. Yeah.
Great. I think we have time for one more question. I see Troy's hand is raised, and then we'll put some of the other questions that have been received in the chat and the Q&A to share with the authors later.
Thanks. Ralph, this one's for you. You displayed the stacked bar chart where it showed the share of ownership by different entities. And what I saw was that banks' ownership share actually increased in the loss section relative to doubtful. It was kind of declining all the way down, and then it peaks back up, so a U-shape. What's going on there? Is it just that the banks are unable to unload the loss loans, or is there something else perhaps?
Well, so my off-the-cuff response is that there aren't that many lost loans, and one truth is there are smaller loans that are typically held by more banks. So there's still term loan A's in there that are usually held almost exclusively by banks, and it could well be that in a small sample there's relatively more of those in the loss category, and then it could. I don't think there's anything deep going on, to be quite honest, in that one. It's just a size issue. We don't have that many lost loans because banks charge them off and then they drop off the sample.
All right. I think with that, we should probably conclude. I want to thank all of the presenters and our discussants for a wonderful session. And we encourage everyone to join us in virtual reception room A at the end of the day, if you're available, to have a little bit more of an informal conversation. Thank you very much, and see you back here hopefully in 10 minutes.
Everyone. This second session of the day is titled Bank Risk and Regulation. We have three very important and interesting papers, And the first one is titled A Q Theory of Banks. Saki Biggio is going to present. So, Saki, go ahead.
Saki, you have presenter roles now.
Turn on the video. My slides are loading. Almost there. Okay, perfect. So can everyone see my slides?
Yes, sir.
Perfect. So this is called Q Theory of Banks. It's joint with Juliane Begenau, Matthias Viera, and Jeremy Majerovitz. So the overall theme of the paper is to study what are the relevant constraints for banks. All of us in this paper, all the authors are interested in banking theory. And in the past, when we've tried to calibrate our models of financial regulation or banking in general, we face the problem of not knowing really what is the relevant set of constraints for banks. In particular, when we look at banking models, there seems to be two groups of papers. Some of those look at regulation from a policy standpoint, and they say, well, banks face regulatory constraints and that limits their leverage. And, other theories, and more on the theoretical front, say, well, you know what? It's really markets that impose constraints on leverage based on the value of the bank. And when it comes to looking at the data, the behavior of bank equity and market equity and book equity look very different. So really, we're unaware of what was the right way of modeling the constraints on banks. So what we're going to do in the paper is start by showing you 4 facts about Tobin Q. Tobin Q is a relevant measure. It's a unifying theme because it's the ratio of market to book. And we're going to make statements about what's the right way of thinking about the constraints of bank leverage. And we're going to say, actually, both can matter, market and book equity, but market equity reacts with a lag. And the reason for that, reacts to a lag with respect to losses, is that that accounting rules make book values very slow to respond. And so we're going to have a model later that incorporates that feature. So our theory is going to say the following. Banks are going to face a trade-off between levering their returns by increasing their leverage and exposing the bank to greater bankruptcy risk. The bankruptcy risk comes from the possibility of loan defaults, and the bankruptcy can be triggered by either a violation of regulatory constraints or market-based constraints. But the key feature of the paper is that whenever there's a loss that doesn't bankrupt the bank, in the books is going to be recognized with some delay. And market values will immediately incorporate the information on on the loan losses, whereas book values will take time to recognize those losses. And as a result, banks can, after suffering a particular loss, they can, sustain greater market leverage, whereas their book leverage will not move because it's not recognizing losses. And we're going to take this model to the data by estimating parameters, and we're going to run some counterfactuals related to the idea that there are different accounting rules that would, speed up or slow down the recognition of loan losses. So let me go straight to the facts. I'm going to fly over the 4 facts because most of you know them. The contribution of the paper is to put them together in a unifying framework, but these are known facts. So just to set the stage, just let me tell you that Tobin Q can be expressed in 3 ways. First, Tobin Q can be the ratio of market equity to book equity. And if we divide the numerator and denominator by liabilities, we will obtain also a representation in terms of market leverage and book leverage. But we can also decompose, and this is going to be the theme of the paper, the behavior of Tobin's Q into 2 ratios, the product of 2 ratios, what we call, the numerator market equity, which is observable, relative to a fundamental notion of equity. So the fundamental notion of equity is something that we don't observe as econometricians. It represents the difference between what the resources in the bank are relative to the market valuation of those resources, even though we don't observe those resources. And then we have another ratio, which is fundamental equity to book equity. So book equity is anything that is counted in the books. Fundamental equity and book equity will differ in this model as a result of the fact that book equity is not recognizing immediately all the losses in the bank. So there's going to be 2 sources of variation in Tobin Q. One can be associated with how investors over time price the fundamental resources inside the bank. This could move because of risk premia. And then the second source, which we're going to say is important, it has to do with the fact that banks are not recognizing losses. So there's a component that has to do with zombie loans that are really worthless inside the bank. So taking these concepts into consideration, we can plot Tobin's Q over time over the last 3 decades in the United States, and we can see that there's quite a lot of movement in Tobin's Q. But importantly, much of the action is coming from changes in market valuations, not so much from book valuations. If you look at book valuations on the right panel, if you look at the trend of the blue and the red line, depending on how you measure it, you really see little action on book equity, for example, in the middle of the Great Recession, whereas market values really tanked. And part of the fact that book equity didn't fall is that much is that banks raised some amount of equity, but just look at the differences; they're really dramatic. And for some banks, this is the differences can be up to 10 to 1, in particular for banks among the Big Four. Another question you could ask is, well, maybe market-based equity is just capturing that in periods such as the Great Recession, really markets were very anxious and they were, really commanding a very high premium. And there's nothing fundamental about variations in Tobin Q. But that turns out not to be the case if we look at the cross-section of Tobin Q. If you look at the cross-section of Tobin Q today, Tobin Q predicts what will happen with the bank, in terms of provisions, charge-offs, net rate of return going forward. So in this picture, what we're doing is plotting Tobin Q today in the x-axis against different variables that have to do with bank performance in the future, in particular charge-off rates. And so banks that suffer biggest losses in their market valuation tend to have greater charge-off rates going forward, and same thing with provisions. Now, why does this matter for the question in hand? Well, as people interested in the solvency of the banking system, we care about, leverage. But if we model leverage based on book values or market values, we're going to find this very big discrepancy in the book and market valuations. In particular, if you look at market leverage in the middle of the crisis, it just increases dramatically for the whole of the banking system, whereas book leverage drops. We can look also what's happening within the cross section, and this is what I'm plotting here. These are the different percentiles of market or quantiles of market leverage. And notice that the scale on the y-axis is a log scale. So what this is saying is that in the middle of the Great Recession, you have banks whose, a non-negligible fraction of banks whose market leverage just blows up to values of around 80, which is incredibly high. And this pattern is actually inconsistent with models where you would have a constraint based on market values, so a constraint imposed by markets, something that would appear, for example, in the work of Gerther and Kiyotaki that would tell you, well, there's a common roof for market leverage across banks. So, in periods where banks suffer losses, you should see, bunching at that roof. Every bank, or on the banks with the highest leverage would hit that ceiling and would have to reallocate assets. But that's not what we see in the data. When we turn to book valuations, I'm plotting here the percentiles. They're really stable if you look at the quantiles. And if you look at how many banks are really violating constraints, yes, I mean, there's a little bit of action going on during the Great Recession. It actually, if you stare at this plot, the stress comes later in the after 2008, nearly peaking at late 2009, right after we recognized that banks were suffering losses. But if you look at this plot, and details are in the paper, the fraction of banks that were under stress is just small. So the fraction of banks that are violating their tier 1 capital ratios is just a small fraction of the banking system. And finally, the final fact, this is more novel in the paper, is interested in asking, whether bank losses and how did banks react to losses. And so here the challenge is, because we don't observe immediate losses, that's the claim that we're making, because books don't recognize losses immediately, there's predictability. We don't have an immediate way to look at bank losses just looking at book values. Now, we could look at market values, but the problem with market values is that there are confounding effects that have to do with risk premia. So the way we're going to do things is to find a proxy for bank losses, which I'll describe in a second. These are these epsilon shocks. And what I'm going to show you next is a regression where this is like a local projection, where I'm showing you a variable of interest and how it changes vis-a-vis these shocks for past losses. So this is going to construct an impulse response to past losses on different variables. What's going to be our proxy? The proxy for us for bank losses is going to build on the efficient market hypothesis. So we're going to say we're going to construct Framma-French factors, and we're going to say once we control for different time series and bank-specific loadings, sector-specific loadings, we can construct deviations of rates of return of a given bank given the risk-free rate. And once we construct the deviations, we're going to say, well, if there was a deviation among a particular bank, that deviation was probably capturing an idiosyncratic shock to the net worth of the bank, or the bank fundamental equity, the unobservable in our first slide. And so the pattern that emerges from this picture is that, of course, whenever you have a loss, the market values will recognize immediately the loss. So Tobin's Q will drop, and there's convergence back. So that means that after the loss, book values are recovering. How is that that process come about? So if you look at market leverage, for example, it mechanically jumps 1-for-1 with a loss, because that's the shock we're measuring. But notice on the very right panel that book equity, which should, if book values were capturing exactly what market values are capturing in the cross-section, these are cross-sectional impulse responses, you should see an immediate drop in book values. Book values react, but they take time to react. So that's why we say, books recognize fundamental losses only slowly with time. How does the deleveraging process come about? Well, whenever there's a loss, banks do reduce their liabilities. That's what you see in this left panel, but they do so only very slowly. They don't touch their equity that much. If they do something on the equity front, they may actually increase dividends slightly after a loss. So all of the action comes from in leverage comes from a reduction in liabilities. So to summarize the facts, we believe that book values don't recognize losses immediately. Whenever there's fundamental losses not recognized in the books, mechanically market values absorb the information. The market values drop, market leverage increases, and banks slowly delever by reducing their liabilities, so selling assets, and at the same time their book equity recognizes those losses over time. So we're going to say this is we're going to say this is important, and we're going to construct a model with the following features. So we're going to write a model which has a cross-section of banks. It's in partial equilibrium, so interest rates are given. There's assets on the loans on the asset side that are risky, and liabilities are composed of equity and risk-free deposits. There's no equity injections, and the important feature is that we're going to have those three differences in accounting values. So fundamental values, accounting values, and market values. And as I said, banks are going to be liquidated if they violate either market-based constraints or book-based constraints. The key feature of the model is that not all loan losses are recognized immediately. So the balance sheet of a bank is given by loans, deposits, and equity, and they have a leverage choice in every period. But importantly, whenever there's a default, and I'm just going to show you a balance sheet, whenever there's a default, and the default is captured by a term like a Poisson shock, the bank will have a book-based balance sheet, which is given by these assets, book liabilities, and book equity. But markets will recognize that a part of that balance sheet is given by zombie assets. So the idea is that a fraction of the total equity inside the bank is really things that are in the books, but they'll never pay off. These are loans that will never pay off. And so the ratio of total equity to the fraction of those loans that are worthless is this little z. So I'm going to tell you how the paper or how the model works just by giving you one picture. So the behavior of the model is the following. So in the model, both the ratio of zombie loans to equity and leverage are state variables. And there's a region captured by this green line that tells us that if the bank surpasses this region, so for any given amount of zombie loans, leverage is above this region, the bank is liquidated. Why do we see this green line? Well, regulation puts a tough constraint on leverage. It says if leverage in the books is above a certain value, the bank has to be intervened. But the right notion for markets and for bankers is fundamental leverage. The ratio of their fundamental equity relative to their total liabilities. Now, if the bank has a lot of zombie loans, that means that regulators are seeing a lot of good assets in the balance sheet, meaning that they see a lot of good equity, or solid equity in the balance sheet. So whenever, for a given level of zombie loans, whenever they enter this region, they're violating the constraints. So what happens in the model is that banks maintain a buffer below that liquidation region. And whenever there's a shock that is immediately recognized, they jump straight to the point at the violation constraint and immediately will do something to delever. And they slowly delever over time as their past losses are recognized. So their zombie loans reduce over time just as a result of loan delayed recognition. Whenever there's unrecognized losses, they jump to another point, and the ratio of zombie loans increases. The reason being that whenever there's a loss that is not recognized in the books, what that means is that the stock of zombie loans relative to total equity is higher. But the same logic operates. They do something to delever, and slowly over time, they reduce their liabilities as they are recognizing losses slowly over time, past losses over time. So that's the behavior of the model. And what we do in the paper is we estimate the model, we calibrate the model on certain parts, and we deliver on all four facts. So we deliver the time series discrepancy between market values and book values. The model and in the data have predictability on future losses. We deliver on the cross-section of dispersion on market values, and we reproduce the impulse responses of the cross-section. The latter part of the book, of the paper, finishes by saying, well, there's a parameter that captures the speed of loan recognition, loss recognition, and the speed of loss recognition determines how much fundamental leverage there is. The slower the books are in recognizing losses, so alpha is the speed of loan recognition, a smaller alpha means slower loss recognition, the higher the fundamental leverage will be, because banks over time are accumulating past losses which reduce their past equity, but they don't have to adjust their liabilities when they have zombie loans. So a world in which losses are not recognized immediately is one where fundamental leverage is going to be higher, and so that puts the economy under some stress, but at the same time it comes with certain advantages. So to wrap up, the advantage is that when a shock comes, banks don't have to delever as quickly when they don't have to recognize losses immediately. So to wrap up, we present the model with four style facts on bank and book leverage differences, and these are rationalized with slow loss recognition.
Okay, well, thank you, Saki. Let's move to the second paper. It's titled Population Aging and Bank Risk Taking, and Sebastian Dorr from the Bank for International Settlements will present.
Okay, can you hear me?
Yeah. Yes.
Okay, very good. Okay, so good evening from Switzerland at this point. This is joint work with Gazi Kabas and Stephen Longina from the University of Zurich, and just Gazi is in the market this year, so in case anybody out there is hiring, make sure to have a look at his profile. He has great stuff. So the starting point of this paper is what you see here. Over the next decade, and actually decades, there will be a drastic increase in the number of seniors, so population age 65 and older. This is for the US, but actually similar developments are happening in most advanced economies and increasingly also in emerging markets. So our starting point is, how does population aging affect credit supply and risk taking, and ultimately risk the financial system? And so we think about this from different angles. So on the one hand, one major driver of the savings glut and low interest rates is demographic change, reflecting that seniors have higher savings. I'll show you more on this a little later. And there is evidence out there that low interest rates could encourage risk-taking by banks. At the same time, an aging population could also affect investment opportunities. My grandpa, for example, no longer really needs credit. So there might be a drop in the demand for credit as populations age. And this is why there's this ongoing discussion on how aging will affect the financial sector and the real economy. And so the way we contribute to this discussion is in basically 3 steps in this paper. So in the first step, we look at the relation between population aging and bank deposits. And the key observation here is that seniors save more in the form of deposits. In the second step, we ask, well, do banks with branches in aging counties, so those which are subject to deposit inflows, actually adjust their supply of credit? And if so, where? And the reason is that, there's deposit inflows, but also changes in the demand of credit that could affect the geography of bank lending, especially in no-branch counties. And after step 1 and 2, in the final step, we look at the effects for bank risk-taking and financial stability, we look at loan-to-income ratios, the share of denied loans, and ultimately also non-performing loans during a downturn. So the setting of our paper is what you see here, so basically the US. And what we exploit is the extensive variation in aging that already has occurred across US counties. So this map shows you the change in the population of age 65 and above from 97 to 2007. And as you can see, there's, tremendous variation across counties and regions. Now, the reason why we focus on this time period, two key reasons. The first one is that regulation was arguably quite light at the time, so this helps us in identifying the effects we're after. And the second reason is that we have the Great Recession in the aftermath, so we can actually test whether risk-taking, manifested itself in higher losses during a downturn. In terms of deposits, our main finding is that an increase in the number of seniors in a county has a positive effect on local bank deposits. So to give you a number, a 33% increase in the number of seniors in a given county increases deposits in branches in that county by around 25%. So where's this 33% increase coming from? Well, this is about what we expect and the number of seniors to increase in aggregate over the next decade. And again, this reflects that seniors, so that the finding here reflects that seniors have higher wealth in the form of deposits. I'll show you a bit of evidence today, and there's more in the paper, that this finding is robust to different bank and county controls, bank fixed effects, and an IV strategy, but I'll get there a little later. We also find that the increase in deposits leads to an increase in total liabilities, so there's no substitution. Why does this matter? Well, in principle, an inflow of deposits could be offset by reduction in other liabilities, but this does not seem to be the case. Is there a takeaway from the first part? Aging increases deposits of banks. The second step, we look at banks and their exposure to aging counties. So basically they have branches, and in these counties where they have branches, population aging, and banks are differentially exposed with this trend in aging. And so what we find is that more exposed banks increase their mortgage lending, so they kind of pass on the funding shock towards the lending side. And in a similar exercise, a 33% increase in exposure leads to an increase in lending by around 20%. I remember there's a 10-year horizon, right? That's where the numbers look quite large. And the increase in lending is especially pronounced in counties where banks have no branch. And, if you think this through again, if population aging leads to local contraction in the demand for credit, then banks have to put their money somewhere else, which is precisely what we find. They put it where they have no branch. That's where they're expanding. And arguably, this increase in credit reflects supply effects as we include granular county fixed effects to control for any confounding factors in borrower counties, including loan demand. So banks see an inflow of funding. In consequence, they increase their credit. And in the final step, we show that they also take on more risk. So more exposed banks increase the loan-to-income ratios. The application rejection rates go down. And importantly, we find that this had real consequences. So during the Great Recession, banks which were more exposed, at the beginning of our sample, 1997, and took risk in the run-up to the Great Recession, have higher non-performing loans during the Great Recession, so during this negative shock. So these are the key findings of the paper. So again, let me just briefly summarize. Deposit inflows due to population aging, lead to an increase in lending and higher risk-taking. And so the conclusion here would be that population aging could lead to financial instabilities down the road. I'll be brief in the contribution in the interest of time. We're not aware of any paper that actually looks at the effects of demographic change on bank credit and lending standards. There is work out there by Becker and the JFE 2007 who uses the fraction of seniors more as an instrument for deposits and to look at the effect on entrepreneurship. Other papers do look at interest rates and risk-taking, but there's very little work out there that looks at, the secular macroeconomic change, namely aging, and how it affects the financial sector. So let's move on. Okay, step one, population aging and deposits. So the key observation here is what you see in this graph. This is data from the Survey of Consumer Finances, and focus on the blue bars for now, which is total deposits in thousands of dollars across the age cohorts on the x-axis. And as you can see, the older you are, the more of your wealth you hold in the form of deposits. So for example, the share population 65 and older holds 2 to 3 times as many deposits in actual value compared to younger cohorts. Okay, so based on this observation, the reasoning is that as there's an increase in number of seniors in the county, there will be an increase in the amount of deposits in that county. And to test this more formally, the first step of the paper runs the following regression. So the outcome is the change in deposits of a bank B in a county C from 1997 to 2007, regressed on the change in seniors in that county. Okay, so imagine one bank has branches in different counties, is subject to different demographic dynamics. This is what we're exploiting here. And then we include different bank and county controls, but we also include bank fix-to-fix and regression. The idea here is that obviously deposit growth might be affected by bank-specific factors that are, whatever, unrelated or orthogonal to aging. So we want to control for them to make sure it's really about the county factors that explain our finding. So focus on columns 1 to 4 here. So these columns give you the coefficient beta on the change in seniors. And as we move from column 1 to 4, we add more and more controls to tighten the identification. So column 1 just has county controls, and there's a significant positive effect of aging in a county on deposits in branches in that county. In column 2, we further add bank controls. Column 3, we go one step further at bank fixed effects. So basically absorb all the variation at the bank level, observed or unobserved. And column 4 even at state fixed effect at the borrower level. So what column 4 basically does is it compares the effect of aging in counties on branches of the same bank all within the same state. Okay, and in terms of magnitude, what you find here is that the rise in the senior population by around 1/3 increases deposits by 25% over a decade. Okay, and so what I think is quite nice here is that as you move from column 1 to column 4, the R-square goes up by quite a bit as you add more and more controls, but the coefficient moves quite little. So this reassures us that aging is to a certain extent orthogonal to bank level changes. Now, of course, it could still be the case that aging is correlated with county factors that affect deposit growth, even if we account for bank-specific factors. And so this is why we use an IV strategy. And the idea here is to use the predetermined component of county's age structure. So simply put, the idea is that if there were many people that were 40-year-old in 1980, there will probably be many people that are 60-year-olds in 2000. And building on that insight, we basically use the past demographic structure 20 years prior to our sample to predict aging during our sample period. And the assumption here is that this historical demographic structure is plausibly exogenous to changes, that's the important thing, in contemporaneous confounding factors. And so we actually can somewhat test for this. So in our regressions, we will include changes, so contemporaneous changes in, for example, income per capita, unemployment rate, or house prices. And, if our identifying assumption is correct, then including those changes shouldn't affect the coefficients of the IV regressions that much. And actually, that's the case. I'll show you in a minute. And we also tested this more formally for the sensitivity with exclusion restriction, following Connolly and co-authors who have this paper on plausibly exogeneity. Okay, so anyway, column 5 and 6 are the results. Column 5 is the IV regression. if you compare to column 4, it's very similar in terms of sign size and magnitude. In column 6, we had county controls in changes, and the coefficient, moves only by a little. So again, this is in line if you think that past demographic structure affects deposits through today's demographic structure, but not other county level characteristics. And finally, in column 7 and 8, we move to the bank level. And what you see here is that bank deposits increase in aggregate for banks more exposed to aging counties, but so do liabilities in almost 1-for-1. So there doesn't seem to be an offsetting factor here that banks reduce other liabilities as deposits flow into the branches. Okay, so step 1, local aging increases bank deposits. What about bank lending and risk taking? And the first observation to make is that population aging will affect the demand for credit. So there's different channels at work here. On the one hand, seniors usually own their property and have higher savings, so they just need less credit. They're less likely to start their own company, which is another important factor for credit demand. And aging could also, reduce the labor force participation rate. And since firms' marginal productive capital is increasing in available labor, this might also dampen demand for capital. So we test for this more formally in the paper, where we decompose credit growth into demand and supply components. And what we find is that there's a strong negative relation between local aging in a county and the demand factor in that county. Okay, so basically, banks are confronted with an inflow of funding, and at the same time a demand shock locally where they have branches. So to analyze how, in the end, aging affects lending, we first have to construct some exposure of the bank to aggregate aging. I mean, the idea is here that a bank might be active in 100 counties, but what exposure here measures is just the deposit-weighted aging across those 100 counties. So basically, suppose the bank would be active in only one synthetic county, then exposure would tell you about how much the senior population increases in this synthetic county during our sample period. And so we show in the paper that high and low exposure banks are actually similar in terms of most balance sheet characteristics, which is reassuring that it's not correlated too strongly with observable bank characteristics. We also find that neither exposure nor aging predict where banks open branches. Why does this matter? Well, to a certain extent, demographic trends are predictable, so maybe banks, in anticipation of deposit inflows, could have opened branches strategically, which would be a trouble for our identification strategy, but we find no such evidence, which mitigates concerns about the selection effects. Okay, so armed with exposure, we want to analyze how does exposure of a bank at the beginning of the sample affect their lending, where we use HAMDA data on residential mortgages, but also their risk-taking. In the main measure, here's the loan-to-income ratio. We also look at application rejection rates in the paper. Now, for identification, we use different bank and county level controls, but more importantly, county fixed effects. So basically, we look at the effect of exposure on bank lending and risk-taking, holding constant everything we can observe at the county level, including loan demand, but also changes in unemployment, and so forth. Okay, so let's look at lending first. In columns 1 to 3, as before, we basically, as we move from left to right, we tighten identification. The coefficient tells you the effect of exposure on lending. Column 1, bank controls. Column 2 adds county controls. Column 3, county fixed effects. And similar to before, there's a significant positive effect of exposure on lending, meaning that banks more exposed to aging counties, so those with more deposit inflows, increase their lending. In terms of magnitude, similar exercise, a 33 percentage point increase in exposure, increased lending by 20% over the decade we consider.
5 minutes.
Okay, that's perfect, thanks. And in column 4 and 5, we interact exposure with a no-branch dummy, which basically takes a value of 1 in counties where banks are lending but don't have a branch. And what you see on the interaction effect that's positive here is that the increase in credit supply is especially strong in counties where they have no branch. Now, does this make sense? Well, we think yes, because highly exposed banks are having branches in counties which are aging rapidly. But if aging reduces local credit demand, they have to put the money somewhere. Whether they put it in counties where they have no branch, there's less aging, okay, which are aging less fast, and credit demand is not dampened. So this is why you find a strong positive coefficient on the interaction term. Now, after looking at deposit inflows and risk-taking and lending, in the final slide we look at risk-taking. The outcome here is the change in the loan-to-income ratio at the bank county level. So what column 1 tells you that more exposed banks see an increase in the loan-to-income ratio on average. And as we show in the paper, or here in columns 2 and 3, there's actually a stronger along the distribution. So banks take more risk, especially in the riskier segments. Okay, so the effect is increasing in the initial loan-to-income ratios. Now, to give more evidence on the risk-taking channel, in column 4, we interact exposure with banks, beginning of sample Tier 1 capital ratio. What we find is that the effect of exposure, so of aging exposure on risk-taking, is more pronounced for banks with low capital ratios, which is in line with previous findings, theoretically and empirically, that as credit conditions are easing, low capitalized banks tend to engage in risk-taking as the constraints are relaxed. And similarly, in columns 5 and 6, we show that the risk-taking is more pronounced in no-branch counties. And this is about, or most consistent with the story about informational frictions. The idea is that if you have a branch, you have soft information locally, and it has been shown that a bigger distance between a branch and a borrower, or the headquarter and a borrower, implies more risk-taking by banks, which is exactly what we find here. Okay, so let me briefly take stock. As the population is aging, banks with branches in aging counties see deposit inflows. They use that money to extend more credit, but in the process increase loan-to-income ratios and reduce the rejection rates on loan applications. Now, by itself, this doesn't mean that, they're taking too much risk. But what we do in the final part of the paper is look at the Great Recession and ask the question, what happens to non-performing loans when there actually is a negative shock? And so what we plot here, we split banks into those with low exposure, like the bottom tercile, and high exposure, the top tercile, and plot the non-performing loans ratio on 1 to 4 family loans, which is, exactly the type of loan we looked at in the analysis before. And as you can see, for both types of banks, non-performing loans increase during the Great Recession, but significantly more for high exposure banks. And importantly, this holds even when we control for banks' exposure to the housing boom or bust. So this really is a force above and beyond the house price dynamics that were going on during that time. So what this suggests is that the declining lending standards in the run-up to the Great Recession really manifested itself in higher non-performing loans during the Great Recession. So this really matters for financial stability. So let me conclude here. I hope, slightly ahead of time. 10 years in Switzerland do that to you. So local aging is associated with a stark increase in credit level deposits, but there's a decline in the demand for credit at the same time. So what aging exposed banks do is they take the funds, they extend more credit, especially in countries where they have no branches, and take more risk, which leads to higher non-performing loans during a downturn. So what our results suggest is population aging could lead to financial instabilities. And if you go back to the very first graph I showed you on the projected increase in the senior population in the US, but also elsewhere, this is quite a worrying finding. We all face an unprecedented increase in the number of seniors. And so if this leads to more risk-taking, then we definitely should keep an eye on those developments. So let me stop right here. Thank you.
Great. Thank you, Sebastian. So our third paper is titled Capital Allocation, the Leverage Ratio Requirement, and Banks' Risk-Taking. And Quinan Vo from the Bank of England will be presenting. Go ahead, Quinan.
Yeah, thank you. Hello, everyone. So thank you for the organizer to include this paper in the program. It is a joy work with Yunan Nim to collect the Bank of England. So given both of us are in the Bank of England, so the usual disclaimer applies. So the view in the paper is our own, not the view, does not reflect the view of the Bank of England or its committee. Next slide, please. Can I move the slide?
You can control the slides by going to the left-hand panel and using the carrots.
Yeah, okay, that's great. So the motivation of the paper, so I think we all here know that after the 2007-2009 crisis, the banking regulatory framework has undergone a substantial overhaul. And I think one of the most kind of prominent reform is the introduction of the leverage ratio requirement to complement the risk-weighted capital requirement and make the whole capital framework more robust. There is a great interest on analyzing what is the impact of that introduction, that requirement on the buying behavior. And so far, the focus of the literature is on the impact of the requirement on the buying risk-taking. I think that is very intuitive because leverage ratio requirement is kind of a rate intensity requirement. But we observe that what is missing in the literature is that there is, so far, to the best of our knowledge, there is no formal analysis looking at how the impact of the leverage ratio on the buying risk-taking depend on the level at which that ratio is applied. So you know that in the Basel framework, the leverage ratio is imposed at the group consolidated level. So why it is relevant to look at the impact of the level at which leverage ratio is applied on the buying behavior. So recent supervisory review, I think the two review conducted by the Prudential Regulation Authority in the UK, shows that even that the leverage ratio is legally applied at the group consolidated level, but some banks did take into account that requirement in their internal capital allocation process. What does it mean? That means that even legally, the requirement is applied just at the consolidated level, but the bank, through their internal capital allocation process, may choose to apply that requirement at the lower level of business, like a business unit, or even like at the trading desk level. And then there is some concern from that supervisory that what is the implication of that practice for the effectiveness of the whole prudential framework. And that is the kind of the gap that we found in the literature, and we try to fill that in. Now, more precisely, what is like the question we asked in the paper? So we want to analyze how is the allocation of regulatory requirement to business units, that means interchangeably, how is the fact that the bank applies the regulatory requirement at the lower business level than the group level affects the bank risk-taking. And we also investigate whether that impact depends on the bank's business model. Now, how we approach those questions? So we construct a model of bank optimal investment with the multiple capital constraints and multiple business units to understand how is the different level of application of requirement affects the bank risk-taking. We just compare the optimal investment of the bank in the case when they follow the rule and just apply the regulatory requirement at the group level, as compared to the case that they incorporated that in the internal capital allocation approach in a way that means they apply the regulation at the lower business level, at the business unit in our model. Then we calibrate, we bring our model to the data to verify like the empirical relevance of our analytical finding, and we also complement our analytical finding with the insight on whether the impact differ between different business models. So a short recap of what we find. So analytically, we find that the impact of the application level of regulatory requirement on the bank asset risk depend on what is the binding constraint at the group level. So there are two interesting cases. Either the banking groups, that means the bank is bound by the leverage ratio requirement at the group level, then we don't see any negative effect on the bank risk-taking. That means either the asset risk does not change or decrease. But if the bank is bound by the risk-weighted requirement at the group level, then we found that under some condition, the bank allocating down the regulatory constraint to the lower business unit, to business unit level, will lead to a kind of increasing in the bank asset risk. And we did find that the impact differ across business models. So that means the business model matter for the question. So that is here's the outline of my talk. So I have explained motivation of research and what is the research question. Then I will explain the related, but for the sake of the time, so I think I will skip the literature, related literature, And then I will explain what is our theoretical model and what is the key result from that. And then I explain how we calibrate the model to the UK bank and the insight from the simulation of the calibrated model. So as I said that for the literature, just to highlight that to the best analyst, we think that our paper is like the first one to formally examine the impact of the application level of regulatory constraint on their impact on the bank behavior. Now, go to the model. So here we have a banking group that run 2 business units. And that banking group is subject to 2 requirements. I will go into this more detail later. But the key question we are asked is that how the bank decision on investing across the 2 business units differ depending on the level, the business level at which they apply the 2 regulatory constraints. We assume now that the bank is funded by some fixed amount of equity and the remaining is unsecured debt with some cross-interest rate. Now, for 2 business units, we will model that as one is lending unit, and the other one will be repo unit. So I will go into more detail about this unit later and explaining the motivation for our choice of business unit. Now, coming to the regulatory constraint, we assume that the bank are subject to 2 requirements. So the first one is the risk-weighted requirement. And the way we model that, we use the VAR constraint as a way to model that requirement. And the second is the leverage ratio requirement. I think it is very simple. It is like some minimum requirement for the ratio of the capital the bank has over the total leverage exposure of their balance sheet. Now, okay, so what is the characteristic of the business unit? Like I have mentioned, so we model in our paper like 2 business units. The first one is lending. We present that as lending. That grant lend to the borrower, and L is like a total granted loan. So we assume that the key benefit of the lending is that there is some generate some lending revenue that is captured by the function G, and then we capture the risk in it of this business unit by the fact that some of the loan may not repay, and we assume that here Z is some kind like the non-performing loan per unit of loan, and then we will the expected profit of that will be the lending revenue minus the impaired loan, and then the cost of funding. So KL here is the capital allocated to the lending business. So that means the unsecured debt is only the size of the business minus the capital allocated to that business. Now, the business, we model that as repo. The reason why we model that as repo, because I think repo seem to be considered as the likely business that affected by the leverage ratio as like because that is a kind of low return but low risk business, and repo attract a lot of interest because that the importance of that business for the functioning of the financial market. And there are some evidence that leverage ratio did generate some negative impact on the repo business, but there is no clear explanation of what is the mechanism underlying that impact. So that is the reason why in this paper we choose to model the low risk and low return business as a repo business, and try to see whether we can offer some explanation for some early empirical evidence found in the literature. Now, how we model the repo business? So we assume that this unit owns a stock of government bond of value X, as you see here. And it will use this inventory of government bond to raise collateral of lending, to engage in the repo activity, to finance bond trading activity, or to act as an intermediary between the repo counterparty and the reverse repo counterparty. So there are 2 sort of revenue from this business unit. Of course, we have some coupon they receive from government bond inventory, and then we assume that the revenue from matching the two party in the repo market, or using the repo as to fund some trading activity, we assume that as generation some revenue as FX, a function of the total value of the stock of the government bond. And then we also assume that there is some loss because of maybe some counterparty repo does not pay their loan. And finally, the expected profit will be captured also the cost of the debt that used to fund this business unit. Now, what is the what we assume about the characteristics of this both business units? So the first condition, the four condition in the first slide below the where is mean that we assume that both business units, they have decreasing return to scale. And then the second line is assume that on the basis of non-risk adjusted returns, then the lending is more profitable than repo. So I think that reflects the reality. And then we also using the VAR measure of risk, we assume also that on the standalone basis, lending is riskier than repo. Now, okay, so as I mentioned before, so the way we try to understand how the level at which the bank apply the regulatory constraint affects their investment decision by comparing the two cases when what is the investment if they apply own at the group level, or what is in the investment if they apply both regulatory at the business unit level. So here is the bank optimization depending on which level they apply regulatory constraint. So for both cases, they will maximize their total expected profit. But when they choose to apply the regulatory constraint at the group level, then the two constraints, the two regulatory constraints, risk-weighted and leverage ratio will be expect at the group level. So on the left-hand side, you see that is kind of VAR constraint at the group level. And on the right-hand side, you can see that the leverage constraint mean that the capital at the group level they have need to be greater than some fraction of their leverage exposure. Now, I want to go in detail about the leverage exposure. Why our leverage exposure is L plus alpha X instead and only L plus X. The reason is that you know that when in the one of the chain in the way Basel III counts the leverage exposure of the repo business is that before it the repo unit have some collateral and they use that collateral to engage in repo, the collateral can go out of the balance sheet of that unit, but now collateral is still kept in the balance sheet. That's the reason why the leverage exposure sometimes can be a multiple of the size of that the balance sheet of that business unit. So that's the reason why we capture here is that the leverage exposure repo can be some multiple for of the balance sheet of the repo, and alpha here can be from 1 to 2. Now, if the bank choose to apply the gradual constraint at the business unit, then here the bank will have to subject to 4 constraints. So on the left-hand side, you have risk-weighted requirement and leverage requirement for the for the repo business. And on the right-hand side, that is the 2 constraints imposed on the lending business. Okay, so before we explain what is our finding, so maybe some concept will be useful. So here, instead of maximizing across like XLL, because we are focused on the impact on the bank asset rate, so we change the optimization variable into the total investment. That means what is the size of the total balance sheet of the bank S, and then our measure of an asset rate is the fraction of the total balance sheet allocated to lending. because in our model setup, there is only two types. One is riskier, only two business units. One is riskier. The other is less risky. So the fraction the bank total balance sheet invested in the riskier one will be measured by asset risk, and the higher that fraction, the higher the bank asset risk. In the regulatory community, I think we also be familiar with like what is the average risk weight. So normally the average risk weight is is a ratio between total risk-weighted asset of the bank over the leverage exposure. So we have here average risk weight at the group level and average risk weight at the business unit level for lending unit and for repo unit. And then also we have a kind of diversification benefit, because you know that when we apply at the risk-weighted constraint at the group level, then the bank will benefit some diversification as compared to the case when they require each business unit to comply with the risk-weighted requirement. Now, so the first finding is that we focus on two main cases. The first case is the case when the banking group is bound by the leverage ratio requirement at the group level. And we found that there are two situations. Either that is applying down the regulatory constraint to the business will not have any impact on the bank asset rate if both business units have lower average risk weight, so below some we refer to like a critical risk weight. It is the ratio of the minimum leverage ratio requirement over the minimum risk-weighted requirement. Now, if both businesses have a higher average risk weight, that means the second case, then we observe that applying down regulatory constraint to the business unit will lead to a decrease in the asset rate. Now, what is the key intuition here? So we focus on how the level of application affects the W, and W is what is the relative attractiveness between lending and repo. So what is the marginal benefit of higher W? So you know that lending is more profitable, so the marginal benefit of higher W is the increase in bank expected marginal profit, because lending is generally more profitable than repo. But what is the marginal cost of that? So the key cost here of the investment is that if you invest more in the lending or in the repo, you have to allocate or require more capital coming from either of the two regulatory constraints. Now, how is this marginal cost is determined? It depends on which constraint is relevant. So group level, because the bank is bound by the leverage ratio requirement, then the building is the leverage ratio. So the marginal cost here is determined by the difference between the marginal leverage cost between the business unit. So you can see that if one further unit invests in lending, then the required capital will increase by key. That means the minimum leverage ratio requirement. But for repo, because of the multiple characteristic of like a leverage exposure as compared to the size, so you can see here the marginal leverage cost for repo is alpha key instead of key. Now, what happens if constraint applied at the business unit level? So for the K1, when both business units have low average risk weight, then the constraint that is relevant for them is also the leverage. So that means the marginal cost in this case is the same as the kind of group level application. That's the reason why there is no change in the bank optimal investment. But in the K2, when both business units have higher average risk weight, then the constraint that is relevant is the risk-weighted capital requirement. And then now the marginal cost is determined by the marginal risk-weighted capital cost. And we know that in general, repo is less risky. So that means the marginal risk-weighted capital cost of repo is less than lending, but the marginal leverage cost of repo is higher. So that is the reason why in K2 we have decrease in the asset risk.
Please conclude.
So for the kind of risk-weighted constraint, we also see that we here is a condition that when there is increase in the asset rates, that means when the lending business is bound by the risk weighted, while the repo is bound by the lending, and the second condition is when the marginal level cost of repo is higher than the marginal risk-weighted capital cost of that business. And the third condition when is the diversification benefit is decreasing with more investment in the lending. So to save time, because the key intuition is quite similar to the first case, so I will skip that. Now, then we bring our model to the data to verify our empirical relevant, our analytical result. And what we found is here. So here we compare the investment within the case when leverage, both constraints apply at the group level to compare to the case when it applies at the business unit level. Then you can see that in each panel the blue area is where the bank is bound by risk-weighted requirement at the group level. And on the bottom left panel, you can see that the difference between the risk-taking impact is positive. That means the asset rate at the case of business unit is bigger than the asset rate in the case of group level. So that means our analytical finding is verified in the data.
Thank you for your presentation. Please spend the next 30 seconds and conclude.
Okay, yeah. So here, just to conclude, is that we found that the impact of the leverage ratio depend on which level it apply. And what we found is that if the bank is bound by the risk weighted, then we will have some increase in the asset rate. And the key policy implication here is that there are some, our paper generates some potential cost of applying regulatory constraint at the lower levels than the group considered level. Sorry for that. Thank you.
Okay, great. So I'm going to discuss the papers in the reverse order that they were presented, but I don't think this should change things too much. Okay, so let me go to the paper that Quinan just presented. This topic, I think, is very important because some banks allocate capital and impose regulatory ratio requirements at the group level, for example, the bank holding company level, while others do so at the business unit level, for example, the subsidiary level. Now, the model in the paper assumes the bank has two risky business units, a more risky lending unit that the bank has in amount L, and then some, and that's subject to losses, where Z is the per unit loss of the lending unit. And then there's a less risky repo unit in an amount X that is subject to losses epsilon X. Now, the paper assumes that the bank's overall portfolio risk is increasing in the proportion of lending to total assets because the lending loss is assumed to be larger or more volatile than the repo unit loss. So throughout the paper, a key quantity that's used is the proportion of lending to total assets. And it's assumed that this W, this allocation to lending, is a measure of the total portfolio or asset risk of the bank. But I think what needs to be accounted for in the model is that that's not true in general if there are diversification benefits, which the paper also assumes, for example, in Proposition 1. So to illustrate that, suppose we denote the volatility of losses from the repo unit, or the variance of losses from the repo unit, as sigma x squared, and the variance of losses from the lending unit as sigma L squared. And suppose there are some potential diversification benefits, and so sigma XL would be the covariance of the 2 units losses. Then we know from standard portfolio theory that the minimum variance asset allocation to lending is not always 0. Rather, it would be given by the first ratio here in the slide. So, for example, if losses were uncorrelated, where the covariance here would be 0, the bank's overall asset variance is not going to be monotonically increasing in W as the paper generally assumes, but rather over the range from 0 to 1, it's going to be U-shaped. And the minimum allocation, the minimum variance allocation in that case to the lending unit is given by this ratio. So that's kind of my first comment. I think the paper needs to check that under certain assumed parameter values, whether in fact over the relevant range that the W they use is actually increasing in portfolio risk, because in general that might not be the case. My second comment is a little more minor. The bank chooses the total amount of lending and its amount in the repo unit to maximize profits. But I think in the profit function, while it includes a term that reflects the cost of debt, this capital R, it kind of leaves out a term that reflects the cost of equity capital. In other words, the higher the cost of equity capital, the lower should be the bank's overall scale. And so my suggestion is that in the profit function, there should be an additional term, both for the profits of the lending unit and the profits of the repo unit. There should be an additional term reflecting the cost of capital, where, say, RK is the shareholders' required return on equity capital. Now, importantly, these terms would only affect the profit maximization in the problem, but not the paper's risk-based capital calculation. So that shouldn't change. The paper does that, I think, correctly, but it should include these additional cost of capital terms. I think the quantitative impact is going to be unaffected, but just to be a little bit more rigorous, that should be included. Okay, so let me go to the second paper that Sebastian presented on population aging. Again, I think this is a very important paper. Clearly, the financial system is going to be affected by demographic change, especially aging. And I think this is an understudied topic that the paper helps to address. So let me begin with the paper's definition of aging. The paper defines county C's aging as its log change in the population of people aged 65 and older over the decade from 1997 to 2007. So the way they calculate aging is simply the log change in the number of people in the county over 65 in 2007 versus the number of people over 65 in the county in 1997. Now, this is, I think, a little bit different from earlier work, such as Bo Becker's paper, that defines county aging as the proportion of the total population that's over 65. So, for example, Becker defines it as the number of people over 65 relative to the total number of people in the county, say NC. And so, based on that definition, you might define aging as the log change in the proportion of the county's population over 65. In other words, you would correct for the total gain in population of the county, not just the gain in population of the county over 65. So essentially growth in the over age 65 population would be adjusted for total population growth. Now, both of these definitions are valid in some ways, but it does make a difference. And let me give an illustration of that. Many counties that have high growth in people over 65 often have, on average, a very young population. And vice versa, people who have some counties that have a low change in the aged population are actually quite old on average. So, two examples that I picked out, and I used data not over the 1997 to 2007 period, but slightly different over the 2000 period to 2010, because that was the data I had available from the two-decade census. So not much different. It's just moved ahead by 3 years. But take as an example Hamilton County, New York. Based on the paper's definition of aging, the number of people over 65 increased by 4.9%, whereas in Utah County, Utah, the number of people over 65 increased by 35%. But if you look at the proportion of the population over 65 in 2010, it was much higher in Hamilton County than in Utah County, which was actually one of the youngest in terms of average population in the country. And if you look at the change in the proportion of people who were over 65 from 2000 to 2010, there was a 3.4% increase in the aged in Hamilton County and almost no change in the proportion of the county over 65 in Utah County. So my point is it sort of makes a difference in how you measure agedness of a county. In some sense, the paper's definition confounds aging with general population growth. Now, the paper does attempt to adjust for some of this. For example, in its online appendix, it looks at not only the growth in population of the over 65 people, but also other age groups. And when it redefines its exposure variable based on that, actually the effect seems to increase in how mortgage lending is affected by the change in the over 65 population. So just as sort of one suggestion to test whether there's actually an independent effect of people over 65, the paper could normalize relevant growth rates by the change in the total county population. So measure this as essentially growth per capita. Measure all the relevant variables in terms of growth per capita. Just to show that this does seem to make a difference, here is the map in the paper. And one point that they make is that there's very few changes in their aged variable in the Great Plains. And that's because this area is really losing population. But if you look at in 2010, the proportion of people over 65 in those Great Plains counties, which is this second map here, you see that, in fact, they're some of the oldest counties in terms of the average age here. The last comment I want to make on this paper is just the definition of the mortgage lending variable. So the paper examines how a bank's exposure to the change in the over 65 population, which, as it shows, tends to be counties with high deposit growth, how that affects mortgage lending as recorded by the data in the Home Mortgage Disclosure Act reports. And one issue, though, is that mortgages are sometimes not kept on a bank's balance sheet, but the bank will often sell mortgages to GSEs, or sometimes they're privately securitized. And that tends to happen soon after origination. And therefore, some of the mortgage lending by the bank that the paper examines is not actually funded by deposits. So to see how actually increases in deposits would affect mortgage lending, I think that the paper could exclude from its HMDA variable on mortgages those that are sold by the end of the calendar year. That information is there. And I think that actually might strengthen the paper's results. I had a paper with Junho Han and Juan Park that finds that banks are less likely to securitize mortgages in states where they face high corporate income taxes when there's a higher proportion in the over 65 population. So we actually do look at this over 65 population similar to the Becker paper and find that actually there's less securitization, more on balance sheet mortgage lending in at least some of the older local markets. Okay, so the last paper is the paper that Saki first presented. I think this is a very clever modeling of delayed accounting. Very innovative paper. As Saki mentioned, they really look at three different variables: the book value of capital, which regulatory restrictions are typically implemented on. But then there's a second variable, which I think I would call the market value of tangible net worth. They use in the paper the fundamental value of capital. And then there's the market value of shareholders' equity. The main focus of the paper is to try to use this model to match data on the time series of U.S. banks, data on these three variables. And the paper, I think, is very successful, largely successful in this exercise to describe the time series movements, book value of capital versus the market value of shareholders' equity. The model is quite elegant, makes some, I think, necessarily simplifying assumptions, but some of the simplifications are unrealistic. And I would kind of, I think, encourage the authors to, perhaps in a new paper, a related paper, modify the model with some additional realism that could address an arguably more important normative exercise to see whether it's really good or not that bank regulation focuses on book values rather than market values. So the model assumes that realizations of loan portfolio defaults follow a Poisson process with a known loss rate. So when there are defaults, we know exactly what proportion of loans are going to take losses. After a loss, a bank can immediately restore its market and book capital ratios by selling loans to pay off deposits. I think this is realistic. The banks typically do shrink their balance sheet to then get back to a lower leverage ratio. Now, the known loss rate assumed in the model allows a bank to choose a capital buffer that will always allow it to avoid breaching either its regulatory or market solvency leverage constraint. Though sometimes it may be optimal for a bank to not want to do that, to risk a breach that leads to a possible bank failure. The paper's simulations find that the regulatory constraint is more likely to bind rather than the market value, the market solvency constraint. However, I think that's, well, in some sense, maybe counterfactual in that almost all large bank failures, such as Washington Mutual, Wachovia in 2008, and Spain's Banco Popular in 2017, failed because of depositor runs. In other words, what appears to be a violation of the market solvency constraint, not that their regulatory constraints were violated. And another illustration of that is from a paper by Andy Haldane at the Bank of England, where he looked at a group of approximately 32 large international banks and actually 34 large international banks, and looked at, prior to the Lehman Brothers bankruptcy in September of 2008, how two groups of banks, namely ones that did not fail or require a bank bailout, the so-called no crisis banks, compared to banks that actually ended up failing or needing a bailout, which is the red figure here. And the finding is that if you look at the average Tier 1 capital ratios of these two groups, there was virtually no difference prior to the Lehman Brothers failure. In fact, maybe just beforehand, it appears that the Tier 1 capital ratios of the banks that ended up needing a bailout or failed was higher than the banks that didn't. But then if you look at the market value of equity to assets, you get a totally different story, that you could see well beforehand that the banks that did fail or needed a bailout had a much lower market value of equity to asset ratios, which sort of leads that what caused them to fail was apparently a solvency constraint. Okay, just a few other comments. The assumption of the model assumes we know a default rate, that the default loss rate on the bank's loans are uncertain, but I think, realistically that is uncertain, and there is ways of modeling similar to the paper, a Poisson process for losses with uncertain loss rates that would allow you also to solve for what would be the default risk premium on deposits. More generally, I think you could also have random gains to bank net worth, not only losses. For example, due to interest rate risk, you could generalize the model in that direction. The model assumes perfectly elastic supplies of loans and deposits. In the model, the bank would like to expand its scale infinitely if it could, but I think realistically, in a model similar to the one by Quinan, is that there's probably diseconomies of scale at some point in both lending and deposit issuance. So the model could incorporate that. And then finally, the model assumes that loans can be immediately sold to shrink its balance sheet without any fire sale costs. Now, I think this might actually be justified if you allowed the bank to hold not only loans, but liquid securities. So that would be another generalization of the model. In fact, loans right now make up less than 50% of all assets of U.S. banks. So just to conclude, I think these are three really interesting and important papers. I'd encourage everyone listening to read them, and perhaps more helpful, they contain ideas that can lead to, I think, additional fruitful research. So thank you, and I'll turn it over to Jonathan to take any questions from the audience.
Thank you very much to the presenters. Thank you very much, George. As the discussant, I see that we are now at 12:10 Eastern Time, which is what we've budgeted for the session. We very much encourage you to attend the virtual receptions later today. If you do have questions and you'd like to talk to the presenters, or of course you can contact them independently. We would like to welcome everyone back at 12:45 for our panel discussion, 20 Years of Banking Going Forward. We hope you will join us then, and well, with that, I will send off to break.
Thanks, bye.
Hello, everyone, and welcome back to a panel session. We're going to discuss, or hopefully shed some light on what's in store for the future in banking. Our panelists are extremely distinguished, and even though in finance we're not supposed to predict the future or use the past to predict the future, I'm very interested to see what they have to say. So first up on our roster is going to be Jiguo He, who has written pretty much on every single topic in finance. But in particular, what's going to be interesting for this panel is his work on intermediation, and in particular competition between banks and other new sorts of intermediaries. And he has an interesting and deep knowledge of blockchain and fintech, which is arguably one of the things that's going to shape the future. Then we're going to hear from Manju Puri, who is known to all of us, and in particular people from the FDIC. She has a long and distinguished career doing research in banking, but recently she's pivoted to fintech and has considered the role of information and how important it is in trying to understand what banks and intermediaries of the future are going to do. And our final panelist is Gregor Matvos, who has spent a great deal of time thinking about what happens to banks when outcomes turn out badly, so in particular bank distress. He's focused a lot on shadow banking, so the intermediaries who look a lot like banks but aren't regulated the same way, and in general thinking about the sorts of frictions that affect intermediaries and affect outcomes. So without further ado, I'm going to turn it over to our first panelist, Jiguo, just to give us a few preliminary comments on how he's thinking about competition in banking and how the world is going to change.
Thanks, Christine. I would like to share my slides. Go ahead and use the share button, please, sir. Yep. So that's the share part. Can you see everything? Yes, sir. Okay. Great. Thank you. So I'm going to be, thanks, Christine, for the nice words. Let me. Okay. So I'm going to try to be very short and using some knowledge that I accumulated in the past 2 years after COVID, where I was kind of very much interested in this open banking idea. And then I will talk about the bank fintech competition in the practice, and then we'll conclude with some government role in the last slide. So obviously, I'm going to focus on this personal small business loans. There are tons of other fintechs out there. I'm not touching on it, and I hope that this is exactly where the bank and the fintech future competition become interesting. The one important part I would like to touch on is this open banking idea is basically financial institutions, they under certain, either the government mandate or either some market forces, they are able to access, use, and share customer transaction data through APIs. This is an application programmable interface with the consumer's consent. Okay, so EU EK is pretty much basically government said, incumbent banks need to do that because we want to level the playing field for everybody. Brazil is very bold in pushing that out, and it's almost down, halfway down. And in the next year, by next year, I guess 11 months from now, then the credit proposals will be implemented, which means that fintechs can use based on the banking information to make loans. Okay, for U.S., it's a very things that happened so fast in the past 4 or 5 years. So I think Manju mentioned this ultra FICO. This interesting idea to me. Basically, that if you were kind of like fall short on the FICO score in getting the loan from the traditional banks, you can ask the experienced FICO company to provide another elevated service, a premium service, so that that part of the service, including some information on the bank data. Okay, and then 3 months ago, Capital One, so that's another traditional bank. Their customers are now able to share their data with thousands of additional fintechs thanks to the agreement between Capital One and the Plaid. So Plaid basically is a data aggregator where they making sure that the data is stored and shared in a safe way. So we had a paper, a theory paper, is asking some questions on this. What will be the competition look like when the borrower owns the data? And particularly, we were asking on these welfare questions. With information, that everything is tricky. So we are just making sure that our regulators should be aware of this possibility of everybody worse off issue. Okay, what I'm going to mainly talk about in the next several minutes is really think deeper on thinking about, obviously those things help fintechs to compete with the banks. In my mind is that still in the US, obviously banks are stronger, or in the EU, and the fintechs are weaker, so that those things helps the fintech compete with banks. But it seems like when I look around China has a slightly different feature, so that I will bring some data for that, as well as many other existing mature fintechs. They seems not necessarily compete on the same information, and which is obviously in contrast to my open banking paper. But I just wanted to let you know. It seems like that there are many different dimensions that it's interesting to the future researchers. So here I'm giving you some stylized regression results that are coming from a paper that I really like. I was in charge of a review finance China special issue, and they sent this paper to me. I really like it. What does it do? They have the Ali's data. Ali has a MyBank data. So that MyBank is like a standard traditional bank, but obviously it's not, because Ali feeding a lot of transaction operating income that these small business borrowers information to MyBank. So MyBank's lending technology obviously is very different from any traditional, think about a state-owned, these traditional banks. And these authors gather these data, and they just do some very enlightening data work to tell us what are their lending technologies. In the way that I wrote down 2 equations here, it's very simple. It's just to try to understand that what will be the correlation with the amount of credit that 2 different banks are able to give in. So this is a samples from both lenders, and they have this I represents a firm, J represents the city, T. You might wonder why it's emphasizing the J. sorry that here house prices should be JT. They don't have the firm level house price. It's basically I try to understand which kind of information are affecting the loan decision. So this is why their title is called Data versus Collateral. All right. So this is the first set of results. It's very simple. Basically, they look at the yellow one is a big tech credit, so that's my bank. A secured bank credit, that's the standard traditional bank. And then they run regression on the log transaction volume of small businesses. So obviously, it seems like the traditional bank also gets some information on these small businesses. Obviously, they can hand over this financial statement, but from just the simple regression here is that the big tech or my bank are relying more on these daily operating, a little bit soft, a little bit those like not those collateral based type of thing. Information. This picture, it's extremely telling. It's just basically okay. Now I change the x variable, independent variable or explanatory variable to the housing prices. Then you see that the big tech do not rely on that at all, almost no. But the secured bank credit is a very much increase. And by the way, this is a log to log, so you can think about it as elasticity. Finally, that it seems like the data only works if it's online firms. That's also kind of making sense because, this is where the Ali is getting data on. So those things, it's all making just telling you that it seems like my bank and a traditional bank, I call my bank as a big tech, are working on different dimensions. So I would like to borrow this opportunity to mention one paper that written by one of my co-authors. It's not written by me, but I really like this paper. She's on the market now. She's a postdoc here. Her paper is titled "The FinTech Expansion." The model sketch is very simple, and I'm surprised that it actually no existing models are having tried to figure out what will happen in this very reasonable and relevant situation, which is think about a borrower who running a food truck. Bank is going to look at your food truck, which is the truck, because they can take the truck and in case of a default, just sell it at the secondary fund. By the way, the Huang is a graduate from Duke. A man you might know. Bank lends with a truck, so cannot enforce cash flow anyway. And the fintech lends data and the technology. So one technology which I found very interesting is recently gets more popular is this take a fraction of cash flows. So that's so-called this POS loan. POS loan. Basically, this is a point of sale machine. When you have the transaction coming in, they just take a cut. So Amazon, PayPal, Square, they're all doing it. And that just means that clearly that if you have a model where you have a firm where you have a truck, but you are selling food, then basically these two lenders are looking at different things. Okay. And then you write down the most standard model, reasonable, and just ask the question, what will happen, and what does this big data can inform us if the world is indeed look like this two-way of competition in a different dimension. So first of all, it's more severe adverse selection. It's endogenous, obviously, is because the fintech indeed needs to figure out whether your food truck is selling good food or bad food. Which means, and also that therefore they need to inquire information. But what's interesting is that when you are having a competitive framework, the information acquisition, which could typically, in thinking about two important emphasis. One is to try to weed out the bad guys. The second is that if you are reasonably good, how much I'm pricing on you. given the competition, actually the incentive to acquire information on the upper side is really dull. It's very small. Okay, so in her model is actually in the end only thing the banks fintechs are doing is for screening, and this seems to be very much consistent with what I know from the China's the Ali's business model. What they really do is try to making sure that you are able to qualified for our loan, while the loan pricing is they just put it as a very, very narrow band. Okay? So they always say, we are making money, but we are making sure that whoever wanted to get the thing is really, it's the extensive margin that you are able to get the loan. The last point is that given this type of model, then the cross-market out-of-sample prediction become super valuable. Think about it. Initially, if the fintech would like to get in, they suffer adverse selection. Okay, but if that we could get a big data technology embedded with the fintech, then what they could do is to learn a lot on some market where they are monopoly, let's say unbanked population, and using the information on these unbanked population on certain characteristics, try to predict the other market with a little bit wealthier, but a similar characteristic. For instance, they always follow the red, traffic rule or these things. So this is my last slide. So basically, I want to say that the fintech benefits a lot from the big data. I think it's a very different economics. And if you are and ask me what will be the future, I do think that the banks are catching up. And I have a recent paper. We utilize the bank's lending IT spending, which will be different from those of fintech idea. I think that a fintech, what the bankers are really catching up with is basically one, investment, right? The other is acquire all these fintech companies. So those things that the banks are catching up, and it will be interesting to know that will be the outcome. What I have not say is the big player, and one thing that I want to mention is that yes, a week ago, basically that Ant is following the Beijing's mandate that Ant gets suspended by the IPO. But the point is that if they wanted to get an IPO, they have to split up, they have to break up their data and the fintech and lending. That's interesting future to see that in what sense that they Ant can still sustain. And the second question is that is going to be helping other, let's say, traditional banks to use Ant data. Because at the whole idea of the Beijing is try to say that, look, you do have a lot of data, but these data are going to be useful for the society, and you should do it the commercialized way to make these data available to everybody. And I also would like to, in the end, I know that we have a discussion. I would like get some sense of my colleagues here, panelists, on their thoughts on the regulatory environment in other countries like the U.S. Thank you. That's all my presentation.
Okay, so I believe I go next. So it's an honor to be on this panel, and I'll be talking about the power and the use of data. Now, historically, banks have had an information advantage over other players. So when we think of public markets or credit bureaus, there's a large literature in academics suggesting that banks are special. They have an information advantage. And hence you have innovations such as the Ultra FICO score, where if you have a bad FICO score, you can actually give your bank accounts and they'll use that information to produce a new Ultra FICO score that will actually incorporate it. So now there's been a new data revolution on the internet. You have all kinds of unconventional data available. What does it mean? What are some of the implications? So is this alternative data even useful? Research suggests it is. So I have a recent RFS paper which looks at digital footprints, the bare minimum information that you leave behind when you access the web, and it suggests it significantly captures default. So what kind of information do we leave behind? So here's just as motivation, a picture of New York City. The red dots are people using iOS system, and you can see these red dots are sort of concentrated in the island of Manhattan. The green dots are people using Android. So as you move away to Brooklyn or New Jersey, you see more green dots. So recent research has suggested, what's the difference between the rich and the poor over the ages? Well, it used to be, do you have cable TV or BMW? These days, it's do you have an iPhone or an iPad? And so even if I know nothing, if I'm a woman from Mars and I'm just looking at this picture, and this is all publicly available data, this already tells me the wealth is concentrated here in the island of Manhattan. And once you go out, to Brooklyn, New Jersey, you actually see less wealth. And this is just one data point from the digital footprint, right? And so what is sort of just the bare minimum that you leave behind? So I'm not talking even of the deep sort of digital footprints of Twitter or Facebook accounts. And so if we think about it, so here are sort of 10 variables that, we explored in our paper that I can tell you more about. So it's how do you access the internet? Is it an iPhone, an iPad? And, so again, that's sort of a proxy of income. It's telling you who has more money. Is it a paid email provider or a free email provider? Then how do you get there? Do you click on paid ads? So people who click on paid ads, the default rate tends to be lower. What time of the day do you shop? Morning, noon, or night? So people who shop between midnight and 6 a.m., their default rate tends to be higher, right? Do you, when you put in your email, does it bounce? And so, yeah, if you stole that email or you're so drunk, you can't type it straight, and it bounces, the default rate is higher. And do you have ownership? Like, what about is your name in your emails? There's research in entrepreneurship that suggests if you name a company after yourself, it means something. So similarly, if your name, first or last name, is in the email, your default rate actually tends to be lower. And then finally, what about how you type? Do you type like civilized people where you capitalize the first letter, or do you put everything in lowercase? So people who type everything in lowercase, the default rate is higher. And so these are just 10 very simple variables that you leave behind each time you access the internet and register on a website. And it turns out, if you look at a credit bureau score, right, the default rate, the difference between the highest decile and the lowest decile of credit bureau score, it's quite high, and that's good news for credit bureaus. But just two of these variables, suppose I take the Mac and a paid email account as opposed to Android, and a free dated email account, the difference in default rate is actually higher than the difference in default rate between the highest and the lowest decile of credit rating. And that is just two variables. So just taking these 10 simple variables, if you look at their predictive power of default, the credit bureau score has good predictive power, but the digital footprint does, as well as the credit bureau score. And if you put them together, you actually gain another 5%. You actually do even better. And so, this is for short-term consumer loans, but it turns out it holds more broadly that your digital footprint today actually predicts changes in future credit scores. And this makes sense. Your credit score is a historical-looking data point. My digital footprint captures me today. So if you've lost your job, start drinking, start shopping at 2 a.m., it'll show up in the digital footprint immediately, but it'll take time to show up in the credit bureau score. And so you actually see this, and we see that when a firm actually uses digital footprints, the default rates actually go down. So what are some of the implications? And again, there are many implications of the data on the web, the privacy and other concerns. But I'm just talking of a shallow digital footprint, and just about everyone has a website that you can harness from your own website. So there are at least a number of implications from here. So one, what does this mean for the information advantage of banks or financial intermediaries? So historically, we've said banks are special because they are better at screening, they are better at monitoring. And now what we're finding is a digital footprint is doing as well, at predicting default as a credit bureau score. And it turns out it does about half as well as the additional amount that you get from the internal credit rating of a bank, right? And think of how much time and effort, banks put into monitoring and screening and collecting information, and the lending offices, whereas the digital footprint just does this in a matter of seconds, right? So clearly the gap between fintech and traditional banks in terms of information advantage is going to be reduced, right? This raises a number of interesting questions, right? Should banks use such information? It's cheap, it's easily available. Should you use it? Related, would regulators let them use it, right? And so our traditional metrics of credit scoring, which is, your income, your job, and all the rest of it, here you're looking at things like what time of the day do you shop, etc. It has predictive powers, but do you want to allow that in the giving of loans? And then what is the durability of this information? Maybe it works today, but will it work tomorrow? Will it work 10 years from now? And then as people learn about this, do they start gaming it, right? If I know that, the time of day I'm going to shop makes a difference, or the, device through which I access makes a difference, do I start gaming it? And finally, how do these alternate sort of social credit scoring mechanisms perform through the cycle or in downturns? These are all important questions for the future of banking, right? Because if we're going to take this data and harness it and use it, we need to understand the implications. A second implication, an important one, is what about access to credit for the unbanked? So this is an important question. There are more than 2 billion working age adults who don't have access to banking. And so there's high expectation from digital footprints, right? And that is maybe these customers who don't have credit files or thin credit files, we can actually start giving them credit through the use of this data. And so when you look at the data, what we find in our sample is that there are a number of consumers who actually don't have credit bureau scores, but they have a digital footprint. And the digital footprint for these customers does as well as, or even better, as the digital footprint for customers who have credit bureau scores. So this gives you hope that now, you can give credit to people who are not scorable or have very thin files, right? A third big picture implication is what about the behavior of consumers, firms, and regulators? So there's the Lucas critique that once I understand something, right, then maybe I'm going to start manipulating it, and so maybe consumers would do that. On the other hand, the people who need, to understand this the best, the addicts, the digital addicts, if you will, right, maybe they're going to be less able to do it. So we all know, how to be healthy and fit, right? And eat well, exercise more. Half of America is overweight. And so if you're an addict, you pull out your mobile at 3 a.m. and you start shopping, and you're the one who needs help. Maybe you're not able to do that, right? And then, so as consumers, do we start masking how we behave on the internet? Just like in the old days when you'd go to a bank, you would put on a suit. Now you put on a digital suit when you sort of go online. And what about firms, right? So the hope is you would bank the unbanked. The challenge is, what about potential discrimination? Now, the Fair Lending Act doesn't allow you to use certain variables, right? Like race, with your minority, geography, etc. And so maybe you're not using these variables directly, but could you sort of get at them through the back door, through the power of data? And so this is also a concern that one needs to sort of think about. And so when we're thinking of the future of banking, right, and we think, the digital footprint, it is very useful for predicting payment behavior. Even the shallow digital footprint is doing remarkably well. So, think of what you can do with a deep digital footprint, and companies have done this where they say, give us your mobile phones, and they've found, People who walk the same route every day, they default less. People who call their mother every week, they default less. And so you can use all this to really build up a lot of default models, right? And there are many, many, important implications. So first, on the business model for banks, right? What is it and what should it be related to the questions that I raised? There's hope for access to credit for the unbanked. There are challenges for the behavior of consumers and firms in this digital sphere. So that concludes my brief presentation. Thank you.
So I think I'm next. Can you see the slides?
Yes, sir. Yes.
Okay. Perfect. Thank you very much. So thank you for inviting me to give a little presentation and then be on this panel on the future of banking. My focus will be on how do we think about regulating banks and shadow banks. And specifically, I'm going to talk about capital regulation, not because I think it's the only piece of regulation that we should be talking about, but simply because we have limited time. And I want to spend time on one well-defined question. And I think it's useful to start with a baseline view of how do we normally think about banking. The traditional view is that banks engage in what we call balance sheet banking. They take deposits, they hand out these deposits as loans, and then they hold these deposits as loans on their balance sheet. And banks are the one intermediary that does most of the provision of lending in the economy. So they're critical. Okay? And when we think about regulating banks, we're kind of trading off the following. Well, if we squeeze their balance sheet capacity too much, we're going to lose this amazing benefit of lending. But on the other hand, we will also decrease externalities of bank failures. And we will sort of decrease default rates of banks, which are problematic because, well, when we lend to bank, we don't internalize default. Okay? The implication of the traditional balance sheet model of banking is that anytime you have capital regulation, what you think is going to happen is you will shrink balance sheets of banks, and this will have a large effect on aggregate lending. Okay? I will present a set of facts that will challenge this view pretty strongly, and I think make us think a little differently about how we should think about regulation of, let me call it, the financial intermediary sector, as opposed to narrowly banking. Okay, here's the first set of facts. The first set of facts is on shadow banks from two of my papers. On the figure on the left, what you see is that 1/2 of residential mortgages nowadays are originated by non-deposit institutions, non-banks. Okay? And the market share of these lenders has been growing tremendously since the Great Recession. Okay? By now, more than half of the $10 trillion market of U.S. residential mortgages is originated by shadow banks. So banks are now the minority player in this market. So this challenges the view that, A, banks are the primary provider of lending in the economy. The picture on the right shows you something quite different, shows you how well capitalized these shadow banks are. So normally we think that we have to force intermediaries to hold a lot of capital through capital requirements. And that if we tighten capital requirements, this will lead to an incredible contraction in balance sheets, and it will result in a huge decline of lending. What I'm showing you from a second paper that I have with Erica Zhang and another set of co-authors is that shadow banks have over twice as much capital as traditional banks. What these two pictures should tell you together is, in the current U.S. economy, we already get lots of lending with very low leverage. This should challenge the view that capital requirements themselves are incredibly destructive to lending. Okay. The second set of facts I'm going to show you is on banks. And the idea that banks lend and then hold loans until maturity in their balance sheet is just not right anymore for the current generation of banks. And this, I know Phil Strahan was talking about securitization. Okay. What's important is that when we think about banks and we think about their balance sheet capacity, which is ultimately determined by capital requirements, we see pretty strong segmentation within the banking sector. What we see is that well-capitalized banks originate hard-to-sell loans that have to be held on their portfolio. But poorly capitalized banks don't necessarily lend that much less. What they do is, instead of lending and keeping loans on their portfolio, they choose to sell their loans. In other words, poorly capitalized banks, on their lending side, start behaving much more like shadow banks. Okay. So these are the two sort of sets of facts I want to start with and then ask, okay, if this is our current view, if this is our current world, what are the implications for regulations? Especially if when a bank's capital condition changes, it adjusts how many loans to sell versus how many loans to hold on the portfolio. Okay? Let's just start with a baseline. The traditional view is if you increase capital requirements, you shrink banks' balance sheet capacity, and that will have a large aggregate effect on lending. Okay? I already showed you that you can get a lot of loans in the economy with quite loose capital, with quite a lot of capital. But the second piece is, what would you imagine would happen if in the current environment you tightened capital requirements on banks? I will argue from work of mine with Greg Buchek and others that there's at least two adjustments that will occur that will significantly decrease the impact capital requirements have on aggregate lending. Number one is what we call the shadow bank migration margin. A bunch of loans that were not going to be made by banks will now go to shadow banks. More importantly, and I think this is one that was less intuitive, is there will be a big adjustment by banks. Banks, instead of originating fewer loans, they will tilt their portfolio to loans they can sell. Okay? They turn to originate and sell models. So what does that imply? It implies that if you had a standard capital requirements model in which bank balance sheet lending was the main game in town, the way we traditionally think about the world, then lending declines tremendously when you increase capital requirements from a baseline to, let's say, another 6 percentage points higher. In the mortgage market alone, you predict to lose on the order of $750 billion of lending, which is an enormous decrease in lending. What our work argues is that instead, even banks will decrease their lending much less, on the order of $250 billion instead of $750. So we're talking about a third decrease. Where is that difference coming from? It's coming from the change in banks' model. Banks, instead of lending on their balance sheet, will rotate and start lending off balance sheet loans that they can sell. The second margin of adjustment will come from shadow banks. Shadow banks will pick up some of the market share now not occupied by banks. So it is true, as we tighten capital requirements in the economy, you will get less lending, but substantially less than what you would imagine in a world that does not account for shadow banks, and a world that doesn't account for the fact that banks change their business model. So how do we then think about more broadly, how do we regulate a world in which the bank balance sheet model is dead? Okay, let me just put it out there. That means regulation has to account for two things. It has to account for the shadow bank migration margin. How much loans flow between banks and shadow banks when different regulations change. The second thing you have to account for is adjustment within banks. This idea that banks are nomadic, in which as you change capital requirements, this automatically flows into how many loans they make, should not be our dominant way of thinking anymore. Okay? And as we highlight in the work, where the shadow bank migration margin and the balance sheet retention margin act really depends on the nature of regulation. What I showed you was capital requirements. And when you think about capital requirements, the effects are smaller than what you would think because both of these margins contract the impact of capital requirements. This is not true for other regulations. So, for example, things like secondary market interventions, intervening in markets for sales, will have quite different effects. Because shadow banks cannot pick up the slack, bank balance sheets will do a lot more work. Okay? At the end of the day, that means we have to recognize both the IO of the market, how banks interact with shadow banks, and the bank business model to be able to think about a sensible regulation. Where does that bite? It bites, for example, when we think about regulation across countries. Right now, when we think about Basel regulation, we have broadly a, one-size-fits-all across countries model. What our work is showing is that the issue that arises is if your market does not have a well-developed secondary market, the way that US has, or doesn't have a lot of shadow banks, then the aggregate implications of regulations are going to be very different. Okay? Let me put down some concluding thoughts and stay on time. So how should we think about regulation of banks and shadow banks in the future? If I can observe in my data right now in the US economy that shadow banks can supply half the mortgages, but do so with twice the capital of banks, then what is the big benefit of bank leverage? If the benefit is not there, should we regulate leverage more tightly? If the benefit is there, where does it come from? Is it because bank liabilities are money-like claims? If that's the case, how big is that benefit to consumers? The second thing I want to leave you with is that secondary market operations, so things like unconventional monetary policy, start looking awfully like capital regulation on some dimensions. So that means we have to start thinking about secondary market operations in a similar way that we think about capital requirements. The third concluding thought I want to leave you with is distributional consequences. Once you start realizing that shadow banks and banks are partially partitioning the market between easy to sell and hard to sell loans, then different regulations affect different types of loans. So for example, in the mortgage market, hard to sell loans are loans made by wealthy households. Easy to sell loans are loans made to less wealthy households. When we think about certain policies, it would affect which households get the benefits and which households get the cost of the policies. So for example, tightening capital requirements mostly hurts households that get portfolio loans, wealthier households and households in places with high house prices like the coasts. Okay? Capital regulation now has distributional consequences. The second thing we have to think about, and I'm going to leave you with this hanging, is how do we think about stability of financial intermediation as opposed to bank stability? Up to now, we've mostly focused on the stability of banks, but if banks don't do most of the lending in the economy, is that still where we should be looking? Okay. And I think I'll leave you with that. Thank you very much.
Thank you very much to all our panelists. You raised some very interesting and provocative thoughts about what's going to happen to banking in the future. So if possible, I'd just like to throw out a few questions and to see whether or not you have any comments on these. So Jigwa, both you and Manju talked about the importance of information and how valuable it is. Do you have a sense of how regulation and the use of regulation should be regulated? Or just give me some sense of what the frictions are. So Manju, I would also turn that question as well over to you because you could well have a different perspective. And finally, Gregor, when it comes to information, how should this feed into your discussion of capital constraints? Because frequently capital constraints are conditional on what we think of as being a default probability, which, as the other two panelists have discussed, are potentially depend on the information set that you have. So I'll turn it over to the panel.
Right. Thank you. So let me just start with, I really just wanted to throw out some of my personal thoughts on it, because this is such a big, and in a way that you think about it, this type of question, which is the data regulation, often the time that there's always a country where you kind of get some experience and we see what's going on. But in this question, it seems like nobody had a really good clue, and really depending on the country's environment. So let me just first point out that part of the reason I wrote the paper on open banking is try to really bring the caution to the idea of so-called consumer consent. Often the time we will say that as long as you consumer consent, then everything should be fine. Unless, these consumers probably has some addiction, blah, blah, blah. What I think that, as normal economists are thinking, consumer consent itself, whenever you get into some information about your own quality, then all these things are not obvious at all. And often the time that, you just reveal it because you worry that if you don't reveal it, then you'll be treated differently. So all these things that we kind of well know, I do believe that the policymakers on the other parts of the sector probably also well know all these things. But for the bank side, probably, they forgot or they just were thinking about the capital more than the information. So all these things that I do think that it is a point that we need to sit together and take the economics as a very, very knowledge base where we kind of want to squeeze it into a different level so that it can guide our policy. So I'm not talking about privacy, but I'm going to end my comments for this particular question on this on China. In China, the data is clearly more on the competition side of it rather than the consumer side of it. In the following sense that if you have big techs getting all these data for free, in the beginning it's really for free. So thanks to some very smart entrepreneurs who understand the way the world is working in the 20 years, they started collecting all these data and they are utilizing it. And I feel like the government at this point is too late to come in, but late or not late, I think it's they're doing it better than late. In that sense, that I think that United States probably is at the right time to really think about these issues in a very careful way. I'm going to hand over to Manju.
Thank you. So I think there are a few different ways of thinking about this. So let me just raise some of them. So the first is, do I have access to the data in-house? So if you think of traditional banks and where their information advantage was coming from, it was coming in-house, right? Because I was doing the screening, because I have the deposit accounts, because I'm doing the monitoring, I can see all that. So if you have a firm that is combining, it does payments, and the payment sector now has just ballooned, right? It's massive. So I'm getting data from the payment sector. I'm getting data from, let's say, giving loans, short-term consumer loans or otherwise. I'm getting data from the transactions you're doing, etc. So if I have all this in-house, whichever entity has all this in-house is going to have a comparative advantage over a specialized entity, right? And we still haven't got to selling of data and stuff, right? So this is just, I'm using what I have in-house. So I think that's one thing to consider, which means different firms, right? Bigger firms or more integrated firms will just naturally have a comparative advantage as far as data goes. The second, which you referred to, is, is the sale of data. So there are all these issues of data privacy, and it's, can I sell them? And there's, of course, regulation sort of around it. And I think the third is, who owns the data? If I, as the consumer, own it, could I give it voluntarily? So just like I can give the information on my bank accounts to FICO, could I not own information about my transactions and give them to an entity, right? And that could help equalize the playing field at some level, right? But these are just three scenarios that I'm throwing out because they have very different implications for how things would look like. And with that, I'll turn it over to Gregor.
Yeah. So I guess, Christine, let me sort of play a little bit of, I don't want to say devil's advocate, but take maybe a slightly different view on this, which is one thing I'm not quite sure when I've started thinking about the banking literature recently. What I'm not quite sure is how much of our research and how much of our models that we have are shaped because historically, in the U.S. especially, but around in Europe as well, banks have housed all these functions. Banks happen to house payments and lending and so on. And I think we, maybe sensibly, but maybe not so, talked ourselves into the fact that therefore it is optimal that all of these things live under the same roof. And therefore there's strong complementarities between, let's say, information acquisition through payments and lending. Okay. Another view is, if I look around the world, I see plenty of lending being done by firms that don't have much of an information, advantage gained from standard banking relationships. Like I look at, half the mortgages in the U.S. are done by non-banks. So they really don't have this deposit information and other information and so on. So that's sort of the question I always have when I think of payments. It's true that, maybe sort of the payment processors are trying to get a little bit into the lending space. A little bit. But is that a first order thing or is sort of a second order consequence? So the question number one is, how much is information inherently important for financial decisions versus, we know Amazon really values this information to price discriminate, for example, to set prices well. Is banking special in that way, or is it all just about the fact that as I collect information, I can charge you the appropriate amount for the mortgage, even if I'm not worried about your default rate? I can charge you, I can sell the right credit card to the right person, and so on. And if that's the case, then it's not obvious to me that we should think about information regulation in financial sector separately from information regulation of Amazon or Facebook or Google or anybody else, even if they're not engaged at all in the financial sector. I don't have an answer, but it's sort of something I've been struggling with a little bit.
So just sort of to expand on that point a bit, and I'll sort of throw it out to all the panelists. So if it is not the natural state for all these things to be bundled together, how do we think that the banks of the future will look? Will they be substantially different? Will these functions be split off across different entities? What do we think is going to happen to the banking sector?
Ragnar, you want to start?
I can start.
This is your part.
So I think I think it's an interesting question. It'll come down on a couple of dimensions. As economists, we always go to, I think, in the long run, we'll get to some sensible arrangements that maximize at least surplus of the people doing the arranging. So firms will organize themselves in a way that will maximize profits, but hopefully with enough competition, this will also maximize consumer surplus. From that perspective, I could easily see both unintegrated entities specializing on lending and integrated entities where there are real complementarities between, let's say, information. Why I think the view of the future is difficult is I think a lot of the path will be determined by the regulatory steps we take on the way. And I think if we force, for example, fintechs to come under the umbrella of banking regulation, well, then we'll have banks doing everything in the future. If we force shadow banks to, at the end of the day, be as, follow the same capital regulations, but then take also deposits to stabilize them, then I think, in the end, banks will be what banks are with more modern technology. But if we don't, then it's very hard to predict from it. So I think maybe Manju's been, in a regulatory office for a bit, so maybe she has a better sense of where regulation is going.
I completely agree with you, Gregor. I think the big factor here is regulation, right? So there is market forces and where competition goes, and if you believe the information is valuable, then you might see, a natural consolidation of bigger and bigger organizations and housing all of this. If for some niche markets, let's say mortgages or very collateral-based lending, the information is less valuable, and that might indeed be a different segment in itself. But I think the key is the big elephant in the room is what is regulation going to allow, right? And that will fundamentally, I think, first order affect the nature of the market. Do you want all these things to be separate? Do you want to allow them to be together? Because it has many banks are so heavily regulated, right? And there's a century-old process, if you will, of how banks are regulated. Now, if fintechs come under that umbrella, the nature of that regulation might start looking quite different, right? And so I think it is an open question, and I think it's a very interesting question, and a lot depends on what people in this room and regulators such as the FDIC decide to do.
Can I make 2 points? One is that I fundamentally believe regulation needs to be taking into account economics. So regulation should be endogenous in response to prices, all these changes we know. Right. This is the first point. The second point is that I want to mention Ali's situation again. Ali used to be that all the boring stuff is done by bank, and they start to create their own empire, collect the data, and nobody deny that's not useful. That's very useful. They make loans, all these things, and now that they're getting to a situation that it is possible, and it's interesting to see that could Ali pass out their data, and those data being used by traditional banks. And in that way, it's actually is exactly what Christine and Gregor were saying, that in the end, is it possible that we have these two parts of the factory, and somehow they work in a reasonable, smooth way in the market, which I do think that it is possible from what I see in the
But the thing is, we should do the same thing for Amazon and Google and Facebook?
That's very different kind of
Is
thing.
it? I don't know. That's what my big question is. I'm not sure it is.
If you think about the market power, yes, I definitely agree with you. I thought that we are talking about whether, this is a Manju's point, that some of the data is in-house, and I do think that right now the good technology makes these soft things become hard, right? Those AI, whatever things. So in that way that I'm making my comments on whether it is possible to separate out.
There are a lot of fascinating questions in this arena. Let me just throw out one thing, because I think we're coming close to the end of our session. A lot of different countries are experimenting with regulatory sandboxes and different types of regimes. And the US has a complex regulatory structure, but at the same time it has deep and liquid capital markets. Do you think that these waves of innovation that we're seeing internationally potentially will leave the US behind?
Manju, do you want to start? We're going to hate here.
It's hard to say. I think it is true that different countries have different regulatory frameworks. I also think it is true that everyone is looking at each other, and what's happening in different countries, and there's some learning from there. So to the extent, the UK has sandboxes, and the US has its sort of a different system. So China has a different system, and maybe we don't completely understand what is the right system. In fact, I'm pretty sure nobody quite understands what is the right system. But insofar as we're all willing to learn from different experiments around the world so that we can converge on the right system, that would be good.
A very quick comment. I don't think U.S. is lagging behind. I was mentioning one example where Capital One played. I was so happy to see that the market played it out in a way that something that has to be mandated by some country, but in the United States, just the market is doing it. There's only one thing that I do feel that seems like the U.S. is hurting from that is on this debate over this CBDC. Now, different economists perhaps have different views on whether you should do that, but those are the things that in my mind is that those are the infrastructure should be provided through the government, and it's just that I'm pessimistic about how long they're going to take to have something along these lines.
So I sort of agree with Jigwa that where the U.S. is lagging is payments. I'm not sure that central bank digital currency is necessarily the right place to go, simply because it's so undefined. Right now, if you look at the debate, it's sort of, it seems like it's all over the place. But the payment space, I think, is one where the U.S. is quite lagging. Payments are both inconvenient and expensive. But in a lot of other dimensions, it's not obvious to me that the U.S. is so far behind the rest of the world. I think it's so the question is this a generation skipping thing? So maybe the world figures it out and then the U.S. can jump ahead to the new technology? Or is it that there is enough lobbying going on that we'll be stuck with a pretty inefficient and sort of costly technology for a long time? That one is hard to predict. But I think that's the one place for me where the U.S. is quite far behind. And maybe it'll move ahead.
So a lightning round. Predict. Be bold. Predict. What are U.S. banks and the banking system going to look like in 20 years from now?
Okay. Depends on what the regulators allow.
I think maybe, Christine, it's the wrong question. I think the question is sort of what kind of goodness, what kind of services will be provided by financial intermediation 20 years from now? Might be something that we're closer to asking rather than what's going to be living under a regulatory umbrella of banks. So I think that one, I think we might have a bit more hope of directing. I think, part of, I think, what finance has been doing, obviously, is what Manju and Jigo were talking about a lot, which is screening. But I think a big aspect of finance is, I think, providing good service. And by good service, I mean in the same way you get a good haircut or you get a good restaurant experience. You get a good experience getting a mortgage, or you get a good experience getting a credit card, and so on. So what I'm curious to see is, in 20 years, is the world converging to we're going to get the financial system providing services in a very efficient way, and it's very convenient and very sort of directed towards the consumer, or something we haven't talked about much, which is there's plenty amount of misconduct in the financial realm. Is financial technology just going to allow, financial intermediaries, at least in some parts of the space, to, extract rents from consumers? And that it's not obvious to me whether good competition wins or bad competition wins, or we have a segmented market in which technology helps on one but also hurts on the other. And I think that one's kind of interesting for me to think about.
And let me use my time to ask Manju a question, which is that if you were the regulator in the next 20 years, what do you think about it, the world will look like?
That's really putting me on the spot, right? So, let me put it this way. I'm glad I'm not the regulator. I think it's an extremely difficult question. I think there are many, many factors to be looked at. I don't even think I'd be so bold as to predict today. I think we would observe over time what's happening and probably, reach some sort of conclusion. I mean, would you think, so if you look at payment firms, right, the market cap of payment firms, I think, now exceeds the market cap of any other financial institution, right?
I just saw it in your paper. I didn't know that fact. That's interesting.
Well, I learned it only recently by doing this paper. And so I don't think any of us would have predicted that 10 years ago, right? And so I think the way the market is growing and the way things are going, there are so many things that we would not have anticipated So I would say wait and watch.
Okay. I think that's extremely good advice. It's intermediation is one of those topics that's absolutely fascinating. It's been fascinating since the 14th century or before. So thank you very much to all our panelists. There's a lot to think about, and we appreciate your comments.
Thank you, Christine.
Thank you.
Thank you, Christine.
Thank you, Christine.
Yeah.
Thank you.
Thank you very much. With that, we'll take a short break before our next session. Thank you, panelists, and thank you, Christine.
Thank you.
Good afternoon, everyone. We have a session on systemic risk and bank regulation, and we have 3 excellent papers in this session. And over to David, the first presenter.
Thank you very much, Anna. It's a pleasure to have the opportunity of presenting this paper. This is joint work with Tony Arnott, who's currently at the ECB, so the usual disclaimer applies. So I think the title of the paper is quite explicit of what we want to talk about. And we want to talk about bank runs, bank competition, and here there's no bank, but it's also banks' opacity choices. Okay? So basically, what we want to highlight is that, as we know, bank runs are an important phenomenon throughout history. And they're not important only because they affect the financial system, but because by affecting the financial system, they affect also the economy. Okay? And the main idea underlying this bank run literature is that investors, especially in banks, have the opportunity to withdraw their funds, and especially are going to do that if they feel that either the bank is in trouble of insolvency or if other investors, for whatever reason, withdraw. Okay? So basically, as we all know, this is not just something that was in the last financial crisis important. Here's, for example, an example of Northern Rock. But, this also happened in the previous Great Depression, and this is not only a European or Asian thing, it also happens across the Atlantic, in both sides of the Atlantic. So basically, what we want to try to highlight is, although we're going to be talking about banks, and we're going to use the word banks, we think that this is not something that only occurs in banks. You can see down here that basically it also happens in non-financial intermediaries, like money market mutual funds in the last financial crisis. And we want to highlight that we find that it's important to take bank runs into account because not only they affect financial stability, but in doing so, they affect real outcomes. Okay? So having established that understanding bank runs is important, we're going to focus on 2 elements that we think are very important that shape today's banking industries and that could affect, and we're going to show indeed affect, the occurrence of bank runs. One of them is bank competition. So there has been a wide change, and we just saw also in the panel that there's new elements on the banking industry, not only arrival of shadow banks and fintechs, but also mergers, acquisitions in the recent decades. This has changed dramatically the structure of bank competition, and we're going to talk to how that affects bank runs. And also another element that's also important is banks' opacity. So we know that banks are an opaque industry, banking is an opaque industry, and that banks have the opportunity to choose different complexities in their assets. So basically, we're going to try to understand how these opacity choices of banks feed into also these bank run decisions. Okay, so basically that's what we want to look at in this paper, and we want to do so, this is very important, through our intent, simple applied theory setup, in which these 3 elements that I talked, bank runs, bank competition, and bank opacity choices interact. And in doing so, this is going to allow us to derive both positive implications and normative implications that can guide regulation. Okay? So what's the main issue that we're going to look on? So basically So basically, we're going to have 2 different set of results. The first one is we're going to microfound what we call the competition fragility view of banking. So our model is going to provide the following intuition. When banks are competing more for deposits, this is very important. Our model focuses on the liability side. So when banks compete more for deposits, this is going to lead in equilibrium to higher deposit rates. And by having higher deposit rates, this is going to increase the incentives of individuals to withdraw, which then leads to higher bank fragility. Okay? And we also are going to microfund what we call is the transparency fragility view of banking, which works in the following way. If we make banks, or banks choose to be more transparent, what happens is that this feeds into higher deposit rates. So when banks are more transparent, deposit rates go up. And then by the same reason as before, given that deposit rates are higher, but individuals have higher incentives to withdraw, which leads to higher bank fragility. Okay? What's important is that for both of these results, as you can see, what's at the core is the change in deposit rates. So we need a model, and that's what we build, in which deposit rates are an equilibrium outcome of the model. Okay? So now, at the end, we are also going to talk about some implication of competition policy in this setup that basically tells us, look, there's some cost, as we can see here, of bank competition. If you increase competition, you're going to have high bank fragility, high bank runs. And on the other hand, you're going to have some positive effect of competition, the traditional higher net lending. In equilibrium, we're going to show that there's an interior optimum of bank competition that can be set, which basically means that in this setup, because of the endogenous deposit rate response, perfect competition in banking is not socially optimal. Okay, so that's are the main messages that we want to put in this setup. Now, what's important is that in order to derive, and I'm not going to have time to talk about this, I'm going to talk about the basic setup, but in order to endogenize bank's opacity choice, what we basically propose is a novel theory of bank opacity. And it builds on two elements. On the one hand, is this issue that we already talked about, that bank opacity, by affecting the deposit rates, actually changes the withdrawal decisions of investors. So because of that, banks want to be very transparent. However, there's a bad issue of being transparent, which we model through competition. Basically, we say, well, if you are transparent, this basically increases the probability of an entrant. Okay, we build the model, and the main idea is that the entrant learns better when you are transparent about your industry, which leads to higher entry on expectation. Well, because of this, the bank wants to be opaque, and this is the interior optimum. Okay, we can show, and I'm going to have time today, that basically banks, because of these deterrents, can choose to be excessively opaque, which then gives rise to transparency regulation. So if banks are excessively opaque, which basically happens if banks have high enough market power, then the economy would want to introduce transparency regulation that forces banks to be transparent and hence allow for higher entry. Okay? So that's basically in a nutshell what we want to talk about. Basically, we argue that our paper is linked to three different strands of literature, but mainly two of them. One is a traditional literature on bank competition and bank risk-taking. The novelty of our research is that we basically focus on liability side. So normally all this literature is on the asset side of the banks. Here we're modeling liability side of bank. And on the second part, there's this literature on ransom financial intermediaries, from the traditional Bryant and Diamond Dybvig setups to more global claims like Roche Vivers and Gostein Fauner. What we include to this literature is basically introducing asset opacity choices of banks and important also imperfect competition. Okay, then there's another element on bank opacity, but basically let me skip it for today. So let me tell you what we do in the one period model, which is the basic setup. So basically what we have is the following. We have basically a model of 3 dates, days 0, 1, and 2, and we have a single good, no discounting, and risk neutrality. What's the basic uncertainty here? The basic uncertainty is that the bank has access to a risky investment, and the return of this investment is unknown. And basically it follows a uniform. So you can think about the bank investing in an asset that the return follows between our lower bar and our upper bar. There's very little movement on the asset side, as I said. If we take this as given, what we want our model is the deposit side. And for that, basically what we assume is that there's going to be n number of banks. So this is going to be our competition measure, the n. And they're going to compete for uninsured deposits offering two elements. One is the deposit rate, D, and another is deposit opacity, delta. I'm going to explain both of these in a second. So basically, we're going to model a shallow model of competition. So you have bank 1 here, bank 2 here, and you have all investors here. We can show, and we'll show you in an extension, that exact way you model competition doesn't matter. The only thing that you need is that when there's more competition, interest rates react, and deposit rates, react. And that happens, as we can show, in different types of models. For today, let's focus on the shallow model. And basically, in this model, what you have is that the investor has some transport cost to the bank. Okay, you can think that this is either a taste cost or a more physical transport cost. Whatever you want, that's going to fit the model nicely. Now, what's important, what's interesting is the bank run set. What happens in our model? Well, we're going to have that there's going to be an endogenous amount of withdrawal W of deposits at date 1. Okay, so banks offer these contracts in date 0, and then at date 1, the investors, some of them are going to decide to withdraw. Well, what's important is there's going to be some costly liquidation of investors, of investment, which means that if the bank has to early liquidate, there's a cost side of this return R, so there's going to be a loss of liquidation there. And then the bank may be illiquid at day 1 or insolvent at day 2, depending on how many people withdraw in this interim period. In order to model bank runs, we're going to follow Rocher and Vives, which basically assumes that investors delegate the decision to withdraw to fund managers, okay, that have a benefit B if they get it right, which means they withdraw when the bank fails, and they have a cost C if they get it wrong, which is if they withdraw when the bank survives. Okay. Again, in an extension, we basically can show that this can be generalized, but for today, we're going to focus on this second. Now, what's the main game here? The main game here is a coordination game. I'm an investor. In this case, I'm a fund manager, and I have to decide if I want to withdraw or not. Well, if I know that a lot of people are withdrawing, I have more incentives to withdraw. If I know that little amount of people are withdrawing, I have lower incentives to withdraw. Now, how do we model these withdrawal decisions? So basically, we're going to follow global games structure. So we're assuming that each of these fund managers, I, is going to receive a noisy signal, and this is very important, of the real return that the bank has. Remember, R is going to be the return of the bank in period 2. Each fund manager receives this return, a signal that is this return, plus some noise, epsilon. Okay? And again, this epsilon follows a uniform. And here is where the opacity is very important. Basically, what we are assuming is that the bank can choose how opaque it is. If a bank is very opaque, what we're basically modeling is that it has a very high level of uncertainty in the signal. Yeah, you have a very wide range here of noise. However, if the bank is very transparent to the limit, let's assume that delta tends to 0, then basically all of the fund managers know for sure what the return is. Okay? So this is basically how we model opacity. It's the dispersion of the signal that the fund managers receive. Good. Once we have that structure, we just need to solve the model. Okay? So basically, just a brief reminder, what's the setup? At day 0, banks are going to compete for funds. They're going to offer the deposits and opacity choices. Both of these things are going to be observable by everyone. In day 1, the fund managers are going to decide to run or not. And once all of them decide to run or not, then either the bank succeeds or not. Okay, once the return is known. So we're going to go by backwards induction. So what's the equilibrium? First, we can show that there's going to be a traditional threshold equilibrium, like having this type of model, that basically tells the following. It's quite intuitive. If I'm a fund manager and my signal is very low, I'm going to withdraw. Okay? Now, what happens? Well, basically, you can show that when you aggregate all of these decisions, the bank is going to fail whenever the returns, VR, are below a given threshold, R star. Okay? Of course, these are endogenous elements, and we can show that they depend on the deposit rate. Okay? This is very important. And also on the opacity. But what's the interesting idea here that you can see here down in this bank failure threshold is that the higher deposit rates you offer, the higher is the default threshold. Why? Basically, the intuition is as follows. If I'm offering high deposit rates to my investors, when they withdraw, they are taking a lot of money out of the bank. Hence, the return has to be higher to allow the bank to survive. That's basically the idea. Okay? Now, what can we show? Well, with this graph, basically the main intuition of the paper, I think, is there. So what do we have here? What we're plotting here is what's the equilibrium withdrawals, W, depending on the return of the bank, R. Okay? And we're going to plot it for two different levels of opacity. The low level, this is the dashed line, and the high level of opacity. This is the bold line. Well, what happens? If you have a high level of opacity, the information is very dispersed. This means that people, even if your return is a given return, it's the same return, there's more people that think it's good or more people that think that it's bad. Well, what this means is that you have a lot of withdrawals, even in the cases, so if you look from R star to the right, there's going to be a lot of withdrawals, even if the bank returns are high. Why? Because there are some people that are receiving very bad signals because you're opaque. Okay? This is something that the bank doesn't like. Why? Because remember, if someone withdraws, you have to sell that asset as a loss. So the bank doesn't like this. However, if the bank is very transparent, what happens? Well, something important that happens because of the uniform distribution is that the default threshold doesn't change. Okay? So you're always going to default if your returns are below this R star. What happens is that the withdrawals that you receive change quite a lot. If the bank survives, that is R above R star, and you are very transparent, there's going to be very little withdrawals. Why? Because everyone knows, gets signals that are very concentrated on the real return. So that means that, very few people are going to go and withdraw. This is good for the bank because the bank doesn't have to basically honor withdrawals. There's very few of them, which means that the profits are high. Okay? So then this basically tells us that banks have an incentive to be transparent. Why? Basically to prevent withdrawals if they succeed. Okay? This is a very important element. Of course, the same happens in the opposite way if the bank fails. However, given limited liability, the bank doesn't care about all this stuff. Okay? You're a bank, and you say, well, I don't care of what happens when I hit. Okay? That's the basic gist of what is happening in
4 minutes.
Sir, yeah, 5 minutes?
4.
4, okay. So given this, we can solve the model. We can say, okay, given this structure, this interim structure, we can basically solve for the equilibrium deposit rates and opacity level. What can we show? Because of what I just told you, banks have incentives to be fully transparent, very, very transparent in this basic setup, and they can actually solve for the deposit rate this time. Okay? And they basically play with the effect of the traditional effect of if I offer a high deposit rate, I win more market, but here I also make it more prone that people run, so that gives you for an interior. Now, let me show you what I think is more fun of the model. Is once we have that, we can show what happens when the number of banks competing exogenously changes. Okay, we know what the equilibrium deposit rate. We can say, well, when you increase N, this increases D star. This increases the deposit rate in equilibrium, which then, remember that the threshold R, depending on this equilibrium deposit rate, given that the deposit rate goes up with competition, banks' fragility also goes up. Why? Because people have more incentives to withdraw in that sense. Okay? So that's basically this graph that you see here. You can see that when N goes up, the deposit rate goes up, and when N goes up, default probability also goes up. So that's the first message we want to send. The second message has to do with transparency, and we can show that in the same way, given that transparency increases bank profits, because of the reason we just talked, then when the banks are more transparent, they want to compete more for deposits. Yeah, there's more profit for them, so they compete more. This increases the deposit rate, which then leads to also higher default probability. Okay, so that tells us that, if we're increasing bank transparency, this can lead, because of the endogenous response of deposits, to riskier banking. Okay?
2 minutes.
2 minutes, perfect. We can say, basically, as we've told you, you can solve for the welfare of this economy, and we can just basically show that in this economy, perfect competition is not optimal. Why? What's the main idea? If banks compete a lot, the deposit rate is very high. This leads to a lot of endogenous runs, which basically, given that withdrawals are costly, that's not optimal. So you have an interior level of opacity. And let me just give you a hint of what we do in the rest of the paper. As I said, what we do in the second part is, okay, we take this model and say, well, what would happen if there would be endogenous entry decisions that depend on opacity? And we can show that in that setup, basically, and I'm going to skip the model, sorry for that, but basically what we can show is, in general, So this, in general, then banks are going to choose to be a bit opaque, some opaque. Why? Because basically they internalize that if they're opaque, there's going to be lower entry, which means that the future prospects go up because they're facing lower competition. Okay? Now, finally, in the extensions, we can basically show, as I said, that Cournot competition doesn't matter. You can go from Sharp to Cournot to different types of competition. All the results hold. What's important is the deposit rate reacts. And we can, this is just for people that are more in global games, we can show that our results actually under certain conditions don't depend even in using Roche-Vives. I guess that's only for the people that are into this literature. We could use Goldstein-Pausner. The same results could happen. Let me finish by saying, wrapping up, saying what we claim to do, and we hope that we do, is we build a parsimonious model that has imperfect competition, bank runs, and opacity. And we can show that when competition goes up, this increases the fragility of banking. Why? Because deposit rates go up, and then individuals have higher incentives to run. This is novel with respect to the asset side literature. And also we provide, although I didn't go into the details, another theory of bank opacity that basically trades off banks' incentives to be transparent in order to reduce withdrawals with banks' opacity, with banks' incentives to be opaque in order to reduce entry. Okay? So basically, that's what we wanted today. Thank you very much.
So thanks to the organizers for including this paper. This is joint work with Isha Agarwal at ABC, and the usual disclaimer applies. So the idea that triggered this paper was that the great financial crisis revealed that large and complex banks can be opaque, which led to a host of regulatory reforms, including stress testing in the US. So stress testing is a supervisory assessment tool which helps regulators better understand exposures over and above what typical accounting disclosures or standard forms of disclosures reveal. And this, in turn, helps regulators align capital requirements, requirements to meet risk profiles. However, there is empirical evidence to show that such assessments may not identify bank-specific risks correctly. Viral Acharya and co-authors, Thomas Philippon, have shown this in the context of the EBA stress tests. Plauser and Santos have also done this in context of US stress tests. So what is the implications of these potential imperfections or inaccuracies in these assessments for how capital regulation should be designed? And that is the research question we ask in this paper. So we follow a two-step approach. First, to understand how banks respond to regulation, and then regulation of our paper are that noisy assessments can lead to a moral hazard issue. It can create adverse incentives for banks, and which means that this overturns the conventional wisdom that higher capital requirements would always improve the risk-return profile of banks. So in other words, more skin in the game. We show that under information asymmetries, more skin in the game requirement can be counterproductive. What this means is that if the assessment accuracy in a stress test is below a certain threshold, capital requirements should not be bank specific at all, and a one-size-fits-all policy, a uniform policy, is optimal. On the other hand, if assessment accuracy is above a threshold, there is a phase shift, and bank-specific capital surcharges make sense. In fact, we show that these surcharges can be made more and more dependent on the stress test results as the accuracy of stress tests improve. So our paper is related to several strands of the literature. The most important is the one on supervision-based relations, assessment of bank riskiness, relation. And let me highlight one which is closer to our pursuit. This is Tony Annert's paper, where they also show a strategy should inform capital requirements. A key difference relative to that paper is the feedback effect that the ability feedback effect from the effort the bank exerts in managing its risk-return profile. More generally, our paper relates to the literature on how banks respond to regulation and what kind of incentives this generates. So, in a nutshell, the main contribution of our paper is to show that against the conventional wisdom, most being counterproductive, and that we draw the implications of this requirements. With that, let me go to the model that we develop in this paper. First describe the model that we develop. It's the simplest model that we can think of. We can develop to study these issues. With that, we then the regulator faces the crisis as a test of stress testing. So the model is quite simple. It's three-period model representative. It's pretty standard innocent household. The action is obviously on the banker's side, which has stochastic types. There is a government that runs a deposit insurance scheme and a regulator that sets capital requirements after conducting a stress test. So let me first describe the model without stress test. So the household consumes from an endowment and it deposits the rest in the bank. The bank on the first date, it chooses the effort that it wants to exert, which in turn determines its type on date one, the middle date here. And based on the type that nature chooses, depending on the effort that it exerts, obviously if...
So let me continue with the description of the model then. The banker on date one, the type of the banker is determined by nature depending on the effort that it exerts on date zero. And based on that, the distribution of returns on the assets is determined. The assets pay off on day two. The distribution here is denoted by psi, where G is the return function on the asset side. So the net cash flow on day two is then psi G K plus D minus RD, where RD is the deposit liabilities. We assume that there is deposit insurance, which ensures that the household always receives R, but this deposit insurance is mispriced. Which in turn rationalizes the role of capital regulation that the regulator sets on date zero, and this regulation is given as chi. So the banker's problem in the absence of any stress test can be set up as a recursive problem. So on date one, the value of the bank is based on the day two cash flow subject to a minimum capital requirement. And these value functions, depending on whether the bank ends up being of a high type or a low type, on day 0, that determines the effort that the banker must exert. So the main message from this is that the effort increases in the value wedge omega, where the value wedge is basically the continuation value on date 1 from being of a high type relative to the low type. This is a key result that I will use in the next for the next proposition. Now, having solved the bank's problem, the question is how the regulator sets the capital requirement chi in the absence of stress tests. And because it cannot observe the bank's type, it must choose a uniform requirement. We call it chi naught, which is basically the solution to this problem, where UH is the utility of the household in the case where the bank is of a high type, and UL is that in case the bank is of a low type. The next question is what the regulator would have done under full information, and there we prove that the optimal requirement for in case of a low type bank would be greater than that in case of a high type bank, and that the level of requirement chosen in case of imperfect information is it lies between the two extremes. So the regulator chooses a middle ground when it cannot observe the bank's type. Now let me discuss the transition to stress test. So going from uniform requirement to granular requirement. So the regulator receives a noisy signal about bank type on date 1, and an H-type bank generates a better signal for the regulator. Depending on the signal cutoff that is chosen by the regulator, then a bank is considered to have failed the test or passed the test. So because we assume that the high-type bank generates a better signal in terms of first-order stochastic dominance, it's clear that a high-type bank would fail less often. So to see this explicitly, once nature has decided the type of the bank, H or L, the regulator conducts the stress test, and based on the signal, an H-type bank can pass, let's say, with probability QH and fail with probability 1 minus QH, same for a low-type bank. And the failing banks would then face a higher capital requirement of X, in addition to the uniform requirement chi naught. Now, a couple of observations here. First, that if a high-type bank is, if an additional capital surcharge is imposed on a high-type bank, this is welfare decreasing, and this is because of the result we had here, that the optimal requirement in case of a high-type bank is less stringent. So a chi naught plus X for a high-type bank is basically imposing something that is further away from what is optimal in case of a high-type bank. Following the same intuition, chi naught plus X is basically aligning the requirement for a low-type bank closer to what would have been optimal in the case of full information, and this is welfare improving. So as you can see, the fact that the stress test is imperfect, which is implied by the possibility that the high-type bank can fail and the low-type bank can pass the test, it induces this trade-off for the regulator. So on the one hand, there is an alignment of regulations. There is a benefit of more granular regulation, but on the other hand, it can also reduce welfare in some cases. What does that mean for the incentives for the bank? We show that a banker's effort may increase or decrease as a result of this higher surcharge, depending on the accuracy of the test. So if you recall, the effort is a function of the value wedge between the high and the low state for the bank. And in the presence of stress test, this wedge which was simply, just to remind you, in the absence of stress test, the value function wedge was given simply as VH minus VL. In the presence of stress test, it becomes a function of the probability that a high-type bank can pass or fail the test. Now, here is the trade-off. If QH is low, then a penalty can basically lower the expected value of a high-type bank by a lot. And ceteris paribus, a surcharge of a capital surcharge is more costly for a high-type bank because of the greater foregone opportunity. So high-type banks' assets are more productive, and therefore a capital requirement is basically a more costly in shadow value terms for a high-type bank. So depending on the accuracy, which is determined by QH and QL, this value function wedge EVH minus EVL can actually be lower and induce the bank to exert less effort in response to a higher capital surcharge. So
4.5 minutes.
Thanks, Ben. So this figure summarizes the discussion we had so far. That so on the x-axis I have QL, and on the y-axis I have QH. So these are the two dimensions of the accuracy of a stress test, and we proved that below this diagonal line, which is given by an analytic linear combination of the type 1 and type 2 error rates, the optimal surcharge is 0. Above this line, the optimal surcharge is positive. But even then, there is a trade-off, because for combinations of QL and QH below the dotted line, as the surcharge increases, effort still decreases. And above that line, surcharge and effort go hand in hand. So we take this model to data and calibrate it on using banking data from 20 countries to make it more representative, and we confirm our analytical results in the calibration. So here, on the z-axis, you see the optimal surcharge as a function of QH and QL. So basically, this underscores the phase shift that we see in terms of accuracy. The next step is to endogenize accuracy. So far, we assume that accuracy is given exogenously, but obviously a regulator can redesign the stress test to improve its accuracy. Now, we explore two cases here. One, when it's possible to improve accuracy along both dimensions simultaneously. By both dimensions, I mean reducing both type 1 and type 2 errors. And in this case, and this is intuitive, we show that as the cost of increasing accuracy decreases, the regulator must increase accuracy as well as surcharge simultaneously. But the more interesting case is when it's not possible to improve accuracy along both dimensions, and the regulator can improve one type error, but at the expense of worsening the other. And this creates a dichotomy between the cost of accuracy and surcharge, and we show that it is possible that while improving the overall accuracy, the surcharge, the optimal surcharge may have to be lower. So again, going away from more granular requirements towards more uniform requirements.
1.5 minutes.
Yes, please. So I do not have time to discuss some of the additional policy trade-offs in detail, but the main point here is that if stress test results are disclosed, which is typical, then this would exacerbate the mechanisms that I have described. The same thing would happen if bank failures are more costly or disproportionately costly in size, which is the case for larger banks, more complex banks. And both of these would amplify the channel, the adverse effect channels that I described. So COVID-19 as a test of stress test, the main thing we want to point out is that we compared how banks performed in the stress test just before COVID-19 struck in 2020 to their actual performances, and we provide some we provide some suggestive evidence of potential inaccuracies. As you can see here on this right-hand panel, the stress test performance is not only more variable than the bank's actual performances during the COVID-19 crisis, but there is very weak correlation between the two. So just to wrap up, we show that in contrast to conventional wisdom, more skin in the game by a higher capital under uncertainty may not lead banks to behave in line with what the regulator wants. And as a result, regulators must use with caution the results of stress tests depending on how accurate they are. Let me stop there. Thanks.
All right. Thank you. First, we want to thank the conference organizers for including the paper. This is a joint work with the FAN, also from OCC. Therefore, the following disclaimer applies. The views in this paper do not represent OCC or any regulators. So let me start with a basic discussion of the main research question and some main results. While the prior two papers are theoretical, this paper is pure empirical. And we ask an empirical question, which is about existing tail risk measures. Our question is, do existing tail risk measures have incremental predictive power beyond the global financial crisis? And we have two findings. The first finding is that it turns out market measures such as the beta market value of equity have incremental power not only during global financial crisis, but also beyond the global financial crisis. However, we also found accounting measures such as short-term funding can help understand underlying mechanisms. And for today's presentation, we will start with motivation, then data methodology, then results, finally some conclusions. So let me first talk about what is the motivation of this paper. By now, after the first two papers and also many other papers at this conference, it's easy to understand that tail risk is very important for banks. Therefore, it's important to understand not only the channels or mechanisms, but also it's important to understand how to measure the tail risk. And in particular, as the prior paper showed that in regulation space, when we do a stress testing or when we do capital requirements, they all have something to do with tail risk. So if we look at the literature after the global financial crisis, we can see that many measures were proposed. And for instance, some measures we refer as channel specific because they focus on specific channels. For instance, we have this paper talking about short-term funding. We also have papers talking about asset and loan growth. We also have papers talking about non-interest income. The first paper from a theoretical perspective talking about deposits or funding side. So these are what we refer as channel-specific measures. But we also see some aggregate measures. They focus on aggregate accounting or market performance of banks. So for instance, we know MES, or more recently, bank profits from Mesoman et al. So one observation we have about these measures, is that all these measures seem to be largely motivated by one financial crisis, which is a global financial crisis. Therefore, it's not really clear if these measures would still have empirical power beyond the global financial crisis or not. And also, as we have discussed, we have both channel-specific and aggregate exposure measures. It's also not clear if all these measures all have incremental predictive power, because if the market is somehow efficient, or if the banking sector is competitive, we would expect that market measures or accounting measures, aggregate accounting measures, would capture the effects of some channel-specific measures. For instance, relating with the first paper, if banks take risk through deposit channel, the motivation would be to earn high profits, right? And therefore, we could see that not only through the deposit channel, but also through the bank profits. So based on these two observations, we basically ask some very simple empirical questions. The first question is, if all these measures are motivated by the global financial crisis, do they still have any power beyond that particular crisis or not? And second, if aggregate accounting and the market measures may comprehend all the information available, or do channel-specific measures still have incremental power in prediction? So these are the two questions, empirical questions we have in this paper. And let me next briefly discuss the data we use. So first, in terms of bank universe, we focus on all the banks in this mapping maintained by FRB. And so for this mapping with about 1,400 banks, we merge their daily stock returns from CRISP with the annual accounting information from Compustat fundamentals. We did not use a Compustat bank because Compustat bank, it turns out, does not cover some major banks such as Citigroup, Goldman Sachs. However, we do supplement Compustat fundamentals with information on charge-offs from Compustat Bank and risk-weighted assets from FR1IC. And if we look at the Compustat sample, the number of banks is very small prior to 1972. So following prior research, we focus on the post-1972 period. In our case, it would be 1972 to 2020. So that's the data we use. In terms of methodology, we follow this recent research by Misoman et al. And so we take a very simple cross-sectional regression approach. The idea is that if a measure is informative about the tail risk of banks in the crisis, then we should be able to use its pre-crisis value to predict the performance of banks in the subsequent crisis. So that's the idea of this simple cross-sectional regression. And again, the exposure is measured prior to a crisis, and bank performance is during the banking crisis. And if a high risk exposure prior to the crisis means poor performance during the crisis, we expect the coefficient to be negative. So, and also since, as you will see, we will take into account a large number of measures to make comparison easy, we standardize all the variables. Now, let me talk about each component of this regression model, how we measure the performance of banks in crisis and how we measure exposures. So first, let me briefly talk about how we measure the performance of banks during a crisis. In some prior research, economists use the average stock returns during a financial crisis as a measure of a performance of banks during the crisis. And we compared basically, for instance, on this slide, the distribution of daily returns during the global financial crisis, which is this flat curve here, and also the distribution of daily stock returns prior to the financial crisis. And the two vertical lines here, if you can see, really represent the mean returns during the crisis and prior to the crisis. And as we can see, we also can test, the mean returns are not really statistically different. What differs is the distribution. In financial crisis, the distribution is much wider because not only we have lots of negative tail risk, but we also have lots of positive tail shocks. Therefore, follow this recent research by Musselman et al. I will use MNP to refer that the paper. We consider a different measure to measure the performance of banks during the crisis, which basically is still average returns, but not average returns over the entire financial crisis, but only average returns on the 5% worst days for the entire banking industry between 1926 and 2020. Therefore, we are focusing on really the tail days in this distribution. So let me give you guys some ideas. So on this slide on the left, we show the number of we call bad days, or the 5% worst trading days between 1926 and 2020. And as we can see, all these bad days pretty much concentrate in downturns. For instance, the global financial crisis or the recent pandemic. On the right, we also show the average returns of bank stocks on those tail days. On those tail days in each year, we also can see a very strong pattern on tail days. We see very strong negative returns. This is in comparison to the average returns over the entire crisis we saw on the price slide. Therefore, in this paper, to measure the performance of the banks during the crisis, we use their average returns on very worst 5% days. So that's our measure for the dependent variable. In terms of the independent variable, we consider a large number of measures. So for instance, again, we take into account aggregate measures based on accounting and the market measures. So for instance, we have MES. We also have bank profits based on this recent paper by Musselman et al. But we also include beta, the simple capital asset pricing model beta, because prior research has shown beta is strongly correlated with MES. And we also know that beta has a very intuitive economic interpretation, but MES is based on statistical theory. Besides the first three variables, we also include the market value of equity, because we know large banks behave differently from small banks. We also include the risk-weighted assets, as the first two papers kind of also indicate. After 2011, under Basel III, we know some banks use internal models to estimate their risk. Therefore, if they have special information or inside information, RWA may also have incremental power. On the other hand, we also have a number of channel-specific measures. For instance, we include popular asset growth and loan growth over prior 3 years. We're also including funding set variables, such as short-term funding, asset set variables, such as illiquidity of assets. That's what liquidity here means. Maybe a little confusing, but it measures illiquidity of assets. We also have non-interest income emphasized in some recent paper. And finally, we have a basic capital or leverage in both book terms and also market terms. Let me just emphasize that since asset growth and the loan growth are strongly correlated, so in the regressions we will show you guys, we only include one variable. Similarly, book leverage and market leverage in many cases are strongly correlated. Therefore, to reduce the econometric problem in the regressions we will show you guys, we only include book leverage. So essentially, the idea of, as just quickly summarize, the idea is to use those measures you guys just saw, measured prior to crisis, to predict the performance of a bank during subsequent crisis, measured by their average daily returns on the worst 5% days. Now, another question is that how do we define a crisis? In this paper by Musselman et al., they focus on three crises: the mortgage crisis, S&I crisis, and the Russian crisis. And they define the starting date and also ending date. We do not have much expertise in terms of chronology of a financial crisis. So what we do is that we rely on this recent paper by Baron et al. In this paper, they define financial crisis or banking crisis based on equity returns. and we thought it's more relevant for our measure of a tail performance. So we use their chronology. So in this paper, they identify 3 crises in the U.S. after 1970, with the starting years of 2007, 1990, and 1984, which seem to correspond to prior research and also the crisis, global financial crisis, and savings loan crisis. Since this paper does not identify the ending dates for this crisis, we consider 3 alternative windows: 1 year, 2 year, or 3 year windows. So, for instance, for the financial crisis of 2007. We basically use the exposure measures calculated in 2006 to predict banks' performance over these 3 alternative windows. And again, our main measure is the average stock return, daily stock returns on just the worst tail days. In the sake of, for the interest of time, I guess I will skip most tables to just jump to table 7, in which we put all the measures together. So we skip all the sequential analyses. And in this table, we do not include MES. We include MES in a different table. Why? Because MES and beta are strongly correlated. Again, we also only include loan growth, not asset growth. We put also only book leverage, not market leverage. The first observation from this table is that here we have 2 sections. Essentially, each section here represents one crisis window. The first section is a crisis window of 1 year. The second is a crisis window of 2 years. We drop the crisis window of 3-year results because they are consistent, and we want to fit the table on the one slide. And in each column, the year indicates the crisis we are studying. For instance, in column 1, we have 2007, which indicates we are looking at the 2007 financial crisis. When we use a 1-year horizon, essentially we are predicting the performance of banks in 2007 with the exposure measures calculated in 2006. So first observation you guys can see probably is that for all the channel-specific measures, they are either statistically or economically insignificant when we go beyond the global financial crisis, also when we include the market measures or accounting aggregate measures. None of these channel-specific measures are consistently economically and statistically significant. And that's first observation we quickly can see. The second observation is that it turns out that some market measures, like a beta in this case, and also market value of equity, seem to have consistent incremental predictive power beyond even global financial crisis of 2007. As we see, they are also statistically and economically significant beyond the 2007 crisis. So, for instance, remember, each number, all the variables are standardized. Therefore, all the impact is in standard deviations. So, for instance, in column 1, the beta's impact means a 1 standard deviation increase in beta is predicting a half the standard deviation decrease in the performance of banks on the worst days. So that's pretty economically significant. We also have variance decomposition at the end of the bottom table based on type 3 sums of square errors. And they also can tell us the same story. Market measures have a significant also economic predictive power. Sure. So I guess we can quickly summarize the main finding from that table in the sense that market measures are informative. Why is that? Where we know that, first mechanically in financial crisis, a major shock is decreases in market returns. So beta captures that mechanically. That's very obvious to see. Second, we also know from prior research, market value of equity tells us the different behavior between large banks and small banks. Third, we also want to emphasize again, if the market is efficient or the sector is competitive, we expect these measures to have information because they will aggregate all the channel-specific effects into one measure. To put some support for that explanation in the paper, what we did was to look at the correlation between the aggregate market measures and channel-specific measures prior to each crisis. So, for instance, for 2007 global financial crisis, we look at 2006, and we look at if a market measure is meaningful based on the channel-specific measures. Whereas we can see market beta in the first section is correlated with several channel-specific measures, suggesting high beta banks also have more illiquid assets. They use also more short-term funding. They also have more income from non-interest income activities. Therefore, it provides some economic mechanism for the measurement of these market measures. Let me just jump.
1 minute remaining.
Sure. Let me just jump to maybe one more table here. So the results in this paper seem to be inconsistent with the prior research, because some prior research finds that the growth in the loan growth is a strong predictor of banks' stock returns. We emphasize our results are not inconsistent with those because they focus on average returns, where we focus on tail returns. If we run the average return regressions, we get the same results. Finally, if we use the market measures to predict charge-offs or accounting measures, we still see significance. We also can use a loaded model to predict the high-risk banks. So I will stop here, and since the conclusion would be the same, as I mentioned many times. Thank you.
Good afternoon again. My name is Anna Chernovai, and I would like to thank the authors of the papers for presenting their recent research. I enjoyed reading all 3 papers. The first 2 were theoretical papers, and the last one was empirical paper. I will start by giving a background and talking about the common theme in the 3 papers, and then I'll provide a non-technical overview of every paper and offer some of my own comments. So, in the last several decades, banks have grown substantially in size and complexity due to digitalization, financial innovation, globalization, and increased merger and acquisition activities. The size of the banking sector has grown disproportionately in relation to the real economy. And just to give you an idea, between 1970 and 2015, the total assets of 50 biggest banks worldwide grew from 15% to 83% relative to the world GDP. Big banks gotten even bigger and are covered by implicit government guarantees because they're simply too big to fail. And essentially what happens is that the risk of failure for the biggest banks is being shifted from the banks themselves to the government and taxpayers. 2 big questions to answer in the area of systemic risk and regulation of banks are, the first question is, are banks contributing to systemic risk? Here, what we're interested in is the negative externality to the overall economic system in case of a bank's default. And the second big question is, are banks exposed to sources of systemic risk and the contagion? And here we're interested in the exposure to common risk factors that can trigger defaults. To limit banks' contribution to systemic risk, regulators design measures to reduce individual default risk, such as by establishing capital buffer requirements and conducting stress tests. And banks' exposure to systemic risk can be addressed with measures aimed to reduce their common exposure, for example, by putting restrictions on certain banking and business activities. The common theme of the 3 papers, I would say, is bank complexity and opacity. The essence of the first paper is that banks are getting more complex and more opaque. As a result of that, market discipline becomes less effective and stress tests are becoming more noisy, which is the focus of paper number 2. This increases incentives for banks for risk-taking behavior and to grow beyond optimal size. And as a result, measurement of tail risk and predicting banking crisis is becoming more and more difficult, which is the essence of paper number 3. So the first paper, A Bank Runs, Bank Competition and Opacity by David Martinez-Miera and Tony Unhert, poses the key question as how do changes in bank competition and bank opacity affect bank fragility? The motivation for their research is that bank runs pose a threat to financial stability, and the goal of the paper is to understand how the following developments in the financial system affect bank fragility. Bank competition has changed due to developments in technology and regulation, such as fintech and financial deregulations in late 1990s. And opacity has increased due to more complex and more opaque assets, such as due to the repeal of the Glass-Steagall Act in 1999, and also introduction of new accounting standards and regulations, such as the Pillar 3 of the Basel Capital Accord and Dodd-Frank Act of 2010. Competition, so this is a theoretical paper, and the competition in the model is measured by the number of banks, and competition is taken to be exogenous. Higher bank competition means that banks choose higher deposit rates, and this is a diagram from the paper. We can see that deposit rates increase with the number of banks or the competition. And here what happens is that banks are facing a trade-off. On one hand, by choosing higher deposit rates, they are securing a higher market share. On the other hand, they are experiencing lower profits per unit of their deposits. With regard to opacity, what is meant by opacity in the paper? Opacity takes place when banks invest in more complex assets or when banks adopt less transparent accounting styles. As a result of opacity, investors receive noisier signals about realized investment returns. Opacity is endogenous in the model, and banks face a trade-off when making their opacity choices. Higher opacity reduces the sensitivity of withdrawals with respect to realized investment return. Higher opacity also comes at a cost. There are more withdrawals from a solvent bank as a result of greater opacity in the system, which results in increased bank fragility. And in the model, higher opacity also means fewer withdrawals from an insolvent bank. As a result of higher opacity, banks see lower expected bank profits and lower expected return to investors. And because of that, banks have the incentive to become more transparent. Higher opacity also has its benefits. Opacity reduces competition by lowering the incentives of new banks to enter. So higher opacity means lower future competition and higher future market share for the incumbent banks. And incumbent banks' profits are increased, which leads to lower future fragility. The paper essentially shows that competition and opacity are interlinked. Bank opacity choices affect future competition in the industry, and current competition affects bank opacity choices. Regulatory implications are discussed as well. When competition upon entry is high, it's a typo, incumbent bank chooses high opacity, but the regulator imposes high transparency to increase net lending in the overall economy. External shocks that increase transparency lead to higher entry rates and higher deposit rates, but this also results in higher fragility. And the paper essentially hints that intermediate level of bank competition is socially optimal, which also echoes the results from the second paper that we'll go over later. So some of my comments, when you motivate the paper, because this is a theoretical paper, it would be nice to back it up with some empirical evidence at some point early in the paper. So I would like to see in the introductory section some anecdotal evidence on the link between opacity, competition, and fragility. Also add discussion relating the paper's insights to some recent regulations in banking. Provide some concrete policy recommendations, and in particular, I would like to see some regulatory implications for systemically important banks and too big to fail banks. Paper number 2, Limits of Stress Test-Based Bank Regulation by Tirupam Goel and Isha Agarwal. The key idea of the paper is that supervisory risk assessment tools, stress tests, aim to increase financial stability. However, they are noisy measures about bank-specific risk exposures and capital adequacy, and therefore may lead to riskier banks. This paper is also a theoretical paper, and the authors develop a theoretical model to study how banks respond to capital requirements that are potentially imprecise signals about banks' true risk. Regulators in the model are not observing a bank's true type. The paper studies trade-offs that a regulator faces in making risk assessments more accurate, and policy and welfare implications are also discussed. From the insights of the model, we can see that noisy risk assessment reduces the overall social welfare. Because of higher opportunity costs to a high-type bank, the banks get an adverse ex-ante incentives to reveal that they are a high-risk bank. And because of the extra noise, there are higher capital requirements because of the noise may lead to more risky banks. And the paper advocates for less tight regulation, which echoes the results from paper number 1. The paper also talks about the impact of disclosure of stress test results. When stress tests are accurate in identifying bank types, then disclosures improve market discipline and therefore surcharges become optimal. However, when stress tests are noisy, disclosures lead to greater risk taken by banks and therefore surcharges are not optimal. And the model shows that when the signal quality falls below a certain threshold, then the optimal surcharge is actually 0. Something that I really liked about this paper, toward the end they have section 5, which is an empirical illustration of the noise inherent in the 2020 Dodd-Frank stress test. So this diagram from the paper shows that cross-sectional variation in the changes in banks' common equity tier 1 ratios from the stress test is much higher, as you can see along the horizontal axis, than the observed changes during the COVID-19 year, which is year 2020, and you can see those changes along the vertical axis. And the correlation between the two CET ratios, changes in CET ratios along the horizontal axis and the vertical axis is close to 0. So my comments, so this last section that I just described that I liked about the COVID-19 crisis, a test of risk assessment tools, I would recommend to move this section very early to the beginning of the paper, right after the introduction, turn it into section number 2, because this can be used as a preliminary evidence that's suggestive of the noise inherent in risk assessments. This is how I would recommend to motivate the paper before you actually proceed with your model. And it seems like nowadays it's almost like a trend to start with some preliminary evidence before you actually build and present your own model. Also, on more technical note, in the paper, it's not very clear what you actually mean, what the authors actually mean by high type and low type banks. I searched high and low, but I did not find a clear definition. Do high and low refer to risk levels, capital surcharge, noise quality? This definitely needs to be clarified in the introduction with a proper definition. Then more broadly, with regards to implications, so what's the next step? How can stress tests be improved? What should be modified in the theoretical model to provide more accurate risk assessments of banks and better stress tests? And maybe an interesting question would be, can the noise inherent in stress tests be actually used to make banks or force banks to reveal their true type? Paper number 3, Measuring Systematic Tail Risk Exposure of Banks by Ding Du and Feng Li. It's an empirical paper, and in a nutshell, what they do is they try to answer the question, what are the key sources of systematic tail risk exposure of banks? And they find that market measures such as beta, market cap, expected shortfall capture most of tail risk exposure. The paper argues that accounting measures such as return on equity, risk-weighted assets to total assets ratio, non-interest income, leverage, liquidity, they capture not only systematic risk but also idiosyncratic risk, but in contrast, market-based measures are better at capturing systematic risk. The finding that risk-weighted assets are only marginally significant in explaining tail risk of banks echoes findings from the second paper on the limits of stress tests. This is an empirical paper, and they use a sample period of almost 100 years between 1926 and 2020. They test empirically using 3 banking crises around 1984, 1990, and 2007. And by bad days, they define days that are the worst 5% of trading days returns during the sample period for the banking industry portfolio index. They find that the market cap measured by the natural log of market value of equity is the most informative about the systematic tail risk exposure of banks with the adjusted R-squared of 0.39. One question here is that isn't this result sort of obvious because the left-hand side variable is equity returns. Then the expected shortfall is second best with the adjusted R-squared of 0.34, and beta is third best with the adjusted R-squared of 0.30. The paper suggests, so these are my comments for the authors now, the paper suggests that accounting measures such as return on equity, risk-weighted assets, non-interest income, leverage, liquidity, capture not only systematic risk but also idiosyncratic risk. This statement needs some clarification and further discussion because don't market-based measures actually capture idiosyncratic risk as well? Market-based measures are much more commonly used in literature to capture idiosyncratic risk of firms and banks. Another issue with accounting measures is that balance sheet measures are generally considered to be sticky and measured on a quarterly basis. Balance sheet measures also have a drawback that they capture risk after it's realized. Therefore, they're not forward-looking and may not capture systematic risk well. As the bank gets more complex, balance sheet performance measures may temporarily improve, so the balance sheet performance may look great, and so weaknesses in risk management may show up in the balance sheet with a delay. With regard to market-based measures, although they are considered to be forward-looking, they also have some issues such as asymmetric information in that investors are not fully aware of all risks taken by the management and implicit government guarantees and other confounding factors. I would like to see comparison to other existing measures of systematic risk. Okay, two of the ones listed here are already used in the paper. I apologize. So one is delta COVAR, marginal contribution of a particular institution to the overall systemic risk, systemic expected shortfall, lower tail dependence, S risk. So I would like to see comparison with some of those existing measures. I would like to also see some comparison between the results for smaller banks and too big to fail banks. Here, the expectation is that implicit government guarantees may weaken tail risk for too big to fail banks. It was not very clear both from your paper and from the presentation, you showed an equation which did not include control variables, but then in the tables that were shown, it seemed like all of the systemic risk measures were included in the same models. It was a little bit confusing and not clear to me, so I would definitely clarify this. I would like to know if control variables were actually used in the models or not, and also it was not clear if you had bank fixed effects in your models. Does your model also work out of sample? In summary, summarizing the common theme of the three papers in this session, the common theme is bank complexity and opacity. The essence of the first paper is that banks are getting more complex and more opaque. Market discipline becomes less effective and stress tests are becoming more noisy, paper number 2. This increases incentives for risk-taking behavior and to grow beyond optimal size. And measurement of tail risk and predicting banking crisis is becoming more difficult, which is the essence of paper number 3. Okay, I think I'm perfectly on time, 19 minutes. Thank you. I think all three papers are great, have a strong potential. I enjoyed reading them all. Thank you again to the authors.
Thank you very much to our discussant and to all of our presenters. With the time left, I think I'll give each of the presenters a minute or two to respond, wrapping up at 3:25 Eastern Standard Time. So if you would go in order of presentation, David, Tirupam, and then, David, Tirupam, and then Ding, to give a minute or two response, and then we'll move to break.
Thank you very much, Anna, for your explanation of the model. Just gathering I think that it's good if we can give a bit of more evidence. I think anecdotal evidence also always helps. And yeah, I think that the only point is what your comment about doing too big to fail and systemic important banks. In the current setup, it's a bit difficult to do given that this type of models normally have symmetric banks. So, we can think on it and probably we'll try to see if there's a way to incorporate some of that suggestion. But currently it's a bit difficult by the way this type of models work. Thank you very much.
Thanks, Anna, as well for the very nice review and the comments. Your point about using COVID-19 as a motivation is well taken. We kept it at the end, given that it's suggestive evidence in its current shape in the paper, but we can obviously make it more formal and put it up front. On your question about what is meant by high type and low type bank, a high type bank is one that has a higher risk adjusted return relative to a low type bank, and we can certainly clarify this. You raised a very nice point about can the noise in the stress test be used to elicit actually better response from the bank? And this reminds me of a comment from Chairman Powell about the need to maintain an element of surprise in stress testing so that banks are unable to game stress tests. We have thought about this and especially how to distinguish between noise in the signal that the regulator receives as opposed to introducing a surprise element. Because after all, the point we are trying to make is that if there is noise, then it can lead to adverse incentives. And the question that we should think about, as you rightly pointed out, is also about how we can introduce surprise element in a way that actually overturns the effect, the adverse effect of noise. So point well taken. Thank you. I'll stop there.
Hi, this is Ding Du. Thanks very much for the comments. They are extremely useful. And Fan and myself, we will be working on to improve the paper based on the comments. Only quick response we would provide is that we needed to significantly increase probably improve the exposition of the paper. As of now, I guess it may be not so clear but empirically we are running a number of cross-sectional regressions, including Farmer-Macbeth regressions. We are now running panel regressions. That's why we don't have panel firm bank fixed effects. But for other questions and comments, they are extremely helpful, and we will think through and include the paper. Thank you, Anna.
Thank you, presenters. Thank you, Anna, for discussing the papers. With that, we'll move to a 10-minute break before joining for our last paper session at 3:35 Eastern Standard Time.
Welcome back, everyone, to the last session of this great conference. I'm Mark Carey, and we're going to hear today about two great papers from two great economists, one Denise Onganay and one Ai Ha. Denise, take it away.
Okay. Here we go. All right. Well, thank you very much for the invitation. This is joint work with Carl Harzl, Yuan Li, and Ray Zhang, all colleagues of mine at SFU. So what we do in this paper is investigate how negative news coverage of borrowers' impact on climate change affects bank loan contracting. So our focus is on how media coverage of adverse climate incidents of corporate clients of banks impact the bank's lending decisions. So over the past couple of decades, banks have been coming under increasing pressure from customers, investors, and regulators to incorporate climate change concerns into their lending decisions, and also to divest away from so-called brown, carbon-intensive, and polluting industries. And these pressures have been growing over time as adverse climate incidents of firms have been gaining greater traction in the media. And as business press remains an important source of information for the public markets, negative news coverage of borrowers' impact on climate change can have a substantial impact on banks' lending practices. And this has been illustrated through a number of recent high-profile cases. A good example of this is JP Morgan's recent decision to end loans for Arctic oil drilling after a series of protests which was widely covered in media. So what we do in the paper is examine how banks change their lending terms after one of their corporate clients are implicated in an adverse climate incident. So what are these adverse climate incidents? They include things like oil spills and other pollution incidents, excess carbon emissions, deforestation projects to make room for pasture land, for instance. We gather the data from a RepRisk, which is a data service firm that collects data on negative ESG, environmental, social, governance events from thousands of media, regulatory, and commercial documents. So they employ proprietary machine learning algorithms as well as analysts to assign news events proprietary scores based on the severity of the incident, which measures how the magnitude of the incident itself, how important it is, as well as the influence, the reach of the readership of the source of documents. So something that is covered in the New York Times, for instance, would get a lot more traction than something that's covered in a local newspaper. So they classify these ESG events into 30 categories, and we focus on one particular one, the ones that are related climate incidents. So in the paper, we have a number of examples of these incidents just to give you an idea of what we're looking at. Here's a press release that was put out for Greenpeace, which was then picked up by a number of newspapers that implicates Nestle in the deforestation project, destruction of rainforests in New Zealand. So why are we looking at these news events as opposed to other things like carbon emissions or environmental standards adopted by firms? Well, there are three reasons. First, things like emissions or other environmental data reported by companies seldom vary over time. So they do not have significant changes from year to year. By analyzing these adverse climate-related incidents, we believe that we can have better identification. We can explore variations in the timing of specific incidents, look at how lending terms before the incidents and how they change afterwards. And we can also do cross-sectional analysis based on the intensity and the severity of the incidents themselves. Second, the outcomes of climate engagements and climate performance and standards adopted by firms are multidimensional in nature. And as Lee Wu, as well as Hong Li and Zhu point out, you have to look beyond just carbon emissions and environmental standards adopted by firms. Again, we believe that looking at these news events gives us a better idea of the actual practices that we use. And finally, banks are more likely to incorporate borrowers' poor climate performance if there is greater coverage in the media, which will lead to greater awareness among customers, investors, and regulators, putting pressure on the banks to act. So what we're going to do is we're going to investigate how a borrower's adverse climate-related incidents affects bank loan terms. So we're going to look at the loan terms before the event and after the event. And what we'll show is that loans that are initiated after the occurrence of firms' first adverse climate incidents have significantly higher spreads, they have shorter maturities, they have more covenant restrictions, and they also have a higher likelihood of being secured by collateral. In cross-sectional regressions, we also show that the intensity, the number of articles, as well as the importance of the events, as well as the influence, the source of the news coverage, are also important, and they exaggerate the pricing of bank loans. And finally, we'll dig a little bit deeper and show that it's really reputational concerns that drive these loan imprints and other restrictions on the loans that are generated. So there's a fairly large literature on climate finance, and it has been growing quite a bit in recent years. So I won't go into detail all the papers, but there's a strand of literature that examines the impact of climate performance on firms' capital structure and cost of capital. Within that, there's some papers that examine how climate performance is priced within capital markets. More related to us, there is a strand of literature that examines the impact of climate change risk on bank financing. And here the closest paper to what we're doing is by Chava, 2014, where he uses environmental scores from KLD stats and shows that lenders charge higher interest rates on bank loans issued to firms with lower environmental scores, KLD scores. So KLD stats, as I mentioned, poses some difficulty for inferring causality because these CSR disclosures seldom vary across years. So our study contributes to this literature by essentially trying to improve on identification, by using the variations in the timing of these specific incidents to infer causality. Also, as I mentioned, we dig a little bit deeper and show that it's really the reputational concerns of banks that drive the changes that we see in the lending market, as opposed to an increase in credit risk of the borrowers. So let me talk about specific hypotheses as to why you might expect these climate incidents to have an impact on loan spreads and other contract terms. First is credit risk. These incidents could reveal information about the climate-related risks faced by the client firms, as well as the processes that they have in place to mitigate such risks. So these adverse incidents may increase firms' liabilities, their regulatory risk, which might affect the firm's ability to repay its loans. It could also affect the collateral that they might have in place, which would affect recovery rate in the event that the client defaults. So, when we talk about climate change, we think about, changes in the environment, higher incidence of hurricanes, wildfires, sea level rises, and so on. Those are all risks. Those are all could increase credit risk. But in the short term, the cash flows of the firm could be affected because of capital expenditures required to comply with current regulations. There could be penalties arising from climate negligence that could be substantial and harms companies' credit standing. There's also a risk of some assets to become stranded, unusable because of changing regulations. The BP recently had to write down billions of dollars of the value of their assets because of that particular issue. So even in the short term, cash flows of the firms could be affected, which could increase credit risk, which could affect the credit terms. And also more specifically, environmental regulations sometimes subordinate the claims of debt holders. So banks, in fact, may face additional liability under the Comprehensive Environmental Response and Compensation Acts. There are also all sorts of indirect economic costs. There could be negative perceptions held by employees, customers, and so on, which could impact firms' ability to recruit, employ talented workforce, which could again affect the firm's credit risk. So even in the absence of high credit risk, banks may face reputational risk from being associated with firms that are perceived as polluters or perceived as environmentally irresponsible by the public or banks' stakeholders. And we know that media coverage of these issues have increased over the past decade, and it's getting much greater traction. So this is a potential risk faced by banks. So in order to enter into a lending relationship that they think that the public views as having socially questionable climate practices, they might need to require a premium. So for these two reasons, we would expect banks to increase their loan spreads and give structural loans after an adverse climate incident. So the main specification that we used in the paper is provided on the slide. So we are going to have loan spread on the left-hand side. We have a dummy post-incident that will take on a value of 1 for the time period after the borrower's firm's adverse climate incidents. Then we'll have some controls and year and firm fixed effects. So be controlled for things like firm size, profitability, tangibility of the assets, leverage, book-to-market ratio, financial health measured by ultimate Z-score, as well as some loan characteristics such as the size of the loan and loan's maturity. Our sample is comprised of 20,297 unique loans issued to over 2,600 firms between the years 2000 and 2016. So our sample includes only firms that have experienced an adverse climate incident. In the paper, we also use alternative samples where we look at all firms, including firms that have not experienced an adverse climate incident, and also include only firms that have experienced only one incident, since we're looking at the impact of the first incident. So these are our main results. Since we include firm fixed effects, the results reported in column 3, you can think of it as a difference in difference model. So what happens after the first adverse climate incidents. So if we don't put any fixed effects, which is the first regression specification, there's about a 70 basis point increase in spreads. In the last column, we include both year and firm fixed effects, and it goes down to about 15 basis points. So that is economically significant. So in our sample, the median spread is 100 basis points. So the spread, the left-hand side variable, is measured as the interest rate minus the LIBOR rate. So this 15 basis point increase is both economically and statistically significant. We then examine the impact of the severity and influence of the news coverage. So if there are a high number of articles covering the event, we measure that by a dummy variable that takes on a value of 1 if the number of articles covering the event is higher than the median coverage for all firms. We see that that is actually significant. So the greater the media attention, greater the impact. The severity of the event itself, although it's positive, is not statistically significant. The economic significance is also lower. If you look at how influential the source of media coverage is, so again, if it's covered by a well-known paper like the New York Times, we see that the impact is more significant. So these results, looking at severity and influence, suggest that it could be related to reputational concerns faced by the banks. So this will dig a little bit deeper into that question a little later.
4 minutes.
All right. So we do have a number of robustness checks that we do in the paper. We control for corporate social responsibility measures commonly used in the regression. Our results remain virtually the same. We also control for overall media coverage, media sentiment. So there's a paper by Bushman, which came out in TAR a couple of years ago. They show that as media sentiment regarding the firm improves, non-relationship lenders have a higher probability of originating loans, and their loan spreads are actually lower. So we do find results consistent with what they find, that overall media sentiment reduces loan spreads, but our results go through. Another possibility is that there could be pre-event traps. So firms involved in adverse climate incidents may have a prior trajectory of increasing loan spreads before the first incidents. So if the loan spreads were already increasing, what we would be capturing is those pre-event traps. To control for that, we follow Bertrand and Blatian and include lead lag values of the event indicator. And you can see in column 4 in that specification that they are kind of insignificant. Finally, we also do a Heckman correction. One possibility is that after a severe adverse event, no banks may want to deal with these firms, in which case, since we're looking at loan spreads, we're not going to be observing those firms. Although this would bias us towards not finding anything, nonetheless, we do a 2-stage Heckman correction, and in the first stage, we show that the firms are indeed less likely to get loans after an adverse climate event. But in the second stage, we show that the effect is not significant. The impact on loan spreads is negligible. So we also examine other loan.
2 minutes.
loan contract terms. We show that after the event, loans are more likely to be secured, have lower maturities, and have higher covenants. They also have lower number of lenders when we examine syndication characteristics, and loans have higher annual and upfront fee. So, digging a little bit deeper, we look at the timing of the events. So we look at what happens after 6 months, 12 months, and 24 months after the event. And what we see is that impact is greater in the first year following the incident and then declines significantly. This is consistent with banks' reputational concerns being the main driver. So we would expect to see a more persistent impact if the increase was due to a change in the borrower's default risk. Similarly, when we examine extraordinary items on the cash flow and the balance sheet, we don't find an impact. So if higher loan spreads were driven by cash flow risk due to regulatory fines, cleanup costs, and so on, we would expect the client firms to report higher extraordinary items. We don't find that. Their earnings remain virtually the same after the event. Again, these are all consistent with reputational concerns driving the results. Okay, so to conclude, we show that loans initiated after the firm's first adverse climate-related incidents have higher spreads, shorter maturities, and no covenant restrictions, and the results are both economically and statistically significant. So digging a little bit deeper, we show that these results are driven mostly by reputational concerns as opposed to increase in default risk. All right, thank you.
Hi, are you ready to present? Can you control the slides?
Yes. Okay, just one. Okay, great. Yes, I'm ready to start. Okay, thanks everyone for attending this session, and thanks for including our paper into this session. So our paper's title is "The Rising Tide Lifts Some Interest Rates." So basically, we discussed how the climate change related natural disasters affect loan pricing. This is a joint project with Ricardo Correa from Federal Reserve, Christoph Heffer from Emory University, and Hugo Leo from University of Georgia. So I think there's no doubt now that we make a statement to say climate change is a key economic challenge. Actually, the paper Denise just presented also implicates the same big picture. Basically, the estimated damage by climate change by the end of this century will be up to 10% of US GDP. And from the government perspective, like the United Nations, it has the organization called IPCC. So basically, the organization gives assessment about climate change across the globe every few years, and their reports also shows that there are increased frequency and intensity of severe weather events that are closely linked to climate change, and that will continue in the future. So facing the big challenge caused by climate change, last November, for the first time for Federal Reserve, they they showed they make a statement says that the climate change can lead a sharp fall in asset prices and increasing uncertainty. And in Europe, like this year, a few months ago in July, ECB Governing Council also strongly committed to further incorporating climate change considerations into its monetary policy framework. So given this big picture, from academia's point of view, we are very interested in how the climate change can affect financial system, and to be specific, can affect different asset pricing. So first of all, I think it's very easy to think about the long-term effect, because a lot of things we mentioned now about climate change, their potential devastating effects may not happen immediately, like next year or next month, but it's something will happen in the future. So that's why the existing papers mostly focus on long-run discount rates in infinitely lived assets like equity or real estate. Now, if we switch our focus to loans, things are a little bit tricky, because we know that the loans, generally speaking, are within shorter period of time. So there will be a challenge if we want to price climate change into loan pricing, which is the mismatch between the maturity of this financial instrument and the long horizon of climate change. So if you think, for example, if you think about sea level increase, which is the most obvious phenomenon related to climate change, its effect will play in like next 20 years, 50 years. Well, if you think about the average maturity of corporate loans, they're just about 5 or 6 years. Therefore, it's really important to find the right events to capture climate change trend. We want to relate that to corporate loans pricing. And in this field, recent paper focused on municipal loans, municipal bonds, and they find that investors have only very recently started to price projected long-term sea level rises into municipal loan pricing. So in this paper, to overcome the mismatch issue I mentioned before, what we do is we find a very unique channel, which is through severe weather, closely linked to climate change. So we treat this extreme weather events as a potential channel through which climate change already impacts our economy today, already impacts people's social activity today. And we are focusing on whether there is an immediate physical effect of climate change on corporate fundings right after the occurrence of some severe weather events happened. So the basic idea we have is like this. Climate change leads to more severe and more frequent weather events, and then these events will impact the performance and the creditworthiness of the borrowers. And from the bank's perspective, they will keep updating their priors about future severity after they observing the occurrence of this extreme weather events. So like we know back to 20 years ago, hurricane might not be talked of so often on media and on our daily talks. But today, because of the repeated occurrence of hurricanes, people use that as a window to know, to have a better idea about how severe climate change could be, right? So if this channel works, we will expect to see banks will increase the loan spreads to compensate their increasing prior about climate change related risks. So here for severe weathers, we focus on those three hurricanes, floods, and wildfires because they are already showed in long-time study in climate science that their severity and frequency are very directly linked with climate change. We also show some anecdotal evidence here. So if you take a look at banks' recent 10K filings, most of them mention, all of them show they care about climate disasters, and most of them show they worry about the trend, and some of them even mention some specific extreme weather conditions which they think are related to climate change. So I think that's from the other angle to prove our channel should work in the real life. Okay, so before I go to the detail of the test and the data, I want to briefly talk about the empirical framework we have here. So we know that disasters, for example, hurricanes, happens across the country in different locations. So for example, if we focus on New Orleans, there's a hurricane hit New Orleans, like Katrina. And there will be a firm located in New Orleans which will be affected by this hurricane, of course. So a very direct approach to test how banks change their pricing after extreme weather is to look at those firm A located in New Orleans and see what is the disaster effect on the loans, right? So even though this method is direct, but it's kind of naive because there will be two confounding effects. One is that those firms will suffer physical damage because of hurricanes, so no wonder banks will will change the loan terms. On the other hand, the occurrence of the hurricane will change banks prior about those risks, therefore they change the bank loans. So we want to capture the second effect rather than first effect. Therefore, this approach is difficult for us to tease out the second effect. So in fact, in our paper, we choose another way. So rather than look at the firm A located in New Orleans, we look at the firm B, which are other firms located in other locations. So like firm B in Houston. So the unique thing here is Houston is a hurricane-prone city. However, it is not hit by this hurricane. So it gives us a very good measure to identify those firms who have the hurricane exposure, who suffer the hurricane risk, but not hit by this hurricane. And we care about whether after hurricane hit New Orleans, banks, because they change their risk priors, they change their loan terms, lend to firms in other hurricane-prone regions like firm B in Houston. And of course, we have our control firms like firm C here in Dallas. So we know like Dallas is area has no connection with hurricanes. So those are totally those are firms without any extreme weather exposures. So they can be used as a control group. So ideally, we're testing the loans issued by the same bank to different firms, and if everything else controlled equal, ideally, the only difference between those two borrowers, like firm C and firm B, is one firm location-wise has higher hurricane exposure, while the other firm has zero hurricane exposure. So if we find after hurricane occurrence in other places, the loan term to these two types of firms changes, then it proves that banks indeed change their risk prior because of the extreme weather events. Of course, I simplified our setting here because we know for public firms, they actually have lots of locations. They're not just located in one place. So we actually take care of all the footprint distribution of the firm. I will talk about that later in the data part. So basically for our data, Disaster-wise, we use shelters. So that gives us detailed information about each disaster's occurrence location, time, and the type, things like that. So for each location, we identify whether this is a disaster-prone county based on past 10 years disaster history. So we do that for rolling windows. Therefore, every month we can identify for each county whether it is disaster-prone. And for firms, we use the NET database, which gives us detailed establishment information of the firm. So because we already have the county level disaster prone information from shelters, now we combine it with NET and we get each firm's location weighted measure to show how likely this firm is prone to hurricane. So for example, if the firm is the hurricane exposure is 90%, that means 90% of its establishments are in hurricane counties. Comparing with another firm whose hurricane exposure is only 10%, so that means the second firm's only 10% of the second firm's establishments are in hurricane-prone regions. So in this way, we're not just focusing one location of the firm, not just the headquarters of the firm, but the establishment of the firm. We get a lot of information from DealScan, and our sample focuses on the year from 96 to 2019. So we take a look at 5 types of disasters. So the 3 in red here are treated as climate change related. And the other 2, like earthquake and winter weather, the blue ones are treated as non-climate change related. So we can see that banks' response to these 2 types of disasters are different, which is another evidence to show that banks are not just responding to extreme weather, they're indeed responding to climate change concerns. Okay, I will skip this too. And this is a basic empirical test model we have. So for each firm I, we look at their loan from bank J in month T. We take a look, we are examining the spread of the loan. And there are 2 dummies we care about. One is the recent, for example, I use hurricane here. So one is the recent hurricane dummy, which is a time dummy. So it indicates whether in the past 3 months there is a hurricane happened somewhere. So like Katrina hit New Orleans, the example I showed before. While the blue one, indirect hurricane, is a firm time dummy. So it shows whether this firm is in a hurricane-prone region. So like the firm in Houston, I used in the example, will have this indirect hurricane dummy as 1, while the firm in Dallas will have it as 0. So we care about the interaction term of these 2 dummies. So after a recent hurricane, whether those firms with indirect hurricane exposure suffer different, while facing different loan pricing. If that is true, then we will expect to see a positive and significant beta 1 here. So beta 1 is the coefficient we pay attention to. Of course, we very carefully conduct the test, so we have all types of loan level and firm level controls. More importantly, we have this one here. So this we control the bank time fixed effect. So in this way, we are comparing the loan issued by the same bank at the same time to different firms. The only difference is one type of firm has indirect hurricanes, the other has indirect hurricane as 0.
3.5 minutes.
Okay, good. So let me quickly show the empirical results. So basically we find if we test by hurricanes, you can see the interaction terms coefficient is positive, and which economically shows banks increased their loan pricing to about 20 basis points after hurricane happened somewhere else. As a comparison, we show that for those two types of disasters which are not climate change related, like earthquake or winter weather, banks do not show any response. So okay, I think because I don't have because this slide is on the background, so I cannot click the hyperlink here, but we don't find effects on earthquake and winter weather, while we find similar effects like hurricane for fire and the flood. So that's comprehensively, that means banks are responding to climate change related extreme weathers. And we care about the channel here, so we think it's related to the attention to climate change. So basically, we introduced the Wall Street Index climate change index here, so which shows a time varying attention, which is a time varying attention measure about how closely Wall Street Journal and all the financial journals pay attention to climate change related topics. So we find our effect is larger when this index is higher. So that means basically when people are more likely to pay attention to climate change related topics, this pricing effect is stronger. We also check how this scenario looks like in secondary market. So we find a similar effect here. So in the secondary market, after the hurricane happens, the price of those hurricane-prone loans decreases. So that means people dislike these loans after hurricane happened.
1 minute.
Yeah. So we also do a lot of cross-sectional tests. So basically show that when the borrowers with higher this financial distress level, this effect is stronger, and when the disaster's damage is larger, this effect is higher. And at the end of the paper, we read some discussion about whether this effect is permanent or not. So basically, by our findings, we find it's just it's temporary, and it leaves us a longer another question to discuss in the further studies, like why this effect is not permanent yet. But to wrap up the paper, I want bring the key conclusion here. So basically, our findings show that even though climate change is something will happen in 50 years, but it already shapes economic risks today. And we provided the first study to directly link climate change to present-day corporate loan cost. So that's all about this project. Thank you.
Okay, Glenn, ready to go?
Yes, sir.
Thank you, Dennis and I, for great papers and great presentations. Wait a minute. Oh, I went the wrong way. So these are both very nice, carefully done papers, which pay a lot of attention to identification. However, as is very, very often true in research, good papers leave us with new questions. And I was briefly at the end of her presentation referring to my big question as a takeaway from both of these papers. And that is, why is it that the effects on loan prices, on loan interest rate spreads, are very temporary? Because obviously climate change is here to stay. It's a very long-term, slow-moving event. If we believe that the banks have discovered the risk as a result of the events that are the focus of the two papers, then they should learn their lesson and, learn it permanently. And yet the pricing effects fade away. So there are two possibilities, I think. One is that climate risk is not yet priced, or at least it's not priced correctly, or that it's already priced so well that pricing is only briefly affected by transient events. We can't really know which of those two is correct, but I urge somebody somewhere to look into this general issue of why the effects are transient. Okay, now the papers are very similar. Denise's paper, has got the loan spread on the left side. It's got a reputation incident on the right side. I's paper, again, spread on the left side, and something related to climate on the right side as the variable of interest. Okay. Let me turn to Dennis's paper. So I find the analysis quite persuasive, that loan spreads respond to incidents as defined in the paper. An incident is an adverse climate change reputation incident, and that what that really amounts to is bad publicity for the firm. Dennis gave an example of Nestle. Greenpeace published a report accusing Nestle of fostering deforestation, which is a climate-related thing. Now, a nice thing about the identification strategy in this paper is that although the probability of one of these incidents is influenced by lots of borrower and other characteristics, the timing of the incidents is plausibly exogenous. Okay, and the authors are examining the impact of the incident on spreads in time windows after the incident relative to no incident loans and firms. So the identification police should be happy. And both papers really have a lot of nice auxiliary exercises that are, at the very least, casting a lot of doubt on, or in the best case, really ruling out alternative explanations. However, I'm not persuaded that climate risk is what is priced. And in the case of this paper, we need to keep in mind that loan spreads are negotiated. They are not set in an arm's length competitive market. So anything that reduces the bargaining power of the borrower is likely to lead to a change in spread. It may have little to do with the particulars of the bad publicity and everything to do with the reduction in bargaining power. Okay, again, we would expect that spreads would rise after bad publicity. So one way that this could be investigated is to use the non-climate related incidents in the same database. My understanding from the brief description in the paper is that there's a lot of other kinds of incidents in there. They're all bad news, or many of them are bad news, many types are bad news of one sort or another. If they all, or most of them, lead to increases in load spreads that then fade away, that seems to implicate a bargaining power effect. However, if the rest of them, or most of the rest of them, have no impact on spreads, that adds more credibility to the fact that this is specific to climate. Dennis talked about there are two possible explanations here if we believe that climate risk is being priced here. One of them is that the bad news implies increased default risk for the borrower. The other is that the lead bank in particular is concerned about their reputation. They don't want to be lending to borrowers with bad climate publicity. I'm less convinced that it's proved that it's a reputation effect, but I do find that more persuasive than a default effect because these borrowers are pretty far from the default boundary. Median spread of 100 basis points, that's kind of a pretty good double B firm. They really have to take a pretty big hit in order to go into default, and most of these bad publicity news stories do not have immediate implications for their cash flow or firm value. I got a couple of nitpicks. Why don't I skip by these? Because I'll send them to the authors. And I'll turn to I's paper. So again, we have loan spread on the left side, and we've got a nice plausibly exogenous interaction of indirect exposure to the hurricane interacted with a recent hurricane. I just want to note that the paper is selling itself slightly short. You know, both papers in some ways are, but I's paper a little bit more. A nice part of both papers' identification strategy is not only the plausibly exogenous variable of interest, but there's a lot of fixed effects. You know, there's borrower fixed effects, there's time, other kinds of fixed effects. These really help to rule out a large number of alternative explanations. I urge both authors to emphasize this just a little bit more in the paper. What's an indirect exposure? I covered this pretty clearly. It means the borrower has operations in locations that are prone to the kind of disaster being examined, in this particular case hurricanes, but not to the current disaster. Okay, and it's less likely that loss of bargaining power is what's driving the results in this paper. Because there isn't news that is specific to the borrower who has indirect exposure. Okay. However, and I didn't emphasize this enough in Dennis's paper, the increase in spreads doesn't persist for very long. In Dennis's paper, there's pretty good evidence that the increase in spread persists for a year. But in I's paper, it persists for only about a quarter. And so, you know, in my view, even notoriously short-sighted banks should retain a climate risk lesson for longer than that. And so either they are really, really short-sighted, they are really have short attention spans, or something else is being priced here. The paper has a nice analysis of secondary market price effects, and that gets rid of all the selection issues that are associated with origination of the loan, but it needs to be presented more clearly. It sure looks like the price impacts in the secondary market are also not persistent, lasting only about a month, but the pricing sample is not very clearly described. You know, just some more clarity there would be helpful. I've got a pretty weak alternative explanation here for what's going on that's not bargaining power related, and that is loan contracts and their covenants typically require borrowers to be adequately insured. It might be that after a hurricane, any hurricane, the lead bank checks insurance more carefully after a natural disaster, and a borrower that happens to be originating a loan is going to have to pay more because their insurance is not up to snuff. However, the covenants force the firms to fix their insurance, so even firms that have not originated yet, and so the increase in primary market spreads doesn't last very long. That's not the same as pricing climate risk, but this explanation is much weaker at explaining the secondary market price effects. I did not emphasize this very much, but she mentioned a placebo test with earthquakes. This isn't so persuasive either, at least as it is currently described. In the case of earthquakes, losses are typically very localized. And as I read the paper, it looks like to get into this Sheldis database, the governor of the state in which the earthquake caused some damage is going to have an incentive to include in the federal emergency management application counties that are broader than the ones who actually experienced damage. And earthquake damage is typically very, very localized. The governor, of course, wants as much federal money as they can get, And so they're going to pretend there's damage in places where there's really not very much. So I fear that the earthquake data in particular is noisy enough to make insignificant coefficients likely. The winter weather is relegated to an appendix. I guess I would recommend relegating the earthquake stuff and promoting the winter weather stuff. Okay, so to wrap up, we got two really very nice papers. The authors take identification very seriously. They're thoughtful, they're careful, they're sophisticated. I'm not really criticizing the papers. I'm just suggesting next projects, because I am not yet persuaded that climate risk is priced in the loan market in the way that we as economists think it should be. So thank you all very much for listening. Glenn, I guess you're in charge of what happens next. I'm not sure how we're doing on time.
So we have a few minutes if you want to have the presenters respond.
Sure. How about if we go in the order of presentation?
Should I go?
Yes, sir.
Okay. Well, Mark, thank you very much for the comments. They are very helpful. So when it comes to pricing of climate risk, I do agree with you. It is, climate risk itself is very difficult to define, and it is very slow moving. So, and maybe we did not state this clearly, but the reason that the banks might react to these climate incidents is twofold. Again, it could be if it's a true fundamental risk, it should unless it affects credit risk, it's not going to be priced by the banks. But there is a lot of anecdotal evidence that there's growing pressure from shareholders, investors, and other stakeholders of banks to sort of take climate concerns into account when banks make lending decisions. JP Morgan that I mentioned is a good example of this. So if we do find a transitory effect, I think this is consistent with banks pricing in a reputational impact, reputational risk. So if we're going to be associated with you, we're going to charge a little bit of a premium. And you mentioned that one thing we could look at is non-climate incidents, whether they also lead to transient effects. It's possible that they do, and I'm sure we would find something there. But again, I'm not sure that would invalidate that climate concerns are being priced transiently. So thanks very much for the comments.
Thanks, Mark. Very helpful discussion, and I partially agree that it's kind of puzzling why this effect is not long-lasting as we expected. That's actually quite important. However, it's what the data shows. So one guessing me and my colleagues have is that because we know like it's a trend, right? Like 20 years ago, climate change is not weird enough. We are probably at a stage that it's being aware to some level, but not to the best level. So I guess that might be helpful to explain why it does not last as long as we expect, which means the awareness is actually not long enough. But I do think the weak, you call the weak explanation you just suggest is something we should consider, and I'm very thankful to that. About the earthquake, yes, I totally agree. Like if we just use the shelters data, the occurrence of earthquake is quite localized, and also we know U.S. is typically not an earthquake country, like comparing with Japan or other like island countries. So what we did is we, besides that, we use foreign earthquake also as the occurrence dummy to show earthquake happened somewhere, because we know like even though tsunami happened in Japan, it's raised the awareness about earthquake globally. And moreover, we do another test. So rather than look at the occurrence of the earthquake, we look at the ground motion assessment across the country. So for that measure, it will be more frequent because it could be ground motion is severe, but the true earthquake does not happen. So we use that to show to show that how likely a region is suffering the earthquake risk. And we do find the similar finding, like we don't find a strong effect there. But I think you might be right. So we should give more emphasis on the winter weather events, because that seems more persuading. Based on my recent presentation to different people seems like you said, prefer that results more. So we will also think about that. But thank you very much for the very nice discussion.
Okay, everybody who's left, how about a virtual hand for the presenters?
Thank you.
Thank you to Mark. Thank you to our presenters. Thank you for everyone for sticking it out to the end of Friday. I do want to encourage everyone to join our virtual receptions. We have a room A with links in the chat. Room A is set up for the presenters from the morning. Room B is set up for presenters from the afternoon. You can also find the links in the agenda. And I want to thank all of you for joining us, but I want to give a really big shout out to all of the people who helped make the event possible and run smoothly. Glenn Kivlin, Ebony Oliver, Donna Vogel, and David Spanberg really doing the back-end operation. They've been phenomenal to work with and have really made this as fluid as it's been. So big thank you to them. I'd like to give a big thank you to Troy Kravitz and Haluk, who are on the organizing committee with us. And I would also like to give a big thank you to Rosalind Bennett and Philip Shively, who helped shepherd us along the way. And really, Roz's notes from doing this for many, many years prior is what made it possible for me to at least have some ability to help the rest of the team get this to where it is. So thank you, everyone, for joining, and thank you, everyone, to the team. I look forward to seeing you in the virtual rooms.
Biggest thank you to John. Thank you, John.
Thank you all.